It is 9 a.m. Eastern on Monday, June 21st. This is Yahoo Finance Live. I'm Julie Hyman with Miles Udlin and Brian Sazi. Take a look at the futures this morning. Rough week in particular for the Dow. Last week, its worst since October, but it's seeing a comeback this morning. And the S&P and Nasdaq are also indicating a higher open here this morning, with the Dow gaining the most, having lost the most last week. We're also watching crypto this morning, and that's on a couple of different cross currents. One of them, a continuing theme of China's regulation of cryptocurrencies in its borders, both on mining and on trading. That seems to be putting some pressure on things this morning. We're going to talk about that more in just a moment. Also, it's Amazon Prime Day. What Amazon's so-called holiday means not just for the e-commerce giant, but for all of the tiny businesses that rely on it. And following dot plot mayhem last week, it's a Fed speech bonanza this week. We'll discuss what the Federal Reserve's outlook could mean for bank stocks with analyst Mike Mayo later in the hour. But first, let's set up that conversation because, of course, inflation has been a big topic. The dot plot and the future path of interest rates, a big topic last week, and when we might finally get some tapering. We heard the official line from the Federal Reserve. Now we'll get more insight perhaps into who was responsible for which dot, because we got a lot of Fed speeches this week. Our Brian Chung is here to help walk us through all of that. So we have some hints, we have some inferences. We know some of the dots already, but we're probably going to learn more this week.
Yeah, well, Julie, we need to rewind to last Wednesday's Federal Reserve announcement where they said that they'd be holding interest rates steady, maintaining that $120 billion a month pace of asset purchases. But of course, it was the dot plots that got everyone all excited about what the Fed's next steps might be and whether or not those steps might be coming earlier than expected. So if you take a look at the dot plot, which is a quarterly projection of where interest rates could be over the next few years, you can see that the Federal Reserve's median dot, again, the median member of that 18-member committee, projecting 2 rate hikes by the end of 2023. We got speeches or remarks from 2 Fed officials, Neil Kashkari from Minneapolis, who told, I believe it was the Associated Press, that he does not see the case for raising interest rates through 2023. So we know that his dot remains pinned at near zero. But we saw St. Louis Fed President James Bullard tell CNBC that he sees the first rate hike coming at the end of 2022. So you can start to shade in which dots are which Fed officials. Now, of course, this is going to be the major week where we start to see a lot of those Fed officials go out and make their public remarks. Some of them might be a little bit more willing to share exactly which dot was theirs than others. But of course, that could introduce a lot of volatility into markets depending on what they say, at least based off of the commentary and the reaction that we had gotten last Friday. Now, of course, we have Fed Chairman Jerome Powell set to speak tomorrow on Tuesday. That could be a counterweight to whatever the other Fed officials say, since we already know the Fed chairman's line since he shared that on Wednesday, saying that he wants to downplay the role of the dot plots and that everyone should be taking it with a big grain of salt. Again, that appearance will be on Tuesday on Capitol Hill. And then we also have a number of other Fed speakers, including New York Fed President John Williams today. Also pay attention to Mary Daly from San Francisco. She's a voting member of the FOMC. She'll be speaking tomorrow. But of course, guys, I'm taking a look at bond yields right now. Keep an eye this week through all of these Fed speeches on the 30-year bond, which has really been flirting with the 200 basis point level. Keep in mind, guys, that was as high as 222 basis points last Wednesday.
Brian, isn't New York Fed President John Williams, isn't his discussion or speech this week perhaps the most important outside of Fed Chair Jerome Powell's? Because he's still seen as a dove. Any hinge or tinge of hawkishness from him would not be a good thing.
Yeah, well, we're going to hear from Powell on Tuesday. We're also going to hear from Mickey Bowman. She's a governor at the Fed later this week as well. But outside of that, we're not hearing from some of the kind of people that you tend to see as the big hitters on the Federal Reserve Board in terms of steering monetary policy conversations, namely Rich Clarida, the vice chairman. We aren't scheduled to hear from him this week. So in deference to that, the New York Fed President John Williams, who has a permanent voting role on the FOMC, but is still one of those regional heads, he is likely to be the highest profile person outside of Powell to be speaking this week. He'll be speaking at 3 p.m. today. Now, of course, what his commentary is going to be remains to be seen. We will likely get some sort of speech text from him around that time. But when it comes to these dots, we have to remember that there's no obligation for these Fed officials to come out and let the media or let anyone that they're talking to know specifically, well, that dot for 2022 was mine, that dot for 2023 was mine. It's completely up to the discretion of the Federal Reserve officials themselves if they want to share which dot was theirs. Now, of course, we heard from Neil Kashkari, heard from St. Louis Fed President James Bullard about which dots were theirs, but the likes of John Williams, I don't expect him to be someone that would be likely to say this was exactly where I charted my projection for the June summary of economic projections. And I think a number of other Fed officials might do the same. So for Fed watchers, we're going to continue to try to shade in which dot is attributed to whose, but we have to remember that it'll still likely be an incomplete picture because a lot of these Fed officials will probably reiterate what the Fed chairman was saying, which was don't pay too much attention to the dot plots. These are just forecasts. A lot of things can change in the next year and a half or 2 years. So just remember that we are outcome based, not necessarily outlook based.
Brian, I'm also just curious how you've thought about the bond market in the last couple of days, because the reaction on Wednesday, the initial reaction to see yields higher was what you would assume would follow from a more hawkish projection from Fed officials. However you want to carve that, I think more hawkish is a pretty standard way to characterize what happened, especially considering inflation and GDP numbers, so on and so forth. But now we've seen yields come back in, and I just wonder if maybe the takeaway is that the market believed the Fed had to come meet it where it kind of has, and right now investors are sort of comfortable with today's forecast from the Fed with respect to rate hikes, maybe even next year.
Yeah, well, the bond market is going to bond market, and the reason why it goes up or down is the same type of speculation that you'll have with the equities market. It's not necessarily attributed to any one piece of news, but of course, when you see some of the large outside the regular standard deviation moves in the 10-year and the 30-year on the longer end, you do start to wonder exactly what's going on here. But what I've heard is that, yes, the Federal Reserve may have been the trigger for some of these moves, but they may have been amplified by certain bets that bond traders have been putting on Treasury yields of longer duration. And one of those possible trades was just the curve steepener trade, where headed into the Fed meeting before we got that kind of announcement that the Federal Reserve was thinking or had already kicked off their discussions about tapering in that June meeting, which was a bit earlier than others expected, people were shorting the 30-year and they were trying to buy on the short end, which was hopefully, they thought, steepening the curve because they had anticipated that the Federal Reserve would be too late to raising interest rates, that they would ultimately have to see eye-popping levels of inflation before they pump the brakes, which would require maybe a 50 or 100 basis point at a time interest rate hikes. Now, of course, the Federal Reserve now doing the opposite of that, saying we're paying attention to this. In fact, we're going to pull forward maybe our timeline for raising interest rates, which caused a lot of those steepening trades to blow up. What happens is, in that case, if you were short 30-year, you now all of a sudden have to buy 30-year bonds. That then flattens the curve back out. You start to sell some of those shorter end treasuries. That's the reason why some of these flattening trades have continued to move the yield curve in a little flatter direction, which explains the falling yield on the 30-year, especially from 20 basis points higher where we saw in the middle of last week. So I think that it's a lot of kind of financial pressure that's also contributing to the moves that we're seeing, in addition to the Federal Reserve action itself. We have to remember quadruple witching was also on Friday, so there was a little bit of intricacies in the way that markets were moving, specifically at the end of last week. Now, whether or not that settles this week remains to be seen. We have at least 10 Fed speakers that are going to be out there into the ether speaking their minds, so that could introduce more volatility, less volatility. Who knows?
Brian, I was reminded this weekend about our level of market expertise and knowledge when I had a friend ask me, what is a Fed hawk and what's a Fed dove? I'll put that question to you since you are the Yahoo chief correspondent.
Yeah, I feel like we do tend to say, like, oh, it's the Hawks versus the Doves, and everyone's like, well, what is this, like a West Side Story kind of like terminology here? Like, what does that even mean? Well, Hawks generally refer to policymakers within the Federal Reserve that would be a little bit more in favor of tightening policy versus the Doves, who would tend to be more, they want more accommodative policy, easier money policies. So it's not necessarily as binary as, raise interest rates or lower interest rates, because in an environment like this, there's no other direction to go than up, right? So just because you're saying interest rates will go up, that doesn't necessarily mean you're hawkish. In the context of where we are right now at the zero bound, hawkish might be you want interest rates earlier than other of your colleagues, in which case the doves might be those that are advocating for, raising interest rates, but just at a later point in time. So it is much more about comparisons, but generally speaking, hawks refer to those that want to raise interest rates at a more aggressive level or try to normalize policy at a more aggressive pace than the doves.
Brian, I'm envisioning some really creative person on the internet with like members of the Fed in leather jackets and like
Yeah, with like, a little snapping,
little West
right?
Side Story action. Yes, exactly. Please, someone out there on the internet, do that for us and send it to us. Thanks so much, Brian Chung. Appreciate it. We are going to move to a different type of currency, I guess. So from talking about rates and the implications for the dollar and other currencies, Bitcoin and the cryptocurrencies, because China, it sounds like, is coming down on things once again in a couple of different ways. Apparently, reportedly, China has ordered Alipay, the payment platform there, and domestic banks to not provide services linked to cryptocurrency trading. And then there's also some reported crackdowns on mining in the Sichuan province in particular. So we're seeing cryptocurrencies fall in today's session as a result of all this. And guys, what's interesting about this, of course, is that China has sort of been on this path. And I guess the question is how real the threat is from what it's doing to overall cryptocurrency trading. I don't know what percentage, for example, of crypto trading overall occurs in China. I know a lot of the mining does occur in China, so that would seem to be more problematic, Miles.
Yeah, I mean, certainly whenever you hear China cracking down on asset X, that tends not to be good for asset X, whether that means, you go back in time 5 years and there was a crackdown on the ability, for China to move renminbi offshore to then acquire dollars. And that created a whole situation, oil prices going on, all that stuff. We don't need to go through, 5-year-old market history here, but it tends, again, in general, not to be a great path for any financial asset. It's certainly been the case with Bitcoin as well. But I think the most interesting thing about all cryptocurrencies, and well, maybe Ether's a little bit different, but certainly Doge and Bitcoin, which are, again, fundamentally faith-based assets, is that we can very cleanly look at the chart, and that tells us a lot about the health of any given trend or any given trade. Right now, Bitcoin, not only did it get rejected 3 different times at that record high level around 60,000, it's now been rejected 3 separate times on an attempted rally at around 40,000 to get back into that pocket that we soared into in January and into February. And the chart for Bitcoin right now, with a declining 50-day moving average, with a declining 200-day moving average, is just not a great setup. And I know we're going to talk with Jared about this later on in the show, and he's been talking now for months, really, about the technical setup for Bitcoin is just not all that constructive. And of course, Bitcoin is, the beginning and the end, really, in the crypto space. And I know that there are some, uncorrelated stories, let's say, that other coins can tell and that markets will glom onto outside of Bitcoin. But in general, the sentiment within the space overall is going to be determined by whether the price of Bitcoin is rising or falling. And it's now, we're now moving into month 3, month 4, where Bitcoin itself has just not had a lot of upward momentum. It's been pretty much cut in half, just about cut in half from its record high. And Sazi, it's been a real slog here after that sort of euphoric and sudden move from around 20,000 to 60,000 that we saw at the beginning of the year.
Right, Miles, and a really important point you mentioned there on the technicals, and I'm on the Yahoo Finance cryptocurrency screener right now, and the pressure, at least today, is not just confined to Bitcoin. You have Ethereum getting pounded, Dogecoin down right now about 18%, and all the coins are under severe pressure. Also, we have futures up here, and look, Coinbase shares are down almost 4% in the pre-market. NVIDIA, that stock has been swept up into the Bitcoin trade. That stock's down 1% pre-market. And Miles, and you flagged this this morning here, you had Michael Saylor over at MicroStrategy come out with a pretty important tweet that he's buying cryptocurrency, and that is not necessarily putting a floor into the market right here.
Yeah, he tweeted about it, and it was linked to a press release, which I guess is how crypto leaders do this kind of thing. They bought an additional around 13,000 Bitcoin, spending nearly $500 million in cash. Average price, $37,617 per Bitcoin. So, the average cost of acquiring these is still lower than where it is right now, according to this tweet and according to the press release. But it's interesting here. What I also found interesting in the release is that MicroStrategy still reminded us what they do. which is a business intelligence
What do
firm,
they
whatever
do?
that means.
Unsure.
Whatever
I
that
thought they were a
means.
crypto exchange.
Because, well, that's what we think of MicroStrategy is doing right now, and that's why people presumably buy MicroStrategy shares, right?
Sure. Maybe they sell hot dogs.
I talked to someone last week who works at, let's call it a major national retailer, and they use MicroStrategy's software for whatever you do when you work in the finance department at one of these companies. So it's a real company. It's about $1 billion annual revenue business attached to that. Two things though, 26,000 mid is the adjusted price for MicroStrategy. So it'll be very interesting to see if we indeed see the price of Bitcoin get back to its average acquired price and what happens there if MicroStrategy considers selling any of it. And we can do the quick math here. Right now, the company has a market cap right around $6 billion. So you've got $1 billion run rate business. We can value that at 1 time that revenue, maybe 2 times that revenue. So you're still looking at the Bitcoin holdings of MicroStrategy trading at a multiple of the holdings themselves. They don't trade at just the 2 billion unless we're going to argue that we want to value the core business at 4 times, but it's not growing at the kind of speed that you would generally see a business that's valued at 4 times revenue. So you can save that for later, but I think we're coming into some interesting price levels here for MicroStrategy, which again is pretty much oriented their whole business around buying Bitcoin.
Yeah,
Most of their
well,
business.
as we know, the valuation models for Bitcoin and things like it are, I don't know what exactly. We're going to take
at least has a model of sorts.
Yeah. When we come back, we're going to talk Amazon Prime Day and what it means for all of the third-party businesses that sell stuff on Amazon. We'll be right back.
All right, welcome back to Yahoo Finance Live on this Monday morning. As you may hear as we're chattering on the way in, it is Amazon Prime Day, the first of a 2-day special event. Yahoo Finance's Dan Howley joins us now to talk about, Howley, what all the deals are. We were all just chatting in the break as a group. The mask is kind of off on Prime Day now. It's sort of just they're unloading what seems to me a lot of electronics junk that's sitting around in Amazon warehouses. And look, some of these things you might need. They are decent prices, but is there anything to be excited about in particular, or is it just kind of a rehash of what we've now come to know Prime Day as?
I think it's a little column A, little column B, right? We were just talking about how there's these kitchen shears that are on sale, and they're one of the main deals on the site right now. I also got something for dumbbells, which, I mean, hey, they were really hard to find this time last year, so nice to see that they're available. But there are going to be kind of some of the big tech items that people are interested in, some of the more appealing items probably. But don't forget, Prime Day started as basically a way for them to sell toilet paper more. The first year was basically just nonsense that people were like, well, why is this even an event? And then they slowly started to add more stuff. But you will see deals on things like TVs, things like big appliances. Hopefully you can find something, or if you're looking for something out there, you probably will find a good deal on it. But there will be those kind of deals where you're just like, why the hell am I looking at scissors on Prime Day? Wasn't this supposed to be a big event with a concert and everything like that?
These are all good questions. I mean, it's also really interesting because right now inventory is so tight on so many things, Dan. So maybe people are more willing to go a little bit further afield just because they're so desperate for certain things. I also wonder what all of this means for the third-party sellers on Amazon, which has been a big and increasing part of their business. Like, how does the whole pipeline work if they're trying to get their stuff out there today?
Yeah, the big thing for third-party sellers is, and I was speaking to a couple of retail experts here, they were saying that if these companies aren't prepared for something like a Prime Day, then it's, it could end up really hurting them, actually. This is a finely tuned machine that Amazon has here. If you go into Prime Day thinking that it's just going to be a big win for you, it's not. You need to have your inventory ready. You need to recognize that this is a chance to pull in customers for the long haul. And you need to make sure that what you're offering is unique and interesting enough. You can't be one of the hundreds of people selling X item that's exactly the same as the others. So, trying to make a race to the bottom as far as pricing goes will hurt you very badly on margins. You have to just make sure that you have something that, again, is unique, interesting, and something that is going to draw people in. Hey, maybe it's a pair of scissors. Who knows? It seems to be, doing well on the site right now. But I do think, for third-party sellers, it is kind of a winner take all almost. And they said last year they had 3.5 billion in sales, but they had close to 10 billion or more than 10 billion in sales overall. And this year we're expecting somewhere around 11 billion. I think for the third parties, a lot of it also will have to do with, can they get items to people in time? The whole idea of the pandemic hangover, as far as shipping, things along those lines, is still going to affect some of these companies, and so they may run into issues here. There's also that kind of pent-up demand for people to just get things that excite them, right? We're finally getting towards the end of this pandemic. We may see a lot more people shopping here. They're expecting this to be the largest Prime Day ever. It's really 2 days, but we'll call it Prime Day because why not? This could really be lead to a backlog for some of these third-party sellers, and you have to wonder what that would mean for consumers who purchase through them.
Yeah, I might get a Kindle. I mean, it is a good deal. I haven't gotten a Kindle in like 7 years. But yeah, I mean, now I'm doing the whole thing where I click those kitchen shears, Hallie. Now my browsing history is just serving me 6 different kinds of scissors. I don't even want scissors. So it's I'm in an algorithmic nightmare here on Amazon, as I think a lot of people are going to be over the next couple of days. All right, Yahoo Finance's Dan Hallie with the latest on the beginning, opening hours, let's say, of Amazon's Prime Day. A lot more coverage to come here on Yahoo Finance over the next few days. All right, coming up on the other side of this break, we're going to have the opening bell on this Monday morning. Stuart Kaiser of UBS will stop by to talk about how he thinks the market is setting up here as we continue digesting last week's news from the Fed. Back with all of that coming up right after this.
30 seconds back, 30 to Julie.
We are setting up for a higher open in just a few moments here as we await the opening bell at 9:30 Eastern. All three major averages pointing higher after a negative week, in particular for the Dow last week. And as we try to figure out where we go from here, a lot of people have been talking about higher volatility potentially coming as we hear more from the Fed. One of the people who studies that very closely is Stuart Kaiser. He's UBS head of equity derivatives research. Stuart, it's good to see you. One of the charts that you sent to us has to do with sort of the relationship between the VIX, the S&P 500, what is implied in the VIX and what actually happens. And the way I read this chart, and perhaps I didn't read it correctly, is that the VIX doesn't really predict that well or as well. I don't know. Am I reading this correctly?
Hey, good morning, Julie. Look, the VIX is, I guess, the market's best guess at where volatility is going to be. It's also not directional, I think, which catches some people by surprise. I would say where we sit today is, the VIX has come off a little bit of where we got last week in the FOMC. It's pricing a fair amount of risk both today and over the next 3 to 6 months. And I think from our perspective, it's that next 3 to 6 months part that's probably the most important. The front of the curve, the spot VIX is going to move based on what the S&P is doing on a given day. But those longer term VIX futures are giving you some sense for how much uncertainty the market expects over the medium term. And I think if there was one takeaway from the Fed is that there's a lot more uncertainty about what that base case is kind of 3 to 6 months out. And we would expect that part of the curve, that part of the uncertainty pricing to remain a little bit elevated as the market kind of tries to digest exactly what they heard last week.
And, Stuart, we've talked about this a couple of different times over the last few months, but as you look out over the next few years, is that environment that we were in for so long, 17, 18, even go back, 13, 14 of low teens VIX for a long time as people just bet on low vols. Do you feel like that environment is on the horizon here, or has the pandemic and the way the VIX curve changed during that event, set things maybe a little higher here for the foreseeable future?
Look, I think for the balance of the year, our view was VIX averages 20 to 22 in the first half and kind of 16 to 18 in the second half, with that second half kind of having a little bit of event risk baked into it as well. But ultimately, what determines the VIX is how volatile the S&P 500 is. And, what we saw ahead of the FOMC is you had realized volatility on the S&P in the 5% to 10% range. So I don't think it's outside of the question that the VIX would get down to those teen levels. And we did see a print 15 a couple weeks ago. So I think the front can get down there. I think there's two questions. The one is how sustainable that is. And last week we saw that that calm can be sort of flirting with you, but then disappear. And the second is, again, how does the market think about the 3 to 6 month period? So I think, again, that 3 to 6 month period stays high, but I don't see any reason why the VIX can't be in the mid-teens again in the second half of the year. I think most investors would view that as a buy because of the amount of risk that's bouncing around. But I don't think it's outside the realm of possibility that we could get back down there.
There we had the opening bell on Wall Street as the market tries to claw back from really some heightened volatility like Stuart was just talking about after that Fed meeting last week. Stuart, you mentioned in your note that folks should start positioning for a move forward or move higher in large cap U.S. tech stocks. What's the trigger for that? Because I'm not hearing a lot of folks position for that trade right now.
Look, our view is essentially that once you got past all of this macro data, that being, the employment report, then the inflation data, and then the FOMC, the market would start to reorient itself to 2Q earnings. And we do think 2Q earnings are too low and need to be revised higher. And what we've seen the last 2 quarters is tech actually performs generally quite well during the heavy part of earnings because, frankly, those are the companies that are generating strong earnings. So I think there's 2 reasons to like tech here. One is the fundamental piece, which I just went into. And the second would just be that, tech doesn't like inflation very much, and I think that's one of the reasons it was under so much pressure, a couple months back. But tech actually deals with higher real yields a little bit better. And coming out of the FOMC, that's the mix we're seeing in the market, which is inflation expectations and break-evens lower, but interest rates higher. And that's actually a bit better for tech than it is for something like small cap. So, from my perspective, the fundamentals, I think, are going to help tech over the next, call it, 4 to 6 weeks. And I do think the macro setup is, if it's not favorable, it's less of a negative than it was a couple of weeks back.
And Stuart, another group that I know you've been watching the options activity on is energy. Obviously, we have seen underlying oil prices go up. We've seen energy stocks recover to some extent. And it looks like there's a lot of options linked interest in the group as well. So what happens next there?
Yeah, it's a good question. I think, energy, materials, and even financials to some degree, we had seen a massive uptick in the amount of options trading, and particularly to the upside. The last week or two, a lot of it has started to back off in terms of both energy and materials, and I think that's the whole inflation story. When inflation was rising, people wanted to own those commodity sectors. Now it seems like the Fed was paying a bit more attention to inflation than maybe we feared they were, and the options activity in energy and materials has come down pretty substantially, and what we're seeing is a little bit of a rotation into tech. So I think the question is going to be here is, we were priced very dovishly going into the Fed. We appear to now be priced quite hawkishly. Clearly the right outcome is somewhere in the middle. So will energy benefit from a rebalancing of those expectations? Potentially. I think right now, though, what we're seeing is people are readjusting their expectations, a little bit less excited about those quote unquote reflation sectors, and maybe focus a little more on tech at the moment.
Yeah, equilibrium is sometimes difficult to come by when it comes to equity markets. Thank you, Stuart. Appreciate it. Stuart Kaiser is UBS Head of Equity Derivatives Research. And let's take a look inside the Yahoo Finance Interactive now at what's going on for the major averages. Indeed, we see the expected bump up in the Dow that was indicated by the futures after that negative performance that we saw last week. The S&P 500 up by about 0.25%. And the Nasdaq, as we continue to watch tech, is actually still trending lower by about 0.2% here this morning. So not seeing a turnaround there in tech. The 10-year yield, since we've been talking so much about the Fed, it's worth checking on that, 1.48%. So still at relatively low levels here for that 10-year yield. Crude oil futures almost at $72 a barrel. Switch on over to the heat map here this morning and what we see moving there. We've got the banks. It looks like, is this the intraday look for the banks? No, it's not. We'll get back to those in a moment. Here we go. If we are looking at the banks, they are bouncing back. It looks like that was from last week. They're bouncing back after last week, seeing quite a lot of weakness on concerns about what was going to be happening with rates and the effect on that. We're going to be speaking to Mike Mayo about that in just a few moments. Stuart, just breaking down what's happening in tech here. And we are still seeing a lot of red on the screen when it comes to tech. That's reflected as well as by what we saw in the Nasdaq, of course, the fact that it is trading down. Meme stocks. Have we gotten to this point in the show and we haven't said the word meme stock? I don't know how that's possible, but it's true. AMC up almost 5% today. GameStop up about 1.4% as we watch what those have been doing. And let me click on into AMC for just a moment here. Here's the year-to-date chart. So it had a dip, but now has sort of come full circle and is back near the record levels there for what we're watching with AMC. And finally, sectors, as we were just talking about the sector rotation there a little bit with Stuart, we've got materials, energy and industrials and financials back in the driver's seat here today. So the rotation back into some of those value groups, and tech is trading lower. We're going to get more insight into all of this and other assets as well. Jared Blickery on the floor of the New York Stock Exchange. He'll be with us in a moment.
All right, welcome back to Yahoo Finance Live on this Monday morning. Stocks with a mixed open here, but the action this morning is really happening in the cryptocurrency space. Let's go to Jared Blickery live on the floor of the New York Stock Exchange to talk about what's happening in the crypto markets, Jared. And I mentioned it earlier in the program, the chart and the setup for Bitcoin certainly does not look any more constructive today than it has in the last few weeks.
Yeah, it's right. 1 week ago, we were talking about Bitcoin again, except it was the opposite situation. We had a nice rally underway. I said it was probably a sucker's rally, caught some flack on the Twitter for that. But I'll tell you what, we're back down to lows around 31,000. And let's pull up the Wi-Fi Interactive. This is a 3-month view. Let's go to a year to date so we can just kind of track the history here. When we got this break to the upside in April, that was a record high to 63,000. That was a momentum breakout at well. The fact that it failed was very telling, and it warned of lower prices. So when we were at the beginning of May, when we were at 57,000, I said we could be headed for a crypto winter this summer because it's winter in the southern hemisphere. And guess what? We started getting price confirmation of that. The good news, there's a little bit of good news, is that this last trip down was on lower momentum. So we could bounce, but the longer we spend down here, the more likely it is this level is going to break. That opens up 20,000.
Wow, not good news for the laser eyes folks out there, I suppose, or I don't know what is laser eyes just meme or is that crypto? I can't keep track of all the different memes that go with the different assets. In any case, Jared, save me here. What else are you watching here this morning? I've been watching oil prices continuing to push higher. I don't know what else stands out to you.
Yeah, I like the oil story because it kind of bucks the trend that we're seeing in commodities. But I want to go back to the indices because we're seeing a little bit of weakness here. And this is the one of the worst months of the year, seasonality speaking. And that's because we had options expiration last week. And just heading into the end of the month, we don't really have that many news catalysts. We're getting excited because we got a bunch of Fed speakers, but they're not even going to be meeting for another, 6 weeks. So let's see if I can pull up the Wi-Fi Interactive now. Looks like it's working. Okay, so here's the Nasdaq, still very close to record highs. S&P 500 still within about 1% of its record highs, and yet we have most of the internal components of the S&P 500 at 1-month lows. So we could be setting up for a sell-off here. I don't think it's going to be horrendous. It could be a one-off event. Nevertheless, we are seeing some weakness here, and given the seasonality and the lack of news into the end of the month, it just sets up the potential for something like that.
All right, Yahoo Finance, it's Jared Blickery live on the floor of the New York Stock Exchange with an update on markets as we get this trading week underway. All right, coming up on the other side of this break, we're going to talk more about what the Fed's announcements last week means for the lookout for financial stocks, especially as we're just a couple weeks out here from second quarter earnings season coming in. Mike Mayo is going to join us for a conversation on all that coming up right after this.
talking about the banks' negative performance last week. The large banks in particular really seeing a tumble. Some of them are coming back today, but still investors are watching Fed speak very closely. They're watching the yield curve, which has been flattening. And Mike Mayo has been watching all of this as well. He's Wells Fargo senior analyst. Our Brian Chung is back with us as well. So Mike, I know you're watching all of this stuff. How are you thinking about where the banks are positioned right now? It seems like sort of a delicate positioning in the eyes of investors.
Well, you have the Federal Reserve last week on monetary policy, and you have the Federal Reserve this week, Thursday night, you get the results of the annual Fed stress test. So we are wedged between two Fed very important moments. But last week, let's start with that, if that's okay with you, Julie.
Yeah, do it.
Okay. Well, last week, there were three key words in the Fed announcement. It was right up front in the 4-page release. And those three important words were inflation has risen. In fact, we've not heard inflation talked this much since really the 1970s. So I brought my 1970s bag for you here. And in my 1970s bag, I have leisure suits, I have mood rings, I even have a disco ball. But you know, the 70s, we don't want everything from the 70s. I don't think we want the pet rocks. I'm not sure if anybody remembers those. And we also don't want the bad inflation from the 1970s. And we also had bad inflation, not only 1974, but 1994. And that's when prices went up quickly. In 1994, the Fed was forced to raise rates very aggressively. You had unrealized and then realized securities losses, derivatives losses, mismatches between the bank's assets and liabilities. So too much change too quickly could be a very bad dose of inflation. But what I think I heard last week from the Fed is a good dose of inflation that's born out of recovery from the pandemic. And last year, the banks had the biggest decline in their net interest margin in a century. So to the extent that rates rise, we think that that can start to reverse for the banks. So you get the benefits from better yield curve. And so that's what the Fed said last week. And now Thursday night, what we expect after the Fed stress test is a green light for banks to return a lot more capital, both dividends and buybacks. And in fact, we think banks will be allowed to return twice as much capital this year as opposed to the prior year. And remember, banks acted as a source of strength during the pandemic. They suspended buybacks. That was one action they took. So extra capital became even more extra capital. So that should be a very good catalyst come Thursday night.
Mike, I can't tell if that's a leisure suit you're wearing. It's not blue, but I can't tell.
I might be wearing, maybe bell-bottom pants for the, they were in then too. So, you always have
keep the mystery alive. But I will note this: you have buy ratings or overweight ratings on Bank of America, Citigroup, JP Morgan, and Goldman Sachs. Which bank stock do you really, really like out of those four to just play based on what you're saying in terms of inflation in the Fed?
Well, we got more aggressive through the downturn last year, and we remain aggressive and positive on the banks. But, our top pick has been and remains Bank of America. We think there's both a cyclical and a structural story. Again, with the Fed announcement last week, if rates actually are going to go higher, when I say rates, the federal funds rate, if there's a greater chance that will increase sooner than expected, Bank of America benefits 3 times more than the average bank, $1.8 trillion of deposits. And these are sticky deposits. I mean, the average life of a relationship in retail banking at any large bank is 14 years. And people underestimate the benefits of a multi-distribution, multi-product, multi-geography business model like Bank of America. So these customers, they could have customers for life now, whereas when I started in this business, 3 decades ago, that was anywhere from the case. So Bank of America cyclically benefits, and structurally, not only do you have this kind of lifetime value of customers, but they are one of the best fintech companies on the planet. And their digital banking, it's not just about digital relationships. We all measure that. It's the degree of penetration with each digital relationship. So it's whether it's online bill pay or deposit capture or depositing a check, I mean, they have metrics that are like, 10 or a dozen different metrics, and they're going deeper and deeper. So Bank of America is our number one pick.
Mike, it's Brian Chung here. Now, the story for the banks, at least in the last few quarters, was that with the curve essentially flat with the rates on the short end back to near zero, you really got to rely on your trading desks. So fixed income and equities trading was the real cash cow for a lot of these banks that have big money center trading desks. So that story, though, might be going away with volatility kind of disappearing from the market, although who knows if that's going to be the case over the next few weeks. But fixed income trading, we're already seeing it fall at Citigroup, for example, as of the first quarter. What do you expect to see in the second quarter, and how might that hurt the bottom line?
Well, Brian, don't leave the play here. Broadway, I think, is opening in the fall, last I heard. And this is a 3-act play for the banks. And Act 1 was about the strong capital markets, especially fixed income. Corporations, front-loaded many of their financing needs, and that helped Wall Street. But the second act involves, benefits from loan growth, which is not here yet. It might not be here for 2 more quarters, but that's certainly coming. And Act 2, the capital return coming Thursday night, dividends and buybacks. So you have dividends, buybacks, loan growth in Act 2. And then Act 3, if you want to stay for the whole show, is that the industry is driving toward the best efficiency in history. Post-pandemic tech-induced efficiency is quite amazing. And you've seen tech solutions applied to other industries such as retail and healthcare, and it's coming to banks. And Plato had a lot to say about banking in the 21st century. I bet you didn't realize that, Brian. But what Plato said about banking in the 21st century is that necessity is the mother of invention. So banks have no choice but to become super efficient, and that will be Act 3 over the next several years.
Yeah, Mike, Brian was born in 1993, so he wasn't alive when Plato was just saying these amazing Instagram quote type things. But we, switching gears here, we did have, our staff has had a hearty debate on what Morgan Stanley CEO James Gorman said recently about returning to work. Basically, return to work, or you may not have a gig, or you may see your paycheck cut. What do you think about that stance by him and others on the stream? What is the outlook for banking jobs because of it?
Well, look, I mean, you have a culture which is born in person. And so it's the spontaneous conversation. It's the water cooler talk. It's your creativity. It's the informal, kind of conversations. That's what culture is made of. There's mentorship. And there's also, especially for new employees, but new customers. So customers, if Morgan Stanley's customers are seeing their clients face to face, I guarantee you that James Gorman is going to have their employees go see their customers too. And reminds me of this iconic 1990s commercial, airline commercial, where the manager said, "We just got fired by a client," and he handed everybody in the room airline tickets to go see their clients face to face. And I think post-pandemic, you're going to see an explosion, not only in visiting clients, but in entertainment, face to face. And look, Wall Street is a hyper-competitive world. James Gorman and Morgan Stanley, they're hyper-competitive. They want to win. So it's not surprising that you see Morgan Stanley, especially Goldman Sachs and JP Morgan, all saying, "Hey, let's get back to the office so we can best serve the customers and nurture this culture that we have." Having said that, I mean, there's likely to be some hybrid solutions if you're not customer facing. And also there's a war for talent. So it's not 100% forward. I mean, all the banks are trying to hire, tech experts. And in a competitive world, you have to consider, a work-life balance a little bit more. But as of right now, it's back to office for many Wall Street workers.
And Mike, finally, I want to ask you, as we talk about the sort of hybrid e-banking and living life in real life, you were talking earlier about Bank of America and its technological positioning. We talked to a lot of sort of fintech startups on the show, whether they be banks or offering other services. How far away do you think we are from them chipping away in a more real fashion on the commanding market share that the big banks have?
Well, I think you need to divide the answer into parts. And you have had fintech players chip away at banks. To some degree, banks were mass affluent, mass market, and several fintech players went a level below that to the unbanked or the the smaller customers where banks weren't paying as much attention. And that was a missed opportunity from banks. In addition, you've had fintech players obviously gain share in the payment space. On the other hand, when it comes to the primary deposit or checking account, you're not seeing fintech chip away when it comes to the largest banks. And I think the most underappreciated aspect is what I said before: a multi-distribution, product, and geographic approach creates very sticky relationships for the banks. And that's what's underappreciated at the largest banks and the banking industry, as opposed to other areas of finance.
Yeah, I have personally been with the same bank for a long time, and I'm sure a lot of other people are like that for inertia's sake, if no other reason. Thanks so much, Mike. Appreciate your time. It's always a pleasure to talk to you. Next time, party at Mike's house with the disco ball. We'll all pull out our bell bottoms. Oh, he's pulling it up again.
Party next time.
Thanks, Mike Mayo, Wells Fargo, and our Brian Chung as well. Coming up next, you see it there, GameStop, and that reminds us of all the retail investors out there. Goldman Sachs says their activity in the market is just beginning.
All right, welcome back to Yahoo Finance Live. Today's story is all about what's happening in the crypto markets, but of course this is a close cousin, Sazi, of what's been happening in the retail and the meme trade. And Goldman Sachs out with some research over the weekend showing just how much fun the retail trade continues to have. And of course, the massive performance we've seen in the AMC is really helping the whole basket of retail favored stocks.
Right, Miles, and if you believe what Goldman Sachs chief U.S. equity strategist David Kostin wrote over the weekend, really those bids and that volatility under an AMC, a BlackBerry, a GameStop, you name it, those popular meme stock trades, it may not be over this year by a long stretch. Kostin raising his estimate on household net equity buying to $400 billion this year from $350 billion. In the first quarter, Kostin notes households were the largest source of equity demand, with net purchases of stocks of $172 billion. So he sees that essentially accelerating, at least for the next 2 quarters. Also interesting to note here, he says households, based on his estimates, currently allocate 44% of their assets to equities. That's only slightly below the all-time high of 46%. When was that? Back at the dot-com heights in 2000, which is very interesting, perhaps telling and a bit worrying here. What ultimately Costin sees this buying activity or this appetite to buy more stocks boiling down to really continued low rates on money market and money market funds and low credit yields. Also, he believes a sustained increase in inflation could favor equities over bonds or cash. Certainly, it makes sense to me. But overall, my take is this. I'm not saying retail investors are not sophisticated. I think clearly we have learned this year that retail investors, this is a different breed. They have more tools at their disposal than ever before, and they do, in fact, know what they're doing. But those getting into the market right now will be entering a different market today compared to earlier this year. I think what the Fed announced last week, and we've seen the pickup in volatility as a result, really it makes a market a lot different. The Fed was pretty much hinting at low rates and more bond buying for the most part of this year. That dynamic has changed. And underneath the market surface, you're now seeing investors position a little more defensively. They're rotating at defensive type names. They're rotating a little more into big cap tech, which has defensive properties. So it's a different market. And if they don't pay attention, they could probably get clobbered.
Well, what is Costin's conclusion on all this, Brian? I mean, is he saying that the interest on the part of retail investors is going to help sustain a rally in stocks, or what is he recommending?
Does not make that conclusion in here. He ultimately expects more households to just come out there and continue buying the market because the market remains near at all-time highs. And it's not just households, and Costin has been writing about this extensively. He sees corporations continuing to buy back a good portion of their stock. So he does see 2 potential catalysts. He just doesn't come out definitively and say, hey, these are going to help power the market to a new record high by year end.
All right, interesting stuff there on the state of the retail rally and who owns the stock market. A good Yahoo U. I know we've been asking for the Yahoo U. If you look at the Z1 flow of funds, inside of the households group actually includes also pension funds, hedge funds, and other investment type vehicles. So you can back that out to some extent, but ultimately hedge funds tend to get lumped within that data. So just something to keep in mind there. All right, coming up on the other side of this break, a lot more coming up in the second hour of our program, including a conversation about the Fed's data or Fed's announcement from last week, the inflation outlook, and a lot more for the U.S. economy. Back with all that coming up right after this. All right, just after 10 o'clock on this Monday morning here, June 21st. Welcome to Yahoo Finance Live. I'm Miles Upton, joined as always by Julie Hyman and Brian Sazi on this longest day of the year. After this, the days get shorter until we get into the winter months. All right, let's take a look at the stock market here. On this Monday, we see all three majors are higher. The Dow is up about 1.2%, leading the proceedings. S&P 500 we see trading right around 4,200. Nasdaq above 14,000 this morning as we continue to see markets try to shake off some of that rocky trading that we saw last week. Well, labor shortages are hitting the skies. American Airlines canceling hundreds of flights as the airline admits they do not have the staff to keep up with consumer demand. We're going to talk with industry expert Helene Becker about everything facing the airline sector coming up later on this hour. Plus, a lot to talk about in the world of sports. Tokyo 2021, technically Tokyo 2020 Olympics happening in 2021. They're going to allow fans, despite COVID-19 concerns continuing over there in Tokyo. And meanwhile, we're going to do some NBA. Eastern and Western Conference Finals are set. Western Conference Finals got started last night. And who would have thought that one of the Hawks, Bucks, Clippers, and Suns going to win the NBA title this year? Vincent Goodwill of Yahoo Sports are going to stop by later on this hour to indulge me in a little bit of sports talk here to get the week started.
But we start, as we frequently do at this time, with the morning brief. And just like us, corporate executives, they're just like us, I guess is the way we could say it. They're talking a lot about inflation, just like we're talking a lot about inflation, just like economists are talking a lot about inflation, just like real people who are paying higher prices are talking a lot about inflation. But the way that it's percolating through the market is quite different than perhaps individual consternation at paying higher prices. Miles, you looked at the sort of data that we're getting on individual mentions among corporate executives and then how that is playing out.
Yeah, so during first quarter earnings calls, this according to FactSet, we had 197 mentions of inflation from companies in the S&P 500. That is a record, and it rose at the fastest pace. It was that number of mentions, that 197, was up 138 from the prior quarter. So those were the calls covering the fourth quarter of 2020. That was also the largest increase on record. And no sector talked about inflation more than consumer staples. So the chart we see here are which factors consumer staples management cited as giving them inflationary or higher cost pressures, higher costs generated by category X. So 15 of the 26 consumer staples companies that talked about inflation mentioned higher freight prices as an impact. Higher ag was mentioned by 10 of those 26. And then, of course, labor costs were mentioned by 6 of those 26 names. All told, some 84% of companies that make up the consumer staples sector mentioned inflation on their call in some form or fashion. Now, the upshot here, as FactSet found, is that earnings estimates and also margin estimates, importantly, for the sector did increase during first quarter earnings season. They increased just a little bit, not a dramatic change. Margin estimates only went up to 6.8% from 6.7% prior to this earnings period. But ultimately, what we've seen in this data so far is that while inflation is a top of mind concern, inflation is something that is impacting how companies are thinking about their operations. They are mostly raising prices in response to that, and Wall Street analysts, in turn, are not downgrading their earnings expectations for these businesses. Now, over the longest of long runs, the only thing that matters for stock prices is how much companies are earning. An interesting dynamic in today's market is that investors are actually willing to pay less for those earnings. The multiple on the market has come down a little bit. I think that has to do with maybe the anticipation of higher rates and competition for equities versus fixed income, so on and so forth. We'll leave that for another time. But Sazi, I think it is instructive, again, to just take note at this point in the proceedings that expectations from analysts on how much companies can make this year have not come down because costs have gone up.
No, it's a very, very important point you mentioned, Miles, on estimates. And what I did find interesting, we just had Stuart Kaiser on from UBS, and he slipped in a line that he thinks estimates for the second quarter are too low. So if companies came out and raised prices aggressively, even despite inflation, we might be looking at a pretty surprising first quarter in terms of earnings beats that might resemble what we saw in the first quarter.
Yeah, I wanted to pull it up here because but I don't have it right on me. But UBS, I believe, had $231 for their expectations for earnings. That might have been next year, but they were pretty aggressive. Keith Parker and the equity strategy team at UBS has been pretty aggressive in what they expect S&P 500 companies to earn. Morgan Stanley, they kind of did it a different way. Mike Wilson combined it like second half of this year, first half of next year. He was in the mid 210s, maybe around $220. But Sazi, you slap a multiple of 19 on that, 20 on that, 22 on that. Now we're starting to look at the S&P at 20 times $200 of earnings is overvalued relative today. At 20 times $220 of earnings, that basically gets us to today's market. And then you throw that on, let's say $230 of earnings. Now you're looking at, S&P 46, S&P 4800, maybe S&P 5000. And so it all comes together in this weird soup of valuations just are not expanding right now. The multiple's not expanding on the market. And, to Stuart's point, Sazi, it feels like what we're getting is more revisions up in earnings estimates, but no one is getting more excited about it. And I think it's just a belief that rates have to go up if this inflation is not going to be transitory. And it really sets up for a fascinating battle, I think, for the markets later on this year and into next year. Just a completely different setup as we come out of recession than what we saw a decade ago. All right, well, let's stay on these inflation conversations. Is it transitory? Is it not? How to think about the Fed's announcement from last week. Let's bring in Joe Song. He's a senior U.S. economist over at Bank of America. Joe, always great to talk to you. So let's start with how you guys are interpreting what we saw from the Fed last week. And I'll ask it this way. Do you believe the Fed was passing judgment on whether inflation is indeed transitory or not? Because market participants want this to say, no, the Fed is admitting it's not transitory. How did you guys kind of see the data we got from them last week?
Yeah, thanks for having me, Miles. So I think the Fed is still suggesting that the data that they have on hand is transitory. Obviously the risks have risen, that there could be a little more persistence in the rise in prices. But we have to remember why all these price increases are happening. As you mentioned at the top, you are seeing immense demand in the economy. And we're going from an economy that was on the cooler, right? We had shut it down completely and we're starting to come back. The reopening is basically going from 0 to 100 in a very quick time. And that's leading to shortages and bottlenecks within the economy, especially in the labor market right now. So all of those supply side issues will work itself out, and that would mean that prices should ultimately slow down and start to stabilize a bit, which means inflation will also stabilize and maybe even show some deflationary pressure early next year, and that will mean that inflation will ultimately prove transitory.
Joe, I like that new B of A transitory meter, very eye friendly. What are some of the inputs in that?
Yeah, I mean, it takes a whole slew of inflationary measures that we track. Obviously the prime CPI, PC numbers, but also a lot of the regional Feds measures as well, where they look at transitory factors, as they suss it out. The trim mean measures, things of that nature. And we're just trying to aggregate it all up and kind of give you a framework into looking at what we're seeing right now. And what we're seeing right now is that all these measures are suggesting that a lot of the inflation that we're seeing will ultimately prove to be transitory.
Hey, Joe, where does labor inflation fit into this equation, and what are the latest data points? I mean, you guys at Bank of America are also well known for pulling in sort of interesting alternative data points. I'm wondering what you're seeing on the jobs front from the other unconventional tea leaves that you're reading.
Yeah, we are starting to see wage inflation build up, across the different sectors. One interesting kind of alternative data we've looked at is from Revelio Labs. They have job posting data, and they actually post the entry level salaries that go with the job posting. And we've seen a pickup at the median wages have picked up in recent months, which suggests that labor demand is hot right now. And then you obviously see the traditional measures as well: average hourly earnings, employment cost index. They've all shown decent strength over the last months and last quarter, and that suggests there is a supply demand imbalance right now in the labor markets, and that just means that for the markets to clear, wages have to rise, and that's what we're seeing today.
Joe, I caught up with my dad on Father's Day, and he told me his car, his '04 Corvette, has been in the shop literally since February because he can't get parts. And folks are telling him they just can't get the parts delivered to them. They don't have the workers. How long do you think supply constraints like that will continue? Help my dad out here.
It's hard to say for your dad exactly, but I think broadly speaking, we think that by the fall, a lot of these, supply constraints will work itself out. Remember, there's, a decent amount of headwind for the labor market. Right? You have a lot of workers still on the sidelines, still concerned about COVID. Maybe they haven't been vaccinated yet. You also have childcare issues, for a lot of families as well. And then there's also some disincentives from generous unemployment insurance benefits. Now, we'll get a natural experiment over the next few weeks as some states have decided to discontinue those benefits. So we'll see if there is a meaningful labor supply response. But by the fall, we know that the entire federal program will go away. And, that we think that will ultimately push, some of the workers back into the labor market. And that should help ease some of these constraints that we're seeing today.
Joe, I think it's helpful that we've been discussing the pressures that are happening today and how they may resolve over the next 6 months. But what the market was really focused on last Wednesday is how the Fed saw 24 months from now, second half of 2023, potentially a couple of rate hikes. You guys are expecting there to be 2 rate hikes in the second half of 23. What kind of conditions do you think the Fed will be reacting to at that time? Will it be full employment? Will it be inflation that remains high? What will the potentially Powell Fed, but maybe someone else leading the Fed then, what will they be reacting to when they decide to go ahead and initiate another rate hike cycle?
Yeah, I think it'll be a combination of those two, right? Maximum employment and sustained inflationary pressure. Remember, they went to this more easy policy regime of flexible average inflation targeting, and they want to sustain inflationary pressure above 2%. Now we're going to get a lot more than that this year because of these transitory factors. But as the new economic forecast showed from the Fed, they're looking for 2.1% next year and the year before. That would argue that flexible average inflation targeting is working, and you're seeing above trend inflation. On top of that, they'll obviously be looking for meaningful progress in the labor market as well, right? The unemployment is still at elevated levels. We still don't, we're nowhere near back to pre-pandemic levels on the level of employment. They'll want to see those levels also get back to pre-pandemic conditions before they start to consider liftoff.
All right, Joe Song with Bank of America, senior U.S. economist over there. Joe, appreciate you stopping by on this Monday morning. I know we'll be in touch.
Thank you.
All right, coming up on the other side of this break news on a Sunday afternoon from Bill Ackman and his latest SPACs deal. We're going to talk about that and a lot more coming up in Down to Business on the other side of this break.
at some other business headlines that we are watching, billionaire investor Bill Ackman buying a 10% stake in Universal Music Group ahead of its planned spinoff from Vivendi later this year. This confirms reports from a few weeks ago. The deal, signed by Ackman's SPAC, Pershing Square Tontine Holdings, for about $4 billion, values the entire label, which counts Taylor Swift among its artists, at almost $42 billion, including debt. Vivendi shareholders are set to vote tomorrow on the spinoff, which is planned to be completed in late September. A former Tesla insider is cashing out. Jerome Guillen, who served as Tesla's president before leaving on June 3rd, sold an estimated $274 million worth of Tesla shares. A filing with the Securities and Exchange Commission revealed that Guillen exercised stock options on more than 450,000 shares between June 10th and June 14th. Salad chain Sweetgreen has confidentially filed for an IPO. That's according to a report from Axios this morning. The company is going to look to list in the fall. It's not disclosed how much it plans to raise. It had that $100 million placeholder in the filing. Sweetgreen has raised around $670 million in venture capital funding so far. That values it at around $1.8 billion on the private market. And the Tokyo Olympics plans to have live spectators. Organizing committee officials and the International Olympic Committee announced that local fans will be allowed to attend with a 50% capacity limit and a maximum of 10,000 attendees. Japan's top medical official last week recommended the games be held without in-person viewers. The games are set to open July 23rd. So Miles, even though this is the decision for now, it could change. There's still some suspense over what the games are going to look like.
Yeah, I mean, incredibly, games are now, 33 days away, just flying up at us. And of course, I know so many viewers paying close attention to the track and field trials held over the weekend. Men's 100 last night, one of 3 races in history where 3 men went under 9.9 seconds, all in the same heat. So again, trials continue tonight. Men's 800 final, women's 1500 final, women's 5K final. Great night of racing, and then they'll be off for a couple of days. All right, let's take a look inside the Wi-Fi interactive touchscreen here for a look at what's moving on the market. And we're going to start with what's happening in the coin space, specifically with Coinbase. We see the stock here since it has gone public, since it went public via that direct listing back in the spring. And it is starting to look like Coinbase came public right at the top for Bitcoin, at least, and the crypto market in general. Stock has kind of gone straight down since its debut, off 33%, $220 per share. We see the stock trading out. Was it 234, 243? One of those was the private market reference price. Maybe it was higher than that we saw before it came public, or where shares of Coinbase traded in the secondary market, because there is some secondary liquidity even for private companies. But again, the stock is certainly below those levels here as it continues to come under pressure. Taking a look at MicroStrategy as well, the stock is still up 50% year to date, as it has really become a leveraged bet on Bitcoin. The company announced this morning that they acquired additional Bitcoin. They now hold over 105,000 Bitcoin, so more than $2.5 billion, right around $2.5 billion worth of Bitcoin holdings within MicroStrategy, which does have a business intelligence core business that has about $1 billion in annual revenue, is not growing at 70 or 80%, but is a good, solid BI business. And then they've tacked on a couple $1 billion worth of Bitcoin. Company's market cap around $6 billion. So an interesting story to see how MicroStrategy handles its balance sheet here going forward. Let's take a look at Ethereum. Ether back under $2,000. That was really the psychological break lower that got people excited a couple months ago when we saw it. But then we had this bounce across the crypto space. Jared Blickery told us earlier in today's program that he thought that rally across the crypto space was kind of a sucker's rally. And it seems we have gotten more selling pressure into that. Ether under pressure, Bitcoin, the big guy, is under pressure as well. Take a look at Bitcoin over the last year. Obviously has continued to do well, but this chart just not super constructive any different way you want to look at the technical picture over the last several months. You've got kind of that really, you could do this as a triple top. You could do this as a head and shoulders on the March to May period. Right now, we do have a pretty clear triple top in play. You could look at this as a longer term head and shoulders from January the head in the spring, now the right shoulder. None of those patterns are patterns that bulls like to hear about. So again, a very discouraging chart longer term for Bitcoin right now. But as with Tesla, as with most of these coins, if you bought it 3 years ago, you don't really care. You've made a ton of money, but something to watch as, again, this really became a cultural meme over the last several months. All right, let's take a break here. On the other side, we're going to talk a bit more about the news out of American Airlines, the company canceling some flights on labor availability. We'll talk about the state of the airline industry as we get into the busy summer months. Coming up with more on that right after this. All right, welcome back to Yahoo Finance Live on this Monday morning. Well, the summer travel season is getting underway, and people are certainly taking to the friendly skies. For the second straight Sunday, we saw TSA passenger throughput top 2 million as the recovery in air travel continues. And then a story over the weekend, American Airlines confirming that it canceled some 450 flights and is expecting to cancel an additional 120 flights due to crew availability. Joining us now to talk about the state of the airline recovery is Helene Becker, senior analyst with Cowen. Helene, great to speak with you once again. So let's start with this news from American. It sounds to me like we're getting to the good problems to have phase here when there's not enough crew to fill out the planes that passengers are demanding right now.
Yes, well, thank you for having me again on your show. I really appreciate the time. Yes, and it is a sort of good problem to have. I think one of the things to think about is, remember, there are still fairly restrictive rules. There's what I call the 16-13 10-hour rule, which basically says pilots can work 16 hours during the day, 13 hours overnight, and need 10 hours of rest between shifts. So when you throw weather into that equation, you wind up having crew members who run out of time. And because of the pandemic, a lot of pilots that may not have retired until 2021 or 2022 or 3 accelerated their retirement until last year. So you do have some staffing shortages. It takes about a year to bring a pilot up from a furlough and get him or her ready to fly again. So there's that to think about. And then, of course, flight attendants, mechanics, airport personnel, you just need everybody back to work. And that's just taking a while to happen, to get everybody back, because I'm not sure the airline should be so surprised at this strength. I mean, maybe it's a week or two sooner than we thought. We thought we'd regularly see 2 million people a day travel beginning around late June, early July through the summer months. We're not really that far off of where we were in 2019. Where we were off is in international and corporate business travel, but international is starting to come back. So the airlines really have to think about staffing up again.
But Helene, it seems like that this issue, from what you're saying, is going to persist for a little bit, right? And that maybe travelers should be expecting these kinds of potential schedule changes and delays because of staffing shortages, because not only does it take time to, get people back into the workforce if they've been furloughed, in other industries, we talk about upskilling and retraining. Like, you can't train a pilot very quickly if they are new to the business. So it seems like there are some obstacles here.
Yes, well, there are capacity constraints for sure. You hit the nail on the head with that. Number one. Number two, I think in terms of demand, it should be very strong actually through the summer. We're really thinking that we're going to have a great summer. And then for supply, which is seats available, last year, you may remember, airlines accelerated retirement of a lot of aircraft. From 2000, around, let's say, 13, 14 to 2019, the airlines really didn't retire that many aircraft because demand was so strong. Normally, they would retire about 4% of the fleet a year. So now you head into 2020, and the industry took that, especially American, they took that opportunity to accelerate retirement of a lot of aircraft that they may have decided doesn't fit the profile anymore. They had announced roughly 156 aircraft being retired in 2020. Those are not coming back, and they're done for the most part with their fleet replacement program, and they're getting 787s here and there. But in general, they just have a lack of capacity to hit the amount of demand they have, which is a good problem because we're seeing very strong airfares, which of course people are starting to complain about, that airfares are too high. But that'll sort itself out because airlines are notorious for adding capacity when airfares get really high.
And so again, just to sort of put a fine point on this, what should travelers expect for the summer months, for example, both in terms of scheduling delays and airfares?
Okay. So first of all, patience. Not that I'm a patient person, I'm for sure not. I think at the airport, we have to be patient because getting through TSA, remember earlier this year, you and I talked about the fact that TSA was hiring 6,000 more people for the summer months to speed travelers through the airport. So there's that to think about. They were not 100% successful. So that's one thing. Then the other thing travelers can expect is weather in the summer. I always felt summer weather is worse than winter weather because when the snowstorm is coming, and you can prepare by changing the day of your flight or whatever. But pop-up thunderstorms wreak havoc with the industry, and you don't know when they're coming. And that's really what is going to cause a lot of delays this summer. So I think passengers have to bring their patience with them to the airport. They have to be prepared on hot summer afternoons to be delayed, and think about connections and building in some extra connect time between when they get to a hub airport and when their next flight is leaving. I wouldn't necessarily do a short, 60-minute connection. I might think about doing a 2-hour connection, even though you don't want to hang around the airport necessarily. You might want to do that because if you miss your connection and seats are are full and demand is so strong, it may be a little while before you can get out again. So that's how I would be thinking about it if I were a passenger right now.
Elaine, speaking of passengers, passengers have gotten a lot heavier over the year plus of the pandemic. How costly will that prove to the airlines? Will the airlines have to use more fuel? Will they have to redesign their seats, redesign their cabins? How do you see it?
Yeah, that's a funny question. But it's true. People over the years, not only last year, but people over the years have been getting heavier. And so the airlines have to rethink their weight and balance. I'm not sure 100% how that's going to work. I think there's maybe some cargo that might not make it on the aircraft while they think about, those passengers. I don't think people are going to be weighed at the gate. I know that was talked about a few weeks ago, but I can't imagine that they're going to do that. It just might be yet another question that you have to answer when you fill out your form and that when you log in to get your boarding pass. How much do you weigh? And then will people be honest about it? That's the other question. I know I'm laughing because I find the whole thing amusing, but to your point, airlines have to recalibrate the weight and balance. They have to think about how much more fuel they have to load on board to handle it, and then maybe a little less cargo to offset it.
Well, Helene, I think everyone out there knows the feeling when the captain stands in front of everybody and says, "We're overweight. We need 3 people to take the next flight," which I've seen happen over the Christmas holiday. And boy, you want to hear some silence, you can go for that one. All right, Helene Becker, senior analyst over at Cowen, covering the airline and transportation industry. Helene, I always appreciate the time. Thanks so much for jumping on this morning.
Thanks very much for having me.
All right, coming up on the other side of this break, continued takeover efforts in the UK of Morrison supermarkets. We'll get the latest on that story coming up right after this.
Well, it's not just consumers having to pay up for items at the grocery store. It looks like a buyer might have to pay up for buying the grocery store itself. We're talking about the UK supermarket chain Morrison's, and our Latoya Harding has more on that story for us from the UK. Latoya.
Yeah, that's right. Over the weekend, supermarket chain Morrison's received a preliminary takeover bid from US private equity firm Clayton, Dubilier and Rice, and that was for £5.5 billion. But Morrison's, which is the UK's fourth largest supermarket, rejected the bid of 230 pence per share, which was a 29% premium on Friday's closing price. Morrison said that it significantly undervalued the firm, although the deal included Morrison's £3.2 billion of debt, taking the total value of the deal to almost £9 billion. Now, in London today, the stock did surge more than 30% on the back of the news. And that was, of course, amid speculation that CD&R would push ahead with another offer and that other bidders may also step in, including American private equity firms Lone Star and Apollo Global Management. And these two also expressed interest in buying supermarket rival Asda earlier in the year. We've also had speculation that Amazon is a potential buyer of Morrison's too. Now, Morrison's is a key supplier and partner with Amazon and has been since 2016. So Morrison's currently sells ranges via Amazon Prime and Amazon's bricks and mortar store as well in London. Now, the grocer has around about 500 stores in the UK, but digital sales were up 113% in its last quarter. So it's been eyed up for a takeover as its online business, again, smaller than its rivals, but it's leaving a lot of room for growth. So a lot of potential there, which is part of the reason of why, again, these companies are seeking out Morrison's in particular. Now, CD&R has up until the 17th of July to make a firm offer or walk away from any deal. And just on the back of the news, just with other shares in London, we've seen a lot of supermarket chains popping higher on the back of that news. So as we said, Morrison's itself up over 30% on the day, but Sainsbury's, Marks and Spencer's, Tesco also all rallying on the day, and even online supermarket rival Ocado, again, also soaring higher on the day on the back of that news.
Interesting stuff. We'll keep our eyes peeled for that potentially higher and firmer bid. Latoya, thanks so much. Appreciate it. When we come back, a lot of NBA action over the weekend. We will get the latest with Yahoo Sports next.
All right, welcome back to Yahoo Finance Live. A lot going on in the markets. We've got inflation, we've got crypto crashing, but it has been a crazy couple of weeks in the world of sports. We've got a cheating scandal in the MLB. You got the U.S. Open, men's golf concluded over the weekend. You got the U.S. Swimming and track and field trials, but the real star has been the wild NBA playoffs, which are now continuing to inch toward their conclusion. Western Conference Finals started last night. Suns taking Game 1 over the Clippers. And then the Game 7 meltdown that was in Philadelphia, the Sixers getting bounced by the Atlanta Hawks. Yahoo Finance senior NBA writer, or Yahoo Sports senior NBA writer, Vincent Goodwill, joins us now to discuss. Vince, thanks for jumping on. So let's start in Philly last night. You have a column out that Ben Simmons is done with the Sixers, in your view. I mean, what happened last night? Because that was just a bizarre meltdown, I thought, from the Sixers.
It was a microcosm of everything that we believed that was wrong with that team, as far as not being able to have your second best player be on the floor and be assertive in moments. Just a basic tenet of basketball is being able to shoot, being willing to shoot. And Ben Simmons, as great of a talent as he is, does not possess that. And it's been 4 years for him in this sort of rebuild process for the 76ers. And they've been championship contenders in 3 of those seasons. And you can honestly say that because of this big wart that Ben Simmons has, it's prevented them from going to the next level. It prevented them from beating a team in Atlanta last night that they're better than. You had a Game 7 on your home floor. You had a Game 5 on your home floor that you blew as well, because the Atlanta Hawks said, we're going to foul you when we're down 20, and you're not going to make your free throws. And that's exactly what happened. So at this point, I don't see how the 76ers can go forward with Ben Simmons, knowing his warts, knowing his deficiencies, and not being able to trust him in the offseason to be able to justify paying him another $140 million over the next 4 years or so.
And I know it becomes the most tired conversation in the NBA because Sam Hinkie doesn't even work in the NBA anymore, but we're still talking about the process. This was the outcome of the process. Is it time to stop waiting for the process to play out in a year where Durant gets bounced by someone else, LeBron is out in the first round? I mean, it couldn't have been, at least, in my view, set up better for the Sixers, and it feels like this has to be the end of that experiment.
Well, I mean, the process ended a long time ago. Let's be perfectly honest. Sam Hinkie left the 76ers in 2016. They've had multiple general managers since then. They're on their second head coach since then. I think it's just a cute name to basically brand them because they got Joel Embiid. They got Ben Simmons through tanking for multiple years. But like you said, the league changes every couple of years. It changes very quickly now. Before, maybe it changed every 4 or 5 years. Now it changes every 2. With free agency and trade demands, you can reset and rebuild your team very quickly. You can see Kevin Durant go from one team to the next. Kevin Durant's gone to 2 different teams since the process basically ended. LeBron James has changed teams. James Harden. Every big name that you can name, that you can think of, with the exception of a guy like Steph Curry, has changed addresses over the past 5 years. So you can no longer hold yourself to the old paradigm of, well, everything's going to change in 4 to 5 years. You have to treat this like it's a year-to-year thing, almost kind of like the NFL. It just looks different and it doesn't feel as good.
So we saw on Saturday, Durant basically on his own cannot overcome the Bucks. And it made me think of what we heard from LeBron James last week and his very forceful comments that the NBA created this situation where you had multiple stars getting injured. You really had, I think what LeBron was saying, kind of a watered down product. What have you heard from league sources? What's been the aftershock, I guess, of LeBron's very public comments, essentially slamming Adam Silver and the commissioner's office for, starting this season, 6 weeks, 8 weeks after last year and the bubble was wrapped up?
Well, if you've followed LeBron James since this whole thing has started, he hasn't been a fan of anything that the league has done. He didn't talk about being vaccinated, even though he brands himself as a leader, and his words could very well tilt the scales from the public standpoint when the NBA wanted him to come out and speak out. The NBA wanted him to endorse the All-Star game that they had in Atlanta a couple months ago. Clearly, all of this was a money grab to get the league out of the debt that it's been in. This has been a pandemic. There's nobody to blame. It's no one's fault. And the players still want to get paid. Like, the players have been receiving their paychecks from the moment that the league shut down over a year and a half ago, and they haven't felt that pain. The owners have, and I am as pro player as anybody, but you also have to understand just the optics of it is that you can't say, hey, we want all of our paychecks. We want to get paid 100% of our salary, but we don't want to play the 72 games, which is uncomfortable because nobody wanted to play 72 games. Nobody wanted to see that. You knew it was going to be a product that did not look as good as you wanted it to, but 72 games was the mark for the national TV deals to kick in, the regional TV deals to kick in. That was the magic number. That was the number that the league had to come to for all of that money to come in. The league is still in debt. And if you're LeBron James, you have to understand the economics, not just for your future, because you only have a few years left, but for the future of the league, for the younger players who are going to want to make the same type of money to be able to take advantage of the economics, the growth, and the popularity of the league. So it's an unfortunate situation, and nobody's there to blame except LeBron wants to point the finger at somebody because he just has to.
And Vince, before we let you go, we are going to get a glow up from some major star in the next couple of weeks. Maybe it's Devin Booker, Trae Young, Giannis. How do you see it playing out? Who do you think will win the NBA title, given what we know today?
You have a lot of teams. Every team that's left doesn't have a tradition of winning. So I would say, there's no history that we can go on and say, well, they're following in these footsteps. But I will say the Milwaukee Bucks, just given by health and having a star in Giannis, even though Giannis Antetokounmpo has a lot of flaws, he overcame Kevin Durant this weekend. He overcame that big shot that he took. And Giannis is a two-time MVP. He has the healthiest roster, the fullest roster, and they've endured enough heartbreak that I think we're going to know him as something more than the novel Greek Nigerian basketball player. I think we're going to see him being crowned as a champion over the next couple of weeks. And please, let's not put an asterisk by it.
I was going to say, talk about someone who has had a good last week in terms of where his narrative has gone after what happened in Game 5. All right, senior NBA writer Vincent Goodwill with Yahoo Sports. Vince, really appreciate the time this morning, and hopefully we'll stay in touch as the playoffs progress. All right, coming up on the other side of this break, we'll get an update on the situation that never ends over at Lordstown. Stock off 6% this morning. Sazi has the latest after this.
Tucson Motors back in the news today, and the shares are back in the red. They're down between 5 and 6% at the moment. And Brian Sozzi, you have been digging into this company. You've been also emailing a bit with them after some reports about what executives were doing with shares before some recent announcements.
Yeah, this is a really good story by the Wall Street Journal this morning. And in that story, they're noting that the company's top 5 executives, including current president Rich Schmidt and the company's former CFO, sold more than $8 million in stock over 3 days in February. Now, what happened in mid-March? The company came out with a whopping loss, more than double analyst estimates, and the stock has been essentially in free fall ever since. You've had complete management turnover. It's been really an absolute disaster. Interesting to note, inside this Wall Street Journal story, this definitely gets my OMG award for this week. I mean, it's just absolutely ridiculous. It says, according to the Journal, President Rich Schmidt sold his stock in the company during that period to go out, not launch, but expand a turkey hunting farm in Tennessee. That is correct. He's expanding a turkey hunting farm in Tennessee, while essentially the company that is in fact paying for his endeavors to launch or expand that turkey farming venture in Tennessee is completely going up in smoke. Now, I exchanged an email with a company spokesman at Lordstown this morning. He refuses to admit that Schmidt is expanding into a turkey hunting venture in Tennessee. Not too sure what's going on there. It's embarrassing. It's the absolute, really indications of incompetence at the highest level in corporate America. This is absurd.
Are the trucks that they drive around the turkey hunting property electric? Would be. Can't
confirm that either, but I can't confirm if these are organic turkeys. But clearly, Rich Schmidt has an affinity to go out there and hunt turkeys while his company's blowing up. I'd be surprised if this guy survives the rest of this month at the company.
Hunting turkeys, indeed. That's what we do here at Yahoo Finance. All right, we're going to take a break, and that does it for me, Miles and Brian today. We'll be back at 9 a.m. tomorrow, but keep it right here on Yahoo Finance as stocks hover at their highs of the session.
Welcome to Yahoo Finance Live and happy Monday. I'm Akiko Fujita along with Zach Guzman, and we are seeing a Wall Street rebound so far in this session here. Stocks recovering some of the losses from last week. The Dow right now up more than 500 points. The Nasdaq up 84 and the S&P 500 up 50. Bitcoin falling to a 2-week low here as the crackdown intensifies in China. We're also seeing a number of stocks there being dragged down alongside it. MicroStrategy and Coinbase there seeing steep losses so far in the session. Amazon kicks off its biggest shopping event. It's the last Prime Day under Jeff Bezos. Rival retailers, though, offering up their own discounts to compete with the e-commerce giant. And a record number of small businesses struggling to fill jobs. We are talking to two business owners this hour who found success in a challenging environment, why they say good pay, benefits, and flexibility are key. We're going to begin this hour, though, with that sell-off in Bitcoin. And Zach, a number of headlines we've been tracking over in China. Let's start with what we heard from the PBOC, the central bank over in China, summoning the biggest banks in China, as well as payment services like Alipay, to remind them of the rules that ban Chinese banks from engaging in crypto-related transactions. The rules per se, certainly not anything new, but it does feel like the PBOC is getting a bit more specific here in what they are calling on these banks to do. Number one, calling on financial institutions to comprehensively investigate which regulators are looking to crack down on crypto, or which accounts are active in crypto trading. We've also heard the PBOC in their statement say they're strictly implementing these regulatory requirements, including notifying users of the risks related to Bitcoin. And we've seen those like Alipay, as well as other big banks, saying that they're going to be telling their customers they risk having their accounts restricted if, in fact, they are involved in the trading. And then, of course, Zach, the other headline I know you've been tracking closely is the shutdown of crypto miners over in the Sichuan province, which is one of the biggest areas for mining.
Yeah, and that's a pretty impressive move too, Akiko, because we've been debating before. I mean, we saw the mining crackdown in Inner Mongolia, and that kind of was defended by a lot of Bitcoin advocates, saying that it was a net positive because you had Elon Musk coming out against the sustainability piece of Bitcoin, and Inner Mongolia was mainly coal-powered, right? And Sichuan is mainly hydro-powered, so that was seen as a net positive in the long run here because they'd be going to cleaner energy types. But when you crack down on Sichuan, that kind of goes against the narrative of this just being a sustainability piece into what's going on in China. So this gives more power to the idea that it is kind of a crackdown on cryptos writ large there in that country, but still points to the benefit of other sustainable miners elsewhere around the world. We're already seeing video there in China appearing on social media sites of miners packing their rigs up, potentially shipping them to more sustainable miners over here in the US and around the world. And that was a topic that I asked Bitfarms about at Bitcoin 2021 in Miami just a few weeks ago, because that's one of the largest sustainable miners in North America. They control about 1% of the hash rate of the Bitcoin network. I asked the CEO of Bitfarms, Emiliano Grodzki, about how that might be a positive when we saw the initial Bitcoin mining crackdown in China. Now we have the second wave in Sichuan. Here's what he told me about that being a benefit for his company.
Well, for us it's a benefit because they are unplugging machines from the network, say that the hash rate is lower. The last 14 days, the last adjustment, the difficulty reduced it by 15%, say that we earn on daily basis more 15% more BTC that we adding in our balance sheet, right?
So Kiko, I mean, for a company like his, which actually interestingly just uplisted to the Nasdaq or is planned to uplist to the Nasdaq today, ticker BITF. It's interesting because you got this potentially being a positive for them, because each time you have miners coming off the network that drops, this is how Bitcoin's structured, it drops the computing power that's needed there to kind of solve some of these complex math equations to win the reward when it comes to mining. So, I mean, it could be a net positive. You still have people who are long-term holders here saying that this will be a net positive if you have some of the concentration we've talked about, roughly about 60% or more concentrated in China. A good thing for decentralization when you think about the network and miners moving out across the globe, potentially shifting to more sustainable power sources. So that's still intact. Might lead to some short-term chop, which we're seeing play out today. Of course, never good if it's in the downward direction for Bitcoin holders, but we'll see if it's true that in the long run, it does help the network overall.
Yeah, no question. We're going to see a knock-on impact outside of China. Some interesting numbers, though, here, Zach. The Global Times, which is a state-run paper, reporting that the ban over in Sichuan province now means that more than 90% of China's Bitcoin mining capacity has effectively been shut down. And you've got local regulators that have put some of these mining operations on notice as well. They've listed 26 firms that have been inspected. They've also ordered local electricity companies to immediately stop providing power to these crypto mining projects. So again, the crackdown itself, not necessarily new, but you could see sort of the increased intensity with which regulators are trying to close all the loopholes to show that they really are serious about this crackdown. So something, to your point, really interesting, going to be interesting to watch. What's happening over in China, but also to see the impact over here. Well, Big Short investor Michael Berry warned of the losses that are likely to stem from crypto and meme stock trading, tweeting this out last week, saying, all hype speculation is doing is drawing in retail before the mother of all crashes. When crypto falls from trillions or meme stocks fall from tens of billions, Main Street losses will approach the size of countries. Now, that tweet has since been deleted, but our next guest says there are 10 common threads that are driving the action in both crypto and meme stocks. Let's bring in our guest, Sneha Jose, Stifel Director of Behavioral Finance. Sneha, it's good to talk to you. It feels like this is kind of a timely discussion given what we're talking about in crypto trading today, but walk me through some of the common threads that you're seeing on both sides of the trade.
Yes, absolutely. I think the timing is perfect because at times when there is sort of a lot of price action and increased volatility, sort of our ability to react just becomes much stronger. So that means our sort of investor biases could be elevated during such times. And, three biases that I would like to highlight are sort of, things that we should be mindful, we should be aware of. And one is loss aversion, right? It just hurts twice as much on the way down. Losses loom larger than gains. So we should be prepared should there be volatility. The second is FOMO, widely talked about, fear of missing out. And we really want to caution our investors to not get trapped because a lot of them have emotions like regret to some of these investments. But the reality is that when you look back at data, time spent in the market is a lot more rewarding than trying to time the market. It's just challenging. And the third is herd mentality. I mean, with this sort of evolving investment landscape and this interplay between financial markets and social media, herd mentality is a bias that we have to be aware of because, yes, there will be winners, but sometimes or at some point there might be a stampede and there will be people who will get hurt. And buy high, sell low is another thing we would like to sort of remind our investors about. I think at the end of the day, you want to be in a portfolio that gives you good sleep at night and is actually good for your financial health.
Yeah, it's interesting to see maybe some people put their life I mean, we've seen these stories of meme traders putting their life savings into volatile things like Dogecoin, which is down pretty significantly today. But when you think about that herd mentality piece of investing, I mean, how much of that goes back to kind of the new age of internet investors piling in to thread groups like a Wall Street Bets on Reddit and how it's driving kind of that herd mentality where you can update it and see it in real time of how your comrades are trading, I guess.
Yes, no, I think you bring up a really good point. I mean, there are headwinds and there are tailwinds, and sort of the new generation, the new era of investors are embracing technology and tool sets. But I think what we're trying to tell our clients is that it's all great to have access to technology and tool sets, but use it to your advantage where you can sort of get yourself organized, be aware of sort of the risks you're taking on, have a speculative budget if you want to really dip your toes into a lot of these investments, have an entry and exit plan, and try to automate the process so that you get the emotion out of it and you don't get sort of pulled into it for more longer than, or over your comfort zone. So absolutely, there are both sides of the coin, but I think for us, the bottom line would be sort of consider your full wealth picture and be diversified. And if you are dipping your toes, sort of, measure it and understand the risks associated, because it's easy for us to forget when you're looking at asset classes move in one direction, it's sort of easy to forget that it can move the other side.
How much of this psychology that you've pointed to you think is part of a permanent shift we're seeing in the market? I mean, we're talking about this in the context of crypto trading and meme stocks, but certainly there's a lot of people who aren't necessarily putting their money in those spaces, but that have gotten into the market over the last year because the increased accessibility through apps like Robinhood.
Yes, absolutely. I mean, there is a shift in the industry, and I think this is, again, as I remind investors, it's sort of this interplay between financial markets, technology, social media. So yes, the landscape is evolving, but at the end of the day, one needs to consider this sort of as a full wealth picture of yourself, and you have to look within to see what is your comfort level, and not just blindly follow, social media, Twitter tweets, and sort of, other personalities, because each to his own in terms of comfort level, and you want to be in a portfolio that you understand fully, and that's where aspects such as sort of seeking advice, if possible, couldn't hurt. Going back to some of the basic principles of investing, i.e. being diversified in your portfolio, will not hurt. And being aware and getting access to good research and understanding what kind of investments that are out there wouldn't hurt either. So again, it's good principles of investing that, those rules don't change no matter how much the investment landscape evolves.
Sneha Jose, Stifel Director of Behavioral Science. It's good to talk to you today. Well, Amazon is kicking off their two-day shopping event. The shopping event, or Prime Day, we should say, is expected to rake in $11 billion this year, according to Adobe Analytics. We should point out it is the very last one under the leadership of Jeff Bezos. That $11 billion money expected to be a big windfall for a lot of third-party sellers who rely on the platform. Let's bring in Carlos Cashman, Thrasio co-CEO and co-founder. Carlos, you have really been instrumental in helping a lot of these third-party sellers build out their digital footprint. Give me a sense of how big of a bump they're likely to get as we continue to see this event grow.
Well, I mean, look, Prime Day itself will provide a huge bump just because of the publicity and everybody coming to the site and stuff, but you have to prepare for it. So the range can literally be anywhere from, 20% bump to 300%, maybe more. It really depends on what you prepare for and what you do, the deals you put out, and how your products are ready to move.
Yeah, what's the differences in the ways that some people are preparing well versus maybe preparing poorly? Is it just product set around this, or what's kind of the takeaway that you've seen in the businesses you guys have acquired that have done it well?
It's not necessarily product set. I mean, certain products move better at deal times perhaps than others, but it's really more like you have to have your marketing in line. I mean, Amazon brings people to the site on Prime Day, but there's still advertising being bought on every page. You still need to have your products ranking in the right place with the right organic search results on Amazon, the right deals. Like, we put deals in place, and a lot of this stuff you got to do months in advance in planning with Amazon. And so you have to be preparing with them on what deals you want to have, when, how much, and then you got to have your supply. If you don't have enough inventory in time, it's, you're not going to be able to sell as much, and you can't do as much of the other things. They all tie together, all of these things.
Carlos, this comes at a time when there's been a lot of concerns raised by third-party sellers about how, in fact, the data on the platform is used to Amazon's benefit. And I wonder, as somebody who's been in this space for a while, whether you've seen an impact at all from those who are saying, well, maybe Amazon isn't just the best place because of concerns, or ultimately, is it sort of a must? Is it a requirement to be on the platform just given the scale of Amazon?
So I don't know if this will be a popular thing to say or not, but that is a massive red herring. And I mean massive. First off, every seller learns to get on the platform by using Helium 10 or Viral Launch, these software platforms out there that have pretty much the exact same data. And certainly it's within a few percent, 5-10% accuracy of what Amazon's own teams might have. So you can already get this data and look at it. Beyond that, Amazon's Amazon Basics group has to operate as a separate entity inside of Amazon. It has to buy advertising, do these other things. And they're not particularly good at all of this stuff. They're not even great at doing their SEO or always product quality. So we don't see them on a lot of our listings, right? You're talking a few percent. On the scale of what Amazon sells, 300 billion plus and 60% of that being third-party sellers. Amazon's own products are basically irrelevant. I mean, if on any search results page, if you go search for an umbrella, I'm competing with 20 other sellers. If one of them happens to be named Amazon, it doesn't matter. It shouldn't matter to me. I still have to do a good job.
Yeah, and when we look at kind of where you guys are at right now, it's always interesting to chat with you at Thrasio because you guys, are one of the big players in this third-party space. But there are reports you might be looking to go public via the SPAC route right now, and I wonder what the different weightings would be if you go the traditional IPO route versus the SPAC route, or what the cash needs are in the business and the way you guys are operating right now, since it seems like one where the cash flows would be pretty good based on the way that this whole third-party business is structured. Talk to me about what the thoughts are there.
Well, look, cash flow is good, but the opportunity is even better, right? So the scale at which we can move and the size at which we can handle this and the growth, that demands more capital in the business, right? And we could keep raising it privately, and we might. I mean, I can't comment on any rumors out there, but look, the way I think about, being public and why and how you do it, look, 6 months after you're public, a year after you're public, no one remembers how you got public, right? I think a regular IPO, a direct listing, a Dutch auction like Google did, or a SPAC, they're just means to the public market. At the end of the day, you have to have the goods. You have to be a strong company that can report its financials quarterly, that can deliver and can keep, growing, hopefully, right? So, look, being in the public markets, there's a lower cost of capital, and there's a broader group we can source from, and this is a global game too, and it helps us on that front, I think. So, of course, we consider that as among many other options, and if the time is right and we make the choice to do that, we would. But again, all these different mechanisms of getting there, look, people love to report on this stuff and say, oh, SPACs are great. Oh, SPACs are terrible. Oh, IPOs are great or terrible. I mean, for every company that went out through a SPAC, which, by the way, have been around for 30 years, most people don't know, that maybe didn't do well, I'll show you many that did. And I can show you many public companies that did traditional IPOs that were terrible companies. Let's talk about Enron. Let's talk about WorldCom. I mean, those are just the big examples from the back of the last .com crash, but there's no assurance of anything. Right? At the end of the day, you got to have a great company, great people executing on a strong vision, and the public markets give you access to capital at better rates than anywhere else.
Well, Carlos, you could argue that the thinking is among investors is that because there is increased scrutiny from the SEC on these SPAC deals, it's the perception that could potentially hurt any kind of listing. Does that factor in to your decision at all?
So look, perception, I believe, may affect things in the short term. In the long term, performance is going to win out, right? So, there were times when Amazon was perceived as a bad stock, as a money-losing company, people who didn't understand their vision, right? But let's look at where they've gone over time, right? I'd say the same thing with Facebook. People perceived them to not be with the mobile game and to be behind. They've obviously delivered enormously. So I do agree. Look, investors move on perception more often than they should. Markets are not as rational as economic professors would like us all to believe, I think, because they're run by human beings who have emotions. And so they move up and down. But, we think of this company in 10-year blocks, right? In decade terms. We always have. So I'm not necessarily thinking about the short-term perceptions and what happened when I've got a vision that I need to execute over another decade. And I want to have the right investors along with me who understand that.
Some interesting insight there. Carlos, it's good to talk to you today. Carlos Cashman, Thrasio co-CEO and co-founder. We are off for a quick break, but coming up, Moderna making a big bet on its COVID-19 vaccine business, why it's expanding its production lines, even as case counts continue to drop. We'll be right back. We are seeing shares of Moderna get a pop in the session, up more than 4% after the company announced it's expanding its production lines to make room for manufacturing its booster shots. The additions will help expand its overall production capacity by 50%. All of this comes even as COVID-19 case counts continue to decline nationally. It is down nearly 20% over the last few weeks. Let's bring in Dr. Rishi Desai, Osmosis Chief Medical Officer and former CDC officer. Doctor, it's great to talk to you today. The Moderna news, certainly an interesting one at a time when I think a lot of Americans are sort of trying to think ahead. Yes, things look good right now, but what are the potentials for additional booster shots come fall? What are the potentials for infection rates to go up because of the Delta variant? How are you looking at all of the variables right now?
So I know it might seem counterintuitive that you're seeing more vaccine production in the face of fewer cases. In the U.S., we're very fortunate right now, going through a good period. I think that the situation is that, as you pointed out, there are going to be variants that come along. Right now there's the Delta variant. Tomorrow there's going to be, another variant. And so we're going to have to keep kind of staying a step or two ahead of the coronavirus. And we know that the best way to do that is to immunize against these other variants. And the current vaccine doesn't do a great job against these other variants. I would say it does a good job, not a great job. And so that means that you have to continue coming out with booster doses, which will help you boost that vaccine effectiveness. So that's really the key there, is you get that booster dose out there. And keep in mind, the world needs more vaccine. Over half the world hasn't seen vaccine yet. So there's a huge demand to vaccinate the world. That's one issue. And two, to protect folks specifically against these variants. And that's why more vaccine is needed.
And Dr. Desai, when we look into some of the countries that maybe haven't vaccinated as high a percentage of their populations as we have here, or the UK has, they're probably watching the Delta variant and very concerned about what could happen if that starts to spread in their countries. I mean, even when you look at the EU right now, there are countries that lag the UK. Talk to me about maybe some of the concerns that you have there for those countries that are playing from behind here.
Yeah, look, this gets very personal for me. I have family in India, family members that have specifically died of COVID already. And it's very concerning because those folks, they didn't have access to vaccine because it wasn't available in their town or their community. Countries around the world that are behind, the America and the UKs of the world, they're basically trying to protect their population as best they can. And so I think their best shot at it, is to get vaccinations out there and available as quick as possible. And if and when that booster dose becomes available, to start, including that in the messaging right up front as well. So I think the faster we can get that vaccine out there, the better. Keep in mind also, when someone, let's say in another country, gets ill, yes, it sucks, yes, it's terrible, and yes, it's scary, but that person also becomes a risk for creating a variant that can come back to the US, to the UK, and other countries and cause outbreaks. So there's a couple of reasons why you want to make sure vaccine goes abroad. A, because it's the right thing to do, but B, because that creates a risk for variants to come back and cause havoc here at home.
On what's playing out over in India, I mean, you pointed to your family there too. How much progress has been made in terms of vaccinations? We remember seeing those images a few months ago when they were at their peak with the COVID infections. But how much have vaccinations been distributed, and what are some of the hurdles, as you see, in terms of getting to what ultimately is the goal of herd immunity?
Yeah, I mean, take a country, a very populous country like India, where you've got a huge wealth inequities. Some populations maybe in wealthier parts of Bombay, things are probably a lot better in terms of vaccine protection. In most of India, that's just not the case. And so still a fraction of the population has been immunized, on the order of around 10% or so. And even with these huge numbers of vaccines being shipped to India, Nepal, Bangladesh, all these countries, it still doesn't meet the need, not even close. And so even though cases have come down and deaths have come down, which is fantastic, and a lot of that is because of public health measures, not because of vaccines that have kind of made their inroads there. So it's really public health measures, social distancing, putting mandates about who can be out and when. That has really made the difference for countries like that at this point.
Yeah, and it's a natural jumping off point to really ask about the upcoming Olympic Games, because you think about the context we're watching here and the lifting of some of those guidelines to have fans granted limited capacity in a lot of these games, but fans now from Japan allowed to go, international fans not. But I mean, when you look at those risks in Japan around the games, how worried would you be about if really it was those measures that got us back to normal, maybe in combination with vaccines, but kind of the undoing of that? It seems like even people there in Japan are a little bit worried.
Yeah, I mean, the public health leadership in Japan has made it very clear they don't support that. They don't want 10,000 local supporters going to these events, which is what has been allowed. And if you look at the guidelines, they say things like the local supporters are not going to be allowed to cheer. They're not going to be allowed to kind of linger. They have to go home right away. Now, practically speaking, if you're in charge of that, how are you going to get 10,000 people to not cheer? How are you going to get 10,000 people to go home right away? It's just not going to happen. And so I think even with those kind of things on paper, practically speaking, that's a very hard thing to accomplish. And if we look back on the Olympics and say, oh my gosh, Japan was doing quite well, but now look at this surge that they're seeing. How are we going to feel about the fact that we had these kind of, these policies go through? I think people are going to look back and say that this was a mistake. So I would say at this point in time, having 10,000 people in a crowd is probably not the wisest thing to do. And it's probably not the safest thing for the athletes either, to be honest with you.
Yeah, I think I agree with you. It's going to be hard to get 10,000 people to not cheer at all. Kind of goes against the spirit of the Olympics, but we'll be watching to see how successful it is. Dr. Rishi Desai is Moses' chief medical officer as well as former CDC officer. Thanks so much for joining us today. Coming up, small business owners reported a record number of job openings last month. We're going to be joined by two business owners who say they have found success recruiting workers. What they say is the key to filling some of these openings. That discussion is coming up on the other side. Well, small business owners reported a record number of job openings last month. The National Federation of Independent Businesses reporting that about 48% of small business owners said they couldn't fill job openings last month. That was up from the number in April. And it was the fourth consecutive month of record high openings within small businesses. To talk more about that, let's bring in Mike Draper, Raygun owner, as well as Carter Lewis, Soul Slice CEO. And Mike and Carter, we should point out, we've got both of you on because you've said that you've actually had a lot of success trying to fill some of those jobs. Mike, you're in Des Moines, Carter over in Oakland. So Mike, let's start with you on what you have found about the marketplace as you look to fill about roughly a dozen openings. What have you found in terms of how much leverage employees are seeking and what you're able to offer to fill those jobs?
I think one thing we're able to offer is decently lit closets for doing Zoom calls in. No, that was a joke. We, I think, over the years have come up with a plan for employee retention that kind of takes a lot of things into account, not just pay, but kind of equity and how people are treated and what type of work environment it is. And it's not anything necessarily that we've had to update since the pandemic, but it's something that I think as people have looked out at, what they're going to do during the day and what kind of jobs they want to be in and what kind of work environment they'd like to be in, it's an approach to employee retention that probably makes sense for a lot of people now.
Yeah, and Carter, I mean, we keep hearing from politicians the idea that maybe unemployment benefits are making it harder to bring back employees or hire new ones to fill the vacancies. I mean, how much of that are you maybe seeing, or maybe it boosting maybe the negotiating power that some of these workers have? How has it all played out in the real world?
I think that's pretty much a talking point. In my opinion, I think we've seen the devastation the pandemic has had on the restaurant industry. And as a result, I think workers want better conditions, better opportunities. And so I don't think it's a matter of people wanting to stay home and stay on unemployment, but I think that the reckoning has come for the restaurant industry and people don't want to go back to the same. I think that's what it is mostly.
And Carter, you've talked about how you've thought about the hiring process over the pandemic. You used to run several restaurants before. This time around, you're looking not necessarily to pay hourly wages, but have a fixed salary for employees. You've talked about making sure that employees are sort of paid more equally. Can you talk a bit about that evolution and what kind of response you've gotten as you've looked to hire?
Well, really for me, for this venture, I just wanted to sort of take everything that I've learned over the last 35 years in restaurants. I've operated over like 8 restaurants, and really just put into play what folks have said, like, oh, we should do this, we should do that. The biggest piece is salary. I think a lot of operators leverage profit by not providing gainful employment to their employees. And so for this model, we decided, what if we put every single employee on salary? We felt like that would make them more engaged and feel more a part of it. And then, the biggest thing for restaurants is labor and retention. Those are the two things. And labor comes down to, can you offer someone a full-time job? I mean, I think people don't realize, the low-level restaurant workers, which would say like the dishwashers, runners, those type of people, they are making very little money. Most of them cannot afford to live in the country. And then you have the top tier managers, servers who are making a lot of money. Like, even the hierarchy is different. So we decided to take all that away. Everyone is paid the same rate at our company. It's only based upon your skill level, based on our assessment and what we want to do in our development of our employees. And so I felt like if we did that, that would be a good thing. And it worked. We put it into our performa, and it was amazing. We had stable labor, which gave us the opportunity, which we think gives us the opportunity to grow even more as a company.
Yeah, and Mike, I mean, I'm curious. It sounds like you haven't had maybe as hard a time bringing people back or hiring workers right now. When you see that, I mean, would you agree with Carter's point that it's mostly a talking point when we hear politicians saying people would rather stay on unemployment and maybe just continue not working rather than coming back right now?
Yeah, that's not something that we've seen even when unemployment was at a higher rate per week. So again, it's always difficult for people to wrap their minds around any big complex issue, like employee treatment and work environment. It's a lot easier to say, oh, well, it's just this one issue. It's just pay or it's just unemployment, rather than everybody kind of holistically looking at, well, how is your scheduling handled? How is your sick pay handled? How is your actual flexibility? Things like that. We obviously have a lot of part-time staff who work in clothing stores. You know, they might be in college or in high school or just want a part-time job. But it's still handy for them to have predictable scheduling, of a schedule that's mapped out for a month and you don't have to send people home when it's slow. They can be able to rely on when they're going to be working and how much money is coming in. It's kind of that stability. But at the same time, you know, you have to take the time to cross-train employees and to have enough staffing so that if somebody needs to leave for a health or family emergency, somebody else can slide in. So it's not just rate of pay necessarily, because if somebody is making a little bit less, but there's enough staff to cover them if they have to leave, that's going to reduce, you know, one of these stressful pressure points. So there's no quick fix to it if you're, you know, a government or a business.
And Mike, you've got a pretty good pulse on what's happening out in the Midwest, given that you operate in a number of markets, whether it's in Des Moines or Omaha or Chicago. How are you looking to shift up your hiring process as you see the demand for workers only increase? And we talk so much about these record openings.
We oftentimes don't even post our job openings publicly. We only post them internally, and then people who work here will let people they know, friends or family, know that we have a job opening. So we look at that as one indicator that the work environment here is pretty healthy and that we're able to fill a lot of positions without having to, you know, really beat the streets and bring in a lot of people. But it is, you know, a lot of it does come down to employee retention. We don't have as much churn, so we don't have as many people to replace. So we don't need to do massive amounts of hiring because we don't have massive amounts of people leaving.
Mike Draper, the owner of Raygun over in Des Moines, and Carter Lewis, CEO of Soul Slice in Oakland. It's great to talk to both of you today. Really appreciate you joining us today. We are off for a quick break, but coming up on the other side, the president-elect of Iran taking a hard line against the U.S. His message to President Biden is coming up, plus Hong Kong's largest pro-democracy paper on the verge of shutting down. All of that is in our worldview after this short break. View today. Local fans will be allowed into the Summer Olympic Games in Tokyo, but capacity is going to be dramatically lower. Organizers set its limit at 50% with a maximum of 10,000 spectators per venue. Now, there are some exceptions. Sponsors, school groups, and IOC officials won't be included in that count. Japanese media reports the total number is likely to be up to 20,000 people. Foreign spectators have already been banned from the games to prevent the spread of COVID-19. The Tokyo Games kick off on July 23rd, but organizers say there is still a chance that fans may be shut out altogether if the host city sees an uptick in COVID cases. Iran's president-elect says he has no plans to meet with President Biden, even if both sides agree on terms to revive the 2015 nuclear deal. Ibrahim Raisi's first comments on the U.S. comes days after his victory over the weekend. The hardliner accused the U.S. and EU of violating the nuclear deal and called on Biden to lift all sanctions, saying the country's ballistic missiles program was not up for negotiation. Raisi won the election with the lowest voter turnout in the Islamic Republic's history. Just 48% cast ballots, with all of Raisi's serious rivals banned from the race. He takes over from current President Hassan Rouhani later this summer. And Hong Kong's pro-democracy paper is on the verge of shutting down just days after police arrested senior executives and froze $2.3 million of assets. Board members of publisher Next Digital met on Monday and set a Friday deadline to decide the paper's future. They're now calling on the government to release a portion of those assets so the publisher can pay its employees. The paper's been a leading critic of China's encroachment on Hong Kong, and its closure would mark a significant blow to press freedom in the city. Owner Jimmy Lai is already in prison for his involvement in the pro-democracy protests. 2 executives have been denied bail after being charged under Hong Kong's new national security law. Much more to come here on Yahoo Finance Live, including a look at our trending tickers. We're going to take a quick break here, and we'll be right back. Welcome back to Yahoo Finance Live. Stocks continue to rebound in the session with the Dow now up 520 points. Let's bring in Julie Hyman for the very latest on the market moves and some trending tickers she's watching. Julie.
Yeah, I mean, I think the Dow is chief among them as we see it rise. That 500-point increase is good for a boost of about 1.5%. So on a percentage basis, this is the best day for the Dow going back to March 5th. So the best in about 3 months' time. And if you see you have to sort of put this in context of what we've seen over the past week, right? So here's the 7-day chart for the Dow. And this bounce that we're seeing today is just that, the worst week last week for the Dow since October. So seeing a bit of a rebound effect as people now try to digest the Fed speak we got last week, prepare for the Fed speak we're getting this week, and figure out how to position around all of that. So that being reflected in what we're seeing there for the Dow. The S&P 500 also showing strength today. It's up about 1.25%, and the Nasdaq is up less. So let's break that down a little bit and sort of dissect it to some extent. Within the Nasdaq 100, you've got a mixed picture for technology. But if you look at the Dow movers, every single one of the Dow 30 components is higher here. Microsoft, by the way, is trading at a record, and we see a lot of strength really across the board in different types of sectors. Getting more specific about that, many of the so-called value groups, that value rotation that we've been seeing for a lot of this year, that then has seen some hiccups more recently and more strength in tech, has now reasserted itself. So in other words, energy, the best performing group, industrials up there, materials up there, financials up there as well, and it's sort of tech and communication services, consumer discretionary, that are, at least on a relative basis, not as strong in today's session. The banks in particular, which had a pretty dismal week last week, the big banks are all coming back. And if you look at them, nothing but green on the screen here. You had Citigroup really and Bank of America having some negative streaks there, and they are coming back from that in today's session. To go back to some of the trending tickers specifically that we're watching today, though, aside from sort of the big market moves here, really we are seeing a lot of action once again in the cryptocurrencies, as I know you guys have been watching as well, as we've got Bitcoin down about 5% today on the concerns over regulation in China, Dogecoin as well on this list, Ethereum on this list as well. And then I believe if we scroll down a little bit, we've got MicroStrategy, which today announced it had increased its Bitcoin holdings. Its average cost is still at around 26,000, a little above that. So Bitcoin still trading above that level, but that's something it looks like investors are watching pretty closely as MicroStrategy falls by 9% today, guys.
Okay, Julie Hyman with the moves there. Thanks so much for that. Coming up, the labor shortage leading to hundreds of flights being canceled for American Airlines over the weekend. Why the carrier says the crunch could last well into the peak summer travel season. We're going to be discussing that after this short break. Well, American Airlines facing a lot of unhappy passengers over the weekend after the carrier canceled hundreds of flights, Zach. And I'm looking at shares. It hasn't necessarily been hit too hard, down about 0.8%. A number of reasons that American Airlines has given, one being the labor shortage. They talked about a high number of sick calls, maintenance and other staffing issues as well. And we did get a statement from American Airlines in response to what played out over the weekend, saying that we made targeted changes with the goal of impacting the fewest number of customers by adjusting flights in markets where we have multiple options for reaccommodation. And of course, while we're talking about hundreds of flights canceled over the weekend, this is something that American has said it's going to continue into the peak of the summer travel season, saying cancellations are going to continue through mid-July. It's part of an ongoing theme we've talked about, Zach, with labor shortages and companies trying to adjust.
Yeah, I mean, for American, and not just dealing with pilot shortages too, but also crew. And we've talked about how stressed they've been under these mask mandates and trying to enforce it, added responsibilities here, and kind of the lack of time off if you are dealing with a shortage of workers there as well. But I mean, it's also maybe worth reiterating the point that when we talk about kind of the slowdown that happened in the pandemic, of course, always easier to turn the spigot off when it comes to functioning and running these companies than it is to turn it back on, because you got to deal with rehiring or bringing back furloughed workers here at Kiko, and it's not necessarily going to be a light switch you can switch. And so, I mean, they might point to, they pointed to weather here. I'm not sure how big of a factor that is in something like this relative to kind of some of the labor shortages or issues around getting people to want to work again. Just given the fact that, this is a pretty intense bounce back. This is stronger than people were expecting, right? When we think about travel coming back. And the way that you're only about, 25% off pre-pandemic levels now relative to where we were, complete collapse of travel in this country. So it's not an easy thing to come back. I don't envy the position of this company. And some people are criticizing the way that some at the top of the company has been able to maintain their compensation and benefits here relative to the workers who are on the front lines.
Yeah, I guess the positive in all this is that the point you just made, which is travel is coming back. Or demand for travel is coming back at a much faster rate than anticipated. But you've got to wonder whether, American was really prepared for that. I mean, it's easy for us to criticize from the outside saying, wait a second, given the last year and the challenges that the carrier, but the sector as a whole has faced, why weren't you necessarily prepared for that? But I think it does speak to the challenges we're going to continue to see in the space as well as the broader market. And we've talked about labor shortages across the board here. And with airlines, it is specific just given that so many were furloughed at the height of the pandemic. And to your point, there's some questions about executive compensation there and whether, in fact, there was proper planning here in place for the uptick that we're seeing now.
And the thing is, too, we don't talk about the corollary, right? Or the other side of this. What would have happened if some of those support networks that we had earlier in the pandemic weren't put in place, right? And you think about how airline workers were almost excluded from some of these packages and kind of the way that support might not have been there, how much worse it could have been, right? If all of that happened when we had kind of the airlines union coming on, pleading their case, really, and showing that this was going to be a much better way to go and why they needed some of that support. And you wonder what it would have looked like, too, if we had this big bounce back in demand for leisure and just how many more flights would have been canceled if we didn't see that. So also kind of interesting to think about. But nonetheless, clearly strong bounce back here in travel, and workers are needed to kind of support that. We're going to take a quick break here on the show and reset for the noon hour. When we return, it's a busy week hearing from a lot of members of the Fed here. Kicking us off, St. Louis Fed President James Bullard, his new take on why the upside risks of inflation need to be taken more seriously at the Fed. Yahoo Finance's Brian Chung, our Fed reporter extraordinaire, will break down the latest in Fed speak right after this. welcome into Yahoo Finance Live as we cross the noon Eastern Time trading hour. I'm Zach Guzman alongside Akiko Fujita. As we have the markets rebounding today after last week's sell-off, the Dow up more than 500 points, enjoying its best day since March. The last 3 months, we've got a big jump here. Not just the Dow, though, the S&P and Nasdaq also, as you can see there, enjoying about a 1% jump. The S&P a little bit more than that. Of course, this week is a completely different story than what we were chatting about last week, and potentially a different tone coming from the Fed. We'll break down the beginning of a busy Fed week with 10 FOMC members speaking publicly this week. Yahoo Finance's Brian Chung will break down the latest in Fed speak in just a second. Plus, the earliest and perhaps the biggest Amazon Prime Day ever will spotlight the best deals, the retailers trying to ride the coattails, and the worker rights battle still taking place in the underbelly of the Amazon machine. And speaking of Amazon, welcome to the publicly traded so-called Amazon of Weed. The CEO of Weed Maps will join us later in the show to discuss growth post their SPAC merger and how they are helping businesses connect with cannabis users online. But first, two Fed speakers already kicking off a busy week of Fed talk. St. Louis Fed President James Bullard, Dallas Fed President Robert Kaplan are up first on that slate of Fed speakers, and Yahoo Finance's Fed reporter Brian Chung here to break it all down to kick things off for us in the back half of the show. Brian?
Exactly. Well, after the volatility that we saw in markets at the end of last week, obviously Fed speakers continuing to be in view after the jitteriness in responses, specifically St. Louis Fed President James Bullard's comments to CNBC saying that he saw a rate hike coming in as early as late 2022. But we're getting more Fed speak today as we do lift out of that Wednesday announcement last week where the Fed held interest rates steady, but messaged through its dot plot economic projections that interest rates could be going higher not long from now. You could see ahead of you that the dots, which kind of map out where each of the 18 policymakers see interest rates going in the next few years. We're starting to get some clarity. Bullard again saying that he could see a rate hike in possibly 2022, which would explain that red dot. And then Neil Kashkari from the Minneapolis Fed telling Reuters in an interview last week that he doesn't see any case for interest rate hikes through that time period. So again, that divergence on the FOMC with regards to what to do with Fed policy definitely in view. Now, of course, this week we're going to have a flurry of Fed officials. You already heard from 3 this morning. We have the New York Fed President John Williams later this afternoon. And then throughout the week, some other high-profile ones worth watching. Jerome Powell testifying on Capitol Hill tomorrow, in addition to Mary Daly from the San Francisco Fed. She is a voting member this year. And then, of course, we've got a number of other speakers. There's a Fed governor on Wednesday, Raphael Bostic on Thursday, and then Eric Rosengren on Wednesday and Friday as well. Now, a lot of other interesting things going on so far as what we heard from Bullard and Kaplan this morning. It seems like they think the bond market overreacted a little bit. You heard from Kaplan saying, quote, strong bid for the U.S. Treasury, and I think there will be for an extended period of time. He was pointing to pressures from abroad with where yields are. There's just a lot of interest in the U.S. dollar and U.S. government debt. And then Bullard, for his part, saying, quote, I think markets themselves are a little bit confused about the recent moves. It seems like the bond yields have continued to go up and down through the trading session this morning. I'm looking at a 30-year U.S. Treasury that's had a handle of about 207 basis points. And guys, one last thing I want to point out. Jerome Powell headed to the White House today. There is going to be a climate risk and financial inclusion meeting. It's not just a one-on-one. A number of other financial regulators will be there as well. But the reporting is that this is the first time that Powell and Biden have met face-to-face since the administration started. So definitely worth watching on that front, guys.
Yeah, and Brian, I mean, when it comes to that, obviously there might be other things they could discuss beyond those subjects, and including one where we talk about Jay Powell and how much time he might have left at the Fed. I'm not sure if that's one that you're still looking into about the odds there. It seems like a lot of people are expecting him to stay.
Yeah, absolutely. And this is a conversation that we expect to heat up in the coming months. The way that this works is that the Fed chairman, again, Jerome Powell, his tenure as the chairman of the Federal Reserve will expire in February of next year. So not necessarily something that they need to iron out in the coming months. But the nomination process takes time because it has to be a Senate-confirmed individual for the renomination or for the nomination of a new individual. So it seems like they would want to have something hashed out probably in the coming months. So whether or not the Biden administration is thinking about how who to have in those conversations is one thing. We know that Powell, for his part, hasn't necessarily done anything to rub the Biden administration in a way where they would consider actively replacing him. But there are some names that have been floated out there, the likes of Lael Brainerd, who is currently a Fed governor, apparently a possible replacement if they did decide they wanted to go down that route. But again, not a guarantee they would want to turn away from Powell given his performance during the COVID crisis, guys.
Thinking about. Well done there, Brian. Appreciate that. That's good stuff. We'll check back in with you later on. Want to check in, though, on the market action, what we're seeing play out here. As it is, of course, Amazon Prime Day and e-commerce has been a big focus here in terms of the growth drivers we saw in the pandemic. A lot of those tech companies not necessarily seeing the slowdown. In fact, saw quite the opposite. Perhaps part of the reason why we saw Amazon move their Prime Day up to help in those year-over-year comparisons. And for more on that, I want to bring on Scott Helfstein here, ProShares Thematic Investing Executive Director, to help break it all down. And Scott, I mean, when we look into this on Prime Day, I mean, how much of this do you think is still to be the growth engine here for the overall market, since, you know, growth was what got us here and maybe what investors are starting to pour back into?
Yeah, we continue to believe that growth is really a significant area that investors should focus on. Obviously, you know, we saw the reopening trade and value reassert to start the year. A matter of fact, across a number of themes that we track, correlation, inverse correlation between successful themes or the themes that really outperformed in 2020 versus those that came back in, right, and had a more difficult 6 months here in 2021 was quite high. But a lot of that reopening, that low-hanging fruit, has moved through the system. We just heard a little bit about change in policy potentially at the Federal Reserve. We obviously in 2020 saw record amounts of fiscal stimulus from the central government. We saw massive amounts of monetary stimulus. And in those conditions, all boats kind of rise. We saw that as the markets kind of hit peak levels. And we think from here that good growth and good quality companies will really start to differentiate themselves. And, you know, as you pointed out, Amazon and a number of the e-commerce names that really proved critical during the pandemic were among those that really delivered fundamentally.
What are some of those growth names that meet the criteria you just highlighted there, Scott? Especially if we're talking about e-commerce, certainly a lot of focus because of Amazon Prime Day today. Outside of Amazon, what are the names you like?
Sure. There's a range of ones that we think are interesting. We really prefer to focus on what we call the digital natives. And so these are companies that really built their business model for the online environment. And so we try and stay away from the Walmarts, the Targets. We know that Walmart is the second largest e-commerce company in the US, but they've done it at the expense of their margins. Whereas you look at someone like an Amazon, who has actually expanded margins. Some of the other players we think are interesting, Etsy, the online marketplace, which got a lot of attention around masks last year, but subsequently has really been able to hold on to their customer base with a number of repeat customers. Smaller companies like Stitch Fix, which is not only an e-commerce play, but is also, quite frankly, a reopening play. As people go out and they've got their enviable subscription model, but they're also now introducing a purchase model. So there are, you know, whether it's niches like stamps or pet food like Chewy, which has really proven to be an incredibly strong company and is now expanding the pet healthcare line and expanding into pet telehealth as well as part of its subscription model. So there are really a number of areas that we think are interesting. Amazon gets a lot of the press. It's the 800-pound gorilla, but you know, e-commerce as a whole still only represents 14% of all retail in the United States. That's 1/4. It's a lot smaller than people think. And so we believe that there's a big opportunity here for secular growth.
Well, let's talk about the flip side to that too, then. Maybe the big chunk that is still going out and buying things. And particularly when it comes to the reopening here, we saw value earlier in the year enjoy a bit of that rotation back into some of those names that had been absolutely destroyed in the pandemic. I'm thinking the cruise lines here. I'm thinking some of those theaters as well that have gotten a bit of a boost from the meme trade. But when you look into consumer discretion, I mean, what are maybe some of those big thematic investing themes that might stand out for some areas you're seeing excitement around right now?
So what's really fascinating is social media is actually one that people don't think about. We relied on it so heavily during the pandemic, and yet so much of their revenue is driven by hotels, hospitality, travel, and a lot of that got turned off. I think, for example, we're really also seeing this among the FANG stocks play out with the massive outperformance of Google to, say, a Netflix. And so Google advertising focused, reopening, Netflix viewed as much more as a stay-at-home stock. We continue to believe that streaming is a great business. We don't think that that's, all of a sudden gonna get turned off, or we're gonna change technologies meaningfully. But it has been very interesting to see where people have naturally gravitated to. So consumer balance sheets are at record strong levels. People paid down debt. They increased their savings. What's fascinating about the consumer discretionary sector, though, is a lot of people don't realize the largest four components, e-commerce, internet retail, is now the largest at 35%. But the next biggest parts are traditional specialty retail, hospitality and hotels, and autos. So, for people who want to play Amazon Prime Day, we think that there are better ways to target e-commerce versus getting 60 or 70% into some of these other reopening areas.
A good reminder of how layered the retail landscape's become now. Scott Helfstein, ProShares Executive Director of Thematic Investing. Good to talk to you today. Well, salad chain Sweetgreen has confidentially filed for an IPO, according to a report out from Axios. The company will look to list in the fall. It hasn't necessarily disclosed how much it plans to raise, except it will be more than $100 million. Sweetgreen raised around $670 million in VC funding so far, and it was valued at nearly $1.8 billion in the company's last funding round earlier this year. A brand that you and I are very familiar with, Zach. Although I haven't been to Sweetgreen in a while. Not going to the office.
No salads in the office. Haven't had the chance to eat it in a bit, but looking forward to getting back in there when I return to New York, when we all return to the office. Going to take a quick break here, but coming up, discussing Amazon Prime Day. Of course, got to focus in on the best deals. Yahoo Finance tech editor Dana Halley will break that down for us, as well as a look at the continued push for improvement when it comes to worker rights at Amazon. We'll break it all down right after this. Welcome back to Yahoo Finance Live. It is Amazon's Prime Day today, a big kickoff here of the two-day event, including some good deals out there for shoppers. And Yahoo Finance's tech editor, Dan Halley, joins us now with a look at those, as well as the competition trying to ride the coattails here as well. Some of their e-commerce foes. Dan.
That's right, Zach. There are huge deals going on Amazon right now. Obviously, the big ones that I'm interested in, because I'm a dork, are the tech ones. And there are some deals that are really worth noting. We're talking about $1,000 off on some TVs, which is just absolutely wild. AirPods are at one of their lowest prices yet. The original AirPods with wireless chargers. There's also deals on some Apple Watches and other Apple products. Headphones in general are on sale, some of them from Sony that are really great in Bose. And if you're looking for any kind of gaming action, you should find some good deals there as well. And then, obviously there's the regular goods. I saw earlier today kitchen shears were on sale because, hey, why not? And a stand for your broom and dustpan. If that's something you're looking for and you need, go for it. Prime Day is also a good day for those basic home needs, things like, toilet paper, paper towels, toothpaste. You're going to find sales on all of that as well. But I kind of like the more expensive, fun stuff more than that. There are also, though, huge amounts of competition from others that aren't Amazon, namely Walmart and Target. And they're offering similarly large deals to get people to go to their websites or in the doors at their brick and mortar locations. And this has been something that we've seen cropping up a lot in recent years, the buildup of the kind of competition around Prime Day. And obviously, they're not going to call it Prime Day. It's usually something like summer sales or something along those lines. But it always happens to fall on Prime Day. Plenty of deals there on the same kinds of goods that you would expect to find deals on at Amazon, but definitely worth checking out if you don't feel like going to Amazon today.
Yeah, I mean, Amazon's still dictating the timeline of these sales, right? How successful have these rivals been in chipping away at the Prime Day events? If we've seen them sort of build out competing offers over the last few years, how big of a lift are they likely to get?
I mean, these have been some of the best days for them as far as sales go, outside of Black Friday and Cyber Monday. They really are kind of benefiting from this boost. It's almost as if Amazon is assisting them to a degree, just because people are saying, "Wow, Prime Day is a big time for me to go out and buy something." Oh wait, Walmart wants to sell me something too on the cheap, and so does Target, Best Buy. You're seeing all these different kind of retailers that want to join in and make sure that Amazon doesn't get all the glory. Now, Amazon does, because it is called Prime Day, and that's why you're going to see most people go to the site. But look, when you do go, you have to be really fast because so many people are on there just picking up the deals as they go, and there's only limited quantities that some of these sellers have on Amazon. So you may end up finding yourself trying to go to another site to grab a deal that may or may not be similar to what you would see on Amazon. But look, if you just jump on there at any given moment, you're going to find some good deals today. I've just been surfing around. I have no need to buy anything at all right now, but I'm still surfing just to see what might be available. And I'm pretty sure that's what most other people do. You see something, again, kitchen scissors, you say, well, okay, $4 off, it's $8, maybe I'll grab that. And that's how you end up with a cart worth, $200 at the end of the day. But it is worth checking out, I think.
All right, Dan Halley, keeping his eyes on all the good deals. We'll check back in with you on the progress of Prime Day. Obviously, a lot of people look forward to that. Appreciate the update there. Of course, on the flip side of this coin is the actual workers who are working to make these orders possible, to make Prime Day possible. As many of us look forward to the event, worth focusing in a bit more on the worker issues tied to Amazon and now Prime Day as orders pick up, given the fact that it has been a few weeks since that failed union vote in Bessemer, Alabama. A lot of things still not solved when it comes to the issues workers raised around Amazon's employment. And for more on that, I want to bring on Adam Obernauer, Retail Wholesale and Department Store Union Director of the Retail Organizing Project. And Adam, I mean, your guys' union have been at the forefront of kind of this union battle around the issues at Amazon. Talk to me about maybe how much has still gone unsolved, or maybe if any of the efforts and kind of added efforts on Amazon's side to kind of bring attention to these issues. Has anything changed?
Well, I'd actually say that things have gotten a little bit worse as you're leading into Prime Day. You have the constant working conditions that Amazon pushes through the surveillance and the monitoring of every worker's work product, how fast that they're working and the rate that they have, and then the mandatory overtime that you have during Prime Day, which forces workers to have 12-hour long days in hard working conditions, fast working conditions, high temperatures. there is a cost to getting a product this quickly, and there's a cost to all of it, and the workers are bearing the brunt of it for sure.
I mean, take me inside the fulfillment centers. To what extent does this 2-day event really elevate the intensity and the working conditions you just pointed to? I wonder if you can elaborate a bit more.
Sure. Well, the working conditions are always extreme at Amazon. You have to pack a certain amount of boxes per hour. It's called your rate. And then you end up working against yourself. So if you average a certain rate over a period of time, you're held accountable to the rate that you average. So the person next to you could be working slower than you. You're both being pushed to go as fast as you possibly can. And so when you're already at your extreme and you're already at your limit, when you add an event like Prime Day and you add mandatory overtime to get ready for Prime Day, then you're just making these conditions worse. You're making it more difficult to work at a certain speed. You're pushing workers to the point where a lot of them don't go back to work. I mean, you look at the turnover rate at Amazon and it's extremely high. In the New York Times, they recently reported it's 150% turnover per year, which is more than double what you see in other industries that are comparable in the warehouse industry. So I would say that it seems just like a 2-day event, but the lead up to the event, the blackout periods where workers are forced to work longer hours actually are pretty extreme.
Yeah, and Adam, we should know we reached out to Amazon to talk about kind of the allegations around working conditions or union busting claims in Staten Island, and we did not hear back yet in regards to those questions. But when we kind of think about the union vote and when it came amid kind of protection or maybe support here from President Biden, it's not often you hear a president in the White House talking about unions and supporting them against second largest employer in the country. But when you think about how the union vote went and how much of a blow it might have been to kind of the rallying cry for workers at Amazon, I mean, how do you kind of recover from that in the mission to improve things?
That's a great question. I think that workers themselves feel like they're being surveilled all the time. Obviously, Amazon has the capability to do so. And I think that there were many, many workers that stood through and voted to become a union and to become unionized at Amazon, many more than have ever done so before in the United States. And so I think that taking on an organizing campaign is a very difficult process and it's very scary. But when you're doing it at a place like Amazon and the campaign that Amazon ran to vote against the union, being the severity that they put in how important it was to vote against the union so that they can keep productivity up as if they're polar opposing things, I would say that the workers are still resilient and still are want to see things change. I mean, you can't work at Amazon on the day-to-day and not want to have a safer workplace, safer working conditions, and to feel safer overall at work. And so I understand the question. I think it's great, but I think that at the end of the day, I think you see Amazon workers that are rising up all around the country, not just in Bessemer, not just in Staten Island, and also all around the world.
And Adam, of course, we've got founder and CEO Jeff Bezos stepping down later next month. In his last shareholder letter, this came on the back of that vote over in Alabama. He seemed to suggest that the company was thinking about the treatment of employees, essentially saying we have to do better for our employees. That was back in April. And I wonder if you've had any conversations since then. Have you seen the company shift, at least in tone? Do you get any signs here that they're willing to move on some of these critical issues?
I think that a lot of it's very performative. And so what you saw during the union election was managers were appeasing workers. They were telling workers that they just need another chance, let them fix it. They didn't realize things were so bad. And what you then see is you see this performative reaction from people like Jeff Bezos that say, well, we recognize working conditions aren't great. We'll do a safety study. But at the same time, crushing your workers' voice that are trying to voice their opinion that they want to have a union in Bessemer, they're polar opposing views, right? So it's easy to fight against your workers that are trying to take their own agency of the workplace and fight for better working conditions while they're doing it at a specific location. And then to make these broad, generic claims that you want to look into better working conditions at the same time, you are not you were not really willing to listen to the workers that were organizing in the first place.
Yeah, it's a very interesting dynamic when we talk about Prime Day and the other side that doesn't get talked about maybe as often. But Adam Obernower, I appreciate you joining us to walk us through all the issues there. Retail, Wholesale, and Department Store Union Director of the Retail Organizing Project. Thanks again for the time. We're going to take a quick break here on the show, but when we return, shifting from Amazon to what some are considering, maybe the Amazon of weed, the e-commerce platform Weedmaps, the parent company there, public after its SPAC deal. We'll chat with the CEO for more on what they see for growth when it comes to more and more states legalizing weed. Stay with us. We're back in 2. Welcome back to Yahoo Finance Live. Last week we had the culmination of the deal for what some call the Amazon of weed. You can call it the Yelp of weed. The company's name, though, Weedmaps, and the parent company going public via a SPAC merger with Silver Spike Acquisition Corp. Now a publicly traded company, giving investors an interesting way to play the growth in weed as the company is working on being the main e-commerce platform for a lot of these businesses to tap into a growing network of cannabis users. And for more on that, I want to bring on the CEO of WM Technology, the parent company of Weedmaps. Chris Beals joins us now. And Chris, good to be chatting with you again here, man. Congrats on finally closing the deal to get out there as a publicly traded company. I mean, talk to me about the growth that you guys are seeing now as a publicly traded company.
Yeah, it's been a great path, ton of hard work from the team. I think we're really aided by the fact that we have a very mature management team, and so getting through a process like this is never easy, and so it's really exciting to have officially had our debut on Nasdaq last week. But yeah, sort of the Google meets Shopify of the cannabis sector. We're in a really interesting place because I think we're still in the really early stages of growth of a number of the states that have already licensed. Only about 25% of cities and counties in California, for instance, have cannabis licensing. That's a huge opportunity. And then separately, if you look towards our business in a box, that suite of SaaS offerings, that continues to expand. Our adoption continues to grow rapidly. And then as we look towards the sort of going forward, Virginia, New York, New Mexico, now Connecticut most likely are all legislatively legalizing. And so on the go forward, we see what I find to be this incredible acceleration of states of their own volition opening up. And so that really underscores a lot of opportunity on the go forward.
Yeah, maybe we can stick with the Shopify comparison there too, because I guess it is more fair when you think about SaaS and what you guys are trying to build. But last year it was $160 million in revenue. You guys told investors you expect to be $205 million this year. Is that still kind of the guidance when it comes to growth? And I mean, I guess, if you focus in on that SaaS piece, important to flex that you guys don't necessarily touch at any point kind of the leaf, which is why, you guys are able to trade publicly here. But what does that maybe look like if laws do change, what the growth could be, if not just 205 million?
Yeah. So yeah, we are and are always going to position ourselves as the operating system for the cannabis sector. And so yeah, the 205 is our guidance for this year. Really excited about the growth that I see ahead both this year and then in sort of the out periods as well. But I think the thing that's interesting for us is we are not a touch the plant company. We never will be a touch the plant company. But there's so much opportunity for streams of revenue that sits on the other side of something like federal legalization. We cannot offer any form of payment rails. There are a number of what I find to be incredibly exciting and frankly I think lucrative product offerings we could provide or things we could do to help enable these businesses that we simply can't do until federal legalization comes, because we take a very tight compliance view of sort of what is permissible and what is not permissible with this current state of affairs. We have state legalization and an ongoing federal prohibition. And so, that is a really exciting catalyst for us on the go forward, is when that time comes when we do see federal legalization.
So Chris, let me just follow up on that growth question, because you did say you're still in the early stages. To what extent can the value that you see here be unlocked without the federal legislation in place?
Yeah, there's so much growth that can happen without federal legalization. I think to that point, there's so much growth that can happen just in states that have legalized already. The simple reality is most jurisdictions that have legalized still have a retail density that is far too low to enable the legal market to supplant the illicit market. So most states that have legalized still see less than 50% of cannabis demand being met in the legal market. It's a huge area of growth for us or opportunity, because we see the number of licenses continuing to increase as a factor of time. And so, especially in the wake of COVID-19, as state and local governments look for ways to stimulate local economies, augment tax bases, that sort of thing, the cannabis sector is a great way to do that. And so we're seeing local jurisdictions move forward with accelerating licensing. So while federal legalization is in and of itself, I think, a really singular catalyst event for us, our forward growth is really predicated on looking at the states that are already legalized, and I think taking a fairly conservative view of what states may legalize on the go forward, given that we see generally a material lag between when a state, say New York, legalizes and when the first licenses come online with something like adult use.
Yeah, you're also not the only company maybe that's trying to tackle the issue of kind of helping cannabis businesses in these endeavors. You could look at Leafly as maybe another one out there, but when you look at what Weedmaps is doing specifically maybe at the scale, I mean, what are the numbers you point to say, no, look, we're in the best position to eventually capitalize on that growth if we do see federal legalization change?
Yeah, I mean, the interesting thing is we're really in a universe of one when you look at the breadth of our offerings. It's that we have what I believe to be the largest marketplace out there, available in every jurisdiction that's legalized. And then we're pairing it with a deep expertise in data, because the simple reality is we estimate we see over a 20% conversion rate from consumers that touch our surfaces. It's only enabled by us taking a really complex, essentially pharmaceutical product, and breaking down the product information in a way that gets people comfortable with effectively taking a pharmaceutical good that they're going to put in their body, understanding the different compounds, the different product types. And we attack that both through the data piece, but then the fact that we have our suite of software we provide, but then we also invest heavily in integration. So we integrate with almost, for instance, every third-party POS. We integrate with cannabis-specific CRMs, that sort of thing. And so that's really where we position ourselves is unlocking value, is really serving as that operating system where we can help these businesses, especially as they see margins compress, unlock revenue and profitability.
Yeah, and very difficult, I would assume, for some of these legacy tech leaders to maybe hop into the industry and catch up with all the licensing around all of these things too. As we know, cannabis is heavily restricted when it comes to that. But appreciate you taking the time. Chris Beals, the CEO of WM Technology, the parent company of Weedmaps. Thanks again for the time. Going to take a quick break here, but when we return, digging into the issues around the Olympics, still a full steam ahead. Of course, the U.S. Olympic trials wrapping up, and still a lot of concerns when it comes to the safety of the Olympic Games, particularly among the Japanese public. We'll highlight those on the other side. Stay with us. Welcome back. Looking into the business of the Olympics, very interesting change here announced this morning when it comes to how many fans might be allowed as spectators at the Olympic Games, and the number coming in at about 10,000 Japanese spectators. Of course, international travel still not allowed when it comes to spectators coming in to watch the Olympics, but a very interesting update given the health concerns that are still there around the Olympic Games. And for more on that, I want to bring on Yahoo sports reporter Henry Bushnell joining us once again. And Henry, when we look at it, this is one of the biggest, I think, concerns that we had when it comes to the Olympics is that public health concern. Even the people there in Japan, depending on the polling, not necessarily in favor of moving forward with packed stadiums. This will be about half capacity. But what are you seeing in terms of this maybe being a signal about the confidence of moving forward with the Games?
Yeah, I think this is a pretty major decision, especially given that, everybody who is actually involved in the Olympics in terms of athletes and their coaches and stuff is going to be subject to pretty strict health regulations, and is going to be it's not a complete bubble, but something resembling a bubble. But Olympic organizers obviously have much less control over people attending the games as fans. The interesting part about this is that this decision that was made this morning by a combination of the International Olympic Committee and the Japanese government, it was made against the recommendation of Japan's top medical advisor, the Japanese government's top medical advisor, who last week recommended that they hold the games without any fans at all. And now, a few days later, the IOC and the organizing committee have said, nope, we're going ahead with 50% capacity at each venue.
I mean, Henry, it feels like at this point it's a business decision, right? I mean, to put it bluntly, that's outweighing any other health concern on the ground there. And I know we talked before about where the IOC makes money. It comes down to sponsorships. And so if they are able to continue with the game, certainly they're going to rake in the money they're looking for. But I wonder from a ratings perspective, what you're anticipating. I mean, how many people, I mean, what's the interest level likely to be with an Olympic Games that are held under these conditions?
I think the interest level is still, now I think there are two aspects of this interest level. One is the interest level on the ground in Japan and the fans who will actually be going to the games. And I think you could see some suppressed interest level there. But in terms of the international viewing audience, I believe an NBC executive recently said that they're expecting it to be one of their most successful, if not their most successful Olympics ever. I think there is still going to be a huge international television audience for these games. And I'm frankly not sure that fans in venues and the capacity of fans in venues is a big factor there. I think people are still going to watch.
Yeah, it was weird. Tennis star Novak Djokovic saying that he would have maybe rethought if there weren't going to be fans to watch there as well. So I guess he maybe wanted some attention in the stadium, some fan aspect there. When you think about the health aspect, though, it does seem like they could undo this, right? There is still the issue of if things get bad, they could reverse this stance. But I guess, that we've always seen people maybe act too slow when it comes to public health measures in reacting to a spike in cases.
Yeah, the organizers did leave open the possibility in their announcement today that if Japan or Tokyo were to reinstitute this state of emergency that just got lifted yesterday, if there were to be a state of emergency during the games, then they could reverse this decision and we could go with no fans at all. Because I think there is a significant worry that, and it's not only the fans going into the venues, it's all the socializing that happens around the attendance at a sporting event, right? It's the restaurants beforehand, it's the gatherings afterward. And there's a worry that could contribute to a rise in cases. But for now, they're confident that at 50% capacity, they can go ahead and have this not contribute to a huge spike in cases in Tokyo.
Yeah, and all the economists out there who have always wondered what kind of economic benefits beyond the games themselves might provide. This is going to be an interesting case study to see what happens in terms of the boost here. It might undo how much other countries might be willing to pay in really hosting these things, because we're about to find out what it's going to look like. But Henry Bushnell, appreciate you joining us, Yahoo Sports reporter. Thanks again for the time. Thanks again for the chat. We're going to take another quick break here on the show, but when we return, getting technical into the market action, Yahoo Finance's Jared Blickery is going to break down a lot of the key market indicators we've been watching lately. He'll join us on that in just 2 minutes' time. Stay with us. Welcome back. Let's get technical here with Yahoo Finance's Jared Blickery as we move into the midpoint of 2021, maybe resetting the market moves that we've seen with some of the newer entrants when it comes to IPOs and SPACs. Clearly SPACs slowing down a bit, but for more on that, I want to bring on Jared Blickery with a special guest today. Jared?
That's right, and we have the IPO expert with us. That's Kathy Donnelly. She is a proprietary trader and co-author of The Life Cycle Trade. Kathy, it's great that you could join us today. We have a lot of IPOs in the calendar. I thought we'd take a look at some that have been trading for a while, and you can give us your perspective. And we'll start with Snowflake. I'm going to pull up a one-year chart so we can see the entire price history going back to whatever, looks like last September. Look at that big pop on the opening day. Didn't last, did it?
No, it didn't last. But I mean, I will say it did have a successful IPO advance phase that we talk about in the book. And now it's been an institutional due diligence phase. It just started showing it's been trading over 40 weeks now, and it's about 5% or so below the 40-week line. So I think it's one to watch to see if it's going to start that institutional advance phase. It'd be nice to see it create a base just over that 40-week line.
Yeah, could you just break down that institutional advance phase that you talk about? You have several phases in your book because when an IPO trades for the first time at list, it takes a while to get some price history in there and for institutions to do their due diligence and see if they want to buy it or not. Is that right?
Yeah, that's exactly right. The IPOs can have a really exciting initial advance when they first start trading publicly. But usually it's about 6 months to a year and sometimes 2-3 years where it just goes sideways, and often it undercuts that initial gain that it made and that initial base that it created, which Snowflake did. And so now we're really in that period where it could be transforming and switch from that due diligence phase, 6 months to a year or more, into an advance that may last 1 or 2 years or more. And that's what really I find is the most rewarding stage of the stock, really getting in there early, that first mature base when the institutions have decided this is the one I want to invest for the long haul.
Got it. Let's move on to FIGS here. Ticker, FIGS. Not as much price history, but it looks like it's breaking to the upside here.
Yeah, I wanted to talk about this one because this is a really interesting story. It's like the Lululemon for healthcare workers, for scrubs. You know, they wear these scrubs, and a lot of times they don't look very stylish or very comfortable, but now there's a solution for them, and it's FIGS, and it's already created a base, and it's in that IPO advance phase that I was talking to you about just a few minutes ago with Snow. So it isn't necessarily buyable right now unless you're a quick swing trader. You can find an early entry. It could come back to that buy point from that IPO base, since IPOs are usually very volatile, but it might have a nice little run. And then too, we'll be looking for an institutional due diligence phase like Snow 6 months, a year down the road. So I think this one definitely has some potential.
Yeah, I was at the New York Stock Exchange when it listed for the first time. That was just as we were getting back there. So nice swag. Thank you to the people at FIGS there. And now we got to tackle SoFi Technologies. This looks like this stock is in a trading range right now. So break this down for us, please.
Yeah, so this is a SPAC, right? So we don't have a lot of data. Are SPACs following the same patterns as IPOs? But I think this one is looking promising. It had an initial advance. We'll call it a SPAC advance phase, similar to the IPO advance phase. And then it's kind of been going sideways, and it's looking very positive here, like you mentioned, above the 10-week line. Be nice to see it create a little tighter consolidation. And yeah, you've drawn it there perfectly. I mean, it could be soon breaking out into new highs past that turbulence zone. We'll see. SPACs are still a different animal, but I think this one has some potential.
A different animal indeed. Zach, we're going to leave it there. Toss it back to you. And by the way, thank you for joining us today. Kathy Donnelly, co-author of The Life Cycle Trade. Zach?
All right, appreciate it, guys. Very interesting look at a lot of those newly traded companies. We're going to take another break here on the show, but when we return, it is decision time for the city of New York as we are digging into the results of the Democratic primary, likely to name the new mayor in a new ranked choice voting system. That is probably the first experiment here on the scale that we are about to see unfold. We'll dig into the race and who's leading on the other side. Stay with us. Well, in today's hot takes, the time has come for a experiment when it comes to ranked choice voting on the largest scale, New York's mayoral race here. And Akiko, when we look into it, it's interesting not just because of ranked choice voting, but also the way that it's going to shake out in terms of maybe alliances that could come from it. There's a lot of high-profile names, mainly Andrew Yang, who of course made a name for himself on the national Democratic primary scale in the last election cycle. But I mean, I don't know. There's a lot of different things here because it's already contentious when you hear some of the candidates here, mainly Eric Adams, coming out and talking about how some of these candidates maybe working together in the ranked choice system might be problematic. We're learning a lot about this in real time as the race wraps up.
Yeah, and for those who aren't as familiar, the ranked choice voting means essentially that voters can rank up to 5 candidates in the order of preference, and that's why we're seeing the candidates pair up now. But I guess if we broaden out this conversation, Zach, for those who are not in New York City or saying, why are we exactly talking about this race on Yahoo Finance, is because there are so many different implications we're looking at on a national level. It's been interesting to see how the polls have shaped up, and Brooklyn Borough President Eric Adams certainly leading in all polls right now, largely because he has made crime a key issue in the election. And every poll that we have seen in the city has shown that there are a lot of concerns about a rise in shootings, attacks against Asian Americans, attacks against the Jewish community. It's been interesting for me to see how the issues have shaped up, because that, we've been spending the last year talking about the economic impact. And if you look at that alone, in New York City, the unemployment rate is at roughly 11%. That's twice the national average, roughly. And so from an economic standpoint as well, this is really a critical race for the city. And obviously we'll have broader implications beyond that, just given how many businesses operate here.
Yeah, and you had a lot of people moving out of the city as well. Now, of course, New York isn't alone in that camp. Other big cities included, mainly San Francisco, as well as Chicago. But I mean, if you think about what the implications could be here too, there are a lot of people who just don't vote, who aren't actually in the system because they're not happy with the way that, if you have a fringe candidate, you might not be able to win. But at least in this system, ranked choice voting is kind of applauded and celebrated in the fact that it brings more people into the system. At least that's the hope, because even if your candidate doesn't survive the first round, you have an effect on the way that these votes go. So I think it will be interesting to see kind of what turnout we see in New York. Of course, yours truly not there anymore, can't participate in it, but I think it is kind of a needed experiment here to kind of prove this out on a larger system. We've seen this in other cities as well, but it's going to be interesting to see how it all shakes out and if it does deliver on the results, or at least the goal of bringing more people into the system.
Yeah, and what happens if the turnout isn't as high as expected? What does it mean for this type of system? But Zach, I will tell you, as somebody who's in the city, you cannot escape this race. There are so many ads playing on TV. I step outside my door, somebody's handing me a flyer here. So you could argue some people are just, they just want to vote to get it all over with. But we'll be watching the results and bring those to you as well.
Yeah, I got to say, it's nice to maybe not be around it. Maybe the takeaway is, if you don't want to deal with that, you can always just constantly move around every time an election comes up. But anyways, that'll do it for Akiko and myself here in our hours. Stay tuned. We got much more live coverage headed your way here, right here on Yahoo Finance Live.
Happy Monday and welcome into the 1 to 3 p.m. hours of coverage here on Yahoo Finance Live. I'm Kristen Myers, here as always with my co-host Alexis Christoforous, and here's a look at what is happening today. Now, markets waited last week for guidance from the Federal Reserve, which they did receive from that FOMC meeting, and today markets are hearing more from the Fed's James Bullard and New York Fed President John Williams. Now, we're going to have all the details and the breakdown of their speeches shortly. And cryptocurrency is on the move to the downside yet again as more headlines come out about China cracking down on the digital currency. Is this a time to buy or a time to get distance from Bitcoin? We'll be chatting that throughout the next 2 hours. And it is Amazon Prime Day. That's, of course, the company's 48-hour sale that brings in huge profits for the online retailer. But Amazon is going to have to continue to navigate without founder Jeff Bezos at the helm as Congress is taking aim at the company with antitrust legislation. We're going to have a conversation on Amazon with Amazon Unbound author Brad Stone this hour. But first, let's take a look at the markets right now, Alexis. A lot of green across the screen, a huge rally right now in the Dow, up over 500 points. Of course, this is coming after we saw a sell-off in the trading session on Friday after we had some comments from the Fed's James Bullard about a potential rate hike coming as soon as next year. Markets right now seem to be shaking all of that off, and a nice strong rally to start the week.
You better believe it, Kristen. Stock staging that strong snap back. As you can see there, the Dow up better than 500 points after logging its worst weekly decline since October. We've got shares of everything from banks to manufacturers moving higher today, with all 11 sectors in the S&P 500 in the green. The S&P now up 48 points. The Nasdaq Composite along for the ride with a gain of 91. Now, while stocks are rallying, we have bond prices retreating. The yield on the 10-year Treasury note now basically flat at 1.47%. We've got shares of industrial and financial stocks, which tend to be sensitive to changes in the economic outlook, helping to lead today's gains. Among them, we've got Morgan Stanley. Also rallying is Bank of America, Boeing, and Caterpillar, all higher today. Also, what caught my eye earlier was the online hiring marketplace ZipRecruiter. That stock having a really nice session today after analysts at Goldman Sachs and Raymond James gave that stock a buy rating. But as Kristen talked about at the top of the show here, we've got cryptocurrencies bucking the trend today. We've got Coinbase lower along with Bitcoin, Ether, and other smaller digital currencies. That's as China has intensified its clampdown on Bitcoin mining. We're going to talk more about the crypto sell-off a little later on in the show. But at least for now, Kristen, you can bet that investors are all ears listening to the parade of speeches today from some Federal Reserve presidents.
Absolutely. And of course, we did hear from the Fed's James Bullard last week, which did spook the markets a bit. So, of course, all ears and eyes are on some of those speeches today. We have Yahoo Finance's Brian Chung here with all of the details. Hi, Brian.
Interview from Friday where St. Louis Fed President James Bullard gave an interview to CNBC, and during his remarks we saw great volatility in the bond markets. Of course, we have to acknowledge that Friday was also a quadruple witching event, so there were other factors at play for maybe why markets were volatile, but that is expected to continue into this week, maybe not as a result of the quad witching, but as a result of the flurry of Fed speeches that we are scheduled to get. You'll recall that last Wednesday, the Federal Reserve had that decision to keep interest rates steady, but it was the dot plot, again, that projection of where policymakers see interest rates going in the next few years that got everyone all riled up. And you can see that the dot plots based off of how markets have been reacting have indeed caused quite a lot of waves in the market. Now, we've only heard from a few officials so far, but you can start to map out which dot is whose. So James Bullard telling CNBC last week that he sees the possibility of one rate hike by the end of 2022. So that's a red dot that you can put there on the 2022 dots right there. And then Neil Kashkari from the Minneapolis Fed saying on the other side of things, I don't see an argument for any rate hikes through that 2023 time horizon on that chart, which explains the orange again being pinned at the bottom there. But of course, there are 16 other members of the Federal Open Market Committee, many of which we will hear from this week. I counted at least 10 Fed officials making public remarks this week. We had 2 this morning. We actually had 3 this morning. And then we also have John Williams, a very critical component of the FOMC. He's going to be speaking at 3 p.m. So we don't exactly know what he's going to say so far. But you look ahead for the rest of the week, Jerome Powell, the Fed chairman, is going to speak in testimony to Congress tomorrow. We also have Mary Daly. She's an FOMC voter scheduled to speak tomorrow. And then for the rest of the week, Fed Governor Mickey Bowman, Raphael Bostic, Eric Rosengren, Bullard's going to speak again. And then we also have Loretta Mester and also Patrick Harker from the Philadelphia Fed. So all of these speeches could be potential opportunities for more volatility in the bond markets. As far as what's been going on so far today, I was taking a look at the 30-year. It seems like over the weekend it was flirting at around the 200 basis point level, but it seems like it's retreated a little bit from that, 207 basis points, coinciding with the traditional risk on attitude as equities are also going up. So it seems like for now, maybe bond markets are getting a little bit of more stability from the kind of crazy action that we saw on Friday. But again, through the rest of this week, need to monitor how these Fed speeches kind of change things. And of course, we'll have all those updates and relevant commentary right here on Yahoo Finance, guys.
All right. Thanks so much, Brian, for bringing us those details. We'll have you all week to update us on all of those speeches. I want to continue this market conversation now. We're joined by Stephanie Lang. She's a principal and chief investment officer at Homrich Berg. Stephanie, so let's just start with a lot of the comments that we've been getting from the Fed. We saw that sell-off on Friday after we heard from the Fed's James Bullard. And then, of course, now a huge rally today. How are you reading today's market movements, considering those comments that we had gotten from several Fed officials last week? Were some of those reactions, do you think, in the markets perhaps overblown?
You know, I do think that's part of what's happening today. Last week, it was a reality for the market to realize that we've really kind of hit that peak accommodated stance. And now that the Fed is taking the pedal off the gas. So the market, you know, immediately reacted. You saw the front end of the curve move up, the bottom end or the longer end move down. And so what that's telling us is that, you know, the Fed's going to step in earlier. We're going to see less accommodative policy moving forward. And with the long end moving down, there's really the expectation is that pedal to the metal with the Fed, there's less so of that. So we're going to see less growth going forward by the Fed accommodative stance. So I think investors were taking in that reality. There was that sell-off, but it was a little bit overdone and it was quick. So we really do think there's going to be more of this volatility looking forward as the Fed continues to drive the narrative of the market. And I do think, though, when there's those dips, investors are going to come in pretty quickly and buy on that news.
So, Stephanie, now that we know the Fed is going to be pulling back a little bit on the stimulus, we are going to be starting to get those interest rate hikes in the next year or two. What does that mean for corporate earnings? Do you think that they've peaked right now and has all the good news sort of been baked into the market already?
You know, I do think the peak growth is probably there in the market in terms of not only earnings, but GDP growth. We're going to get a print in the second quarter, you know, probably close to 9-10%. And then it's going to moderate in the second half. But we do think there's going to be a lot of momentum for the economy. And really, we think there's good momentum for earnings as well. I mean, you have housing, which has been strong, but there's been, you know, a lack of building there. So we think that's going to continue. We think that will create a wealth effect for consumers, which will continue to spend. Plus, there's $2 trillion on the sidelines for savings there. So that will continue to drive spending in the second half. But as far as earnings go, I think there's been tremendous momentum, which I think even though we may see lower growth rates moving forward, I do think that the beats have been way above expectation. It's the biggest beats in quite some time. And we think that momentum will continue to draw forward for the second half of the year. I do think some of the bigger high flyers are going to see some volatility going forward. And I do think as we move from early cycle to mid cycle, you will see some change in leadership under the surface and go from kind of these cyclical names to more defensive names in the second half.
Now, Stephanie, I was reading through your notes and you were talking about weakness as buying opportunities. Curious to know, where is this a time, to pile back into tech, for example? We had seen rotation out of that sector and a bit of rotation back into some of those big growth, big tech names. Or are there other perhaps sectors, companies, stocks that you're really liking right now?
I do think at this point in the cycle, when there's such strong economic growth, and as I mentioned, it's going to continue in the second half, and it's going to be above trend for next year. I do think for the time being, cyclicals are the place to be. I do think there's going to be a rotation as we move from the early stage to the mid stage of the cycle. And so when you move into that later stages or the mid stages of the cycle, I do think there's going to be a rotation into some of the defensive names. And so I think it's good to have exposure to both at this point. I like on the cyclical side, if you can take the volatility, some of the energy names, since you have the reopening economy, and also there's been some supply constraints. The number of rigs are not even to the point where we can break even in terms of demand. On the industrial side, I think earnings are going to be strong, not only this quarter, but going through the rest of the year in 2022. But I also think as there's this change in leadership and it's hard to tell the timing exactly, it's good to have some anchoring of your portfolio with more quality names that have strong earnings and some downside protection. So that can be dividend growth names, that can include some of these technology stocks that have shown that they can raise their dividend over time, because I do think there's going to be some volatility, and to have a good anchor in your portfolio to withstand some of that downside protection is going to be important in the second half of this year.
Now, I hear you. You're talking about making sure you've added some value names to the portfolio, but is there a place there for some crypto? I mean, we're seeing the crypto digital assets getting slammed again today. Bitcoin basically halved in the past couple of months. It was at $65,000. It's now hanging out at around $32,000. But, to go along with your thesis of these dips could be buying opportunities, do you feel the same way when it comes to crypto?
So our stance on crypto is that, there's going to be some winners and losers, and it's very hard to place on what the value of whether it's Bitcoin or other cryptocurrencies. So it's very hard for us to take a definitive stance and say that you should own Bitcoin at this price. And therefore, when clients come to us and say, hey, should we, put some Bitcoin in our portfolio, or should we buy on this dip? We really take the stance that we don't know the long-term play with crypto. Maybe the Fed comes in, maybe there's regulation that takes over, and there are going to be, big losers in this space. So if clients want to go in and take advantage of this dip, they have to be ready to size that appropriately in their portfolio and be ready to withstand volatility, because as we've seen, it can move a 50% move and in a very short period of time. So you have to be ready for whatever you're putting in the market to potentially lose. If you do think this is a long-term play that has legs and is going to be the next currency, for us to transact in, then you can take a piece of your portfolio and put it into the crypto space. But we're not, big advocates of the crypto space and have been quite cautious on Bitcoin and other cryptocurrencies.
All right, we'll have to leave that there. Stephanie Lang, Chief Investment Officer at Homerichberg, thanks so much for joining us today. And coming up after the break, it's Prime Day. We'll be chatting Prime Day and Amazon right after this with Amazon Unbound author Brad Stone.
Welcome back. It is Amazon Prime Day, which has really morphed into a two-day sale that brings huge profits for the e-commerce giant. And it's also the company's last Prime Day with Jeff Bezos at the helm as CEO. Here to talk about what's next for the world's richest person and for the company he built is Brad Stone, author of the newly released Amazon Unbound, Jeff Bezos and the Invention of a Global Empire. Brad is also senior executive editor at Bloomberg. Good to have you here, Brad. Thanks for being with us. I know this is your second book on Bezos and Amazon. Your first was back in 2013. So I'd like to just start with your perspective, having written both those books. What do you think the biggest change has been, both for Bezos and for Amazon, over the past 7 years?
It really is just a different company. He's a different executive. He's a different person on the world stage. It's almost impossible to just identify one change. I guess if I had to, I'd say it's a much more global company right now. We see the bets that Amazon is making in countries like India and Brazil and Mexico. You know, today is the first day of Prime Day. This is now an international holiday. The first Prime Day was back in 2015. It starts in Asia. It kind of rolls across the globe as people wake up. You know, and the company's so much larger. When I finished The Everything Store, my first book about Amazon that came out in 2013, this was an $80 billion company. And as you guys know well, it is now a 1.6 or maybe even a $1.7 trillion company right now. And Bezos, about to give up the CEO spot, is a global figure and the wealthiest person in the world. So a radical change.
Now, Brad, curious to know how you think, and perhaps how even Amazon itself, a lot of the executives there, are really thinking about navigating Amazon in the future without Jeff Bezos at the helm of the company.
Right, and they're losing a lot without him in the CEO spot. But I'm going to make an argument that maybe they're gaining something. First of all, what they're losing is obviously the architect of the culture, the innovator in chief. I tell the story in the book of the creation of Alexa, the Amazon Go stores, those cashierless grocery stores, the initiatives in India and Prime Video and Hollywood. And Bezos is at the center of all those stories. You unravel, you peel back the layers of the onion, and they tend to start with his ideas and sponsorships of these initiatives inside the company. But as you guys have talked about, Amazon is moving into this era of so much greater scrutiny. We've got these new bills in the House subcommittee now on antitrust, an Amazon critic being appointed the chairwoman of the FTC, antitrust scrutiny in Europe. And Jeff Bezos, he presents and of course he has to, as the wealthiest person in the world, you know, this figure who kind of represents income inequality and so much division in American society. And so I think, you know, he will remain at the company as executive chairman, but you have Andy Jassy, who I think will just present a humbler target for Amazon as it attempts to navigate this new era of heightened scrutiny.
You know, you talk about those antitrust issues the company is now facing. You do have a Congress that has made no bones about it. They're looking at possibly breaking up big tech and Amazon among them. Having covered the company the way you have, do you think that that's a real reality for the company? And if so, what might a breakup at Amazon look like?
Yeah, I think an enforced breakup by the federal government faces some very long odds. You look back at Microsoft in the 1990s when it had dominant market share of the operating systems market and had clearly engaged in illegal behavior to extend its dominance in the web browsers, if people remember that. And that case dragged on forever, and Microsoft won an appeal, and today it's even a larger company than Amazon. And Amazon isn't, the argument for monopoly isn't as clear cut. It is competing in these very large markets of retail and cloud computing, and it doesn't have the same market dominance that even Microsoft once did. So I think the argument for breakup, even though some Amazon opponents are suggesting it, is difficult. I do think there are plenty of ways that Amazon's behavior, the way in which, for example, it privileges its own products in its marketplace, I think some of that behavior can and will be addressed. But I don't see a breakup other than perhaps a voluntary one down the line if Amazon executives decide to unlock some shareholder value by, for example, spinning off AWS.
So you were just talking about, Jeff Bezos really as the innovator in chief at the company. Curious to know what you think might be the next big thing, really, that's coming out of Amazon, where they're going to be focusing all of their time and attention. I know Jeff Bezos right now is focused a lot on space exploration, but for Amazon itself, what do you think is going to be the next big product that we might be able to expect from the company?
Right. Well, you mentioned for Bezos, he's strapping himself to the top of his New Shepard rocket in a couple of weeks. So obviously, even though he's giving up the CEO chair, all eyes will continue to be on him and what he's doing at Blue Origin, at the Washington Post. And as he said, he'll continue to sponsor new products at Amazon. I think, today is Prime Day, and you look at the kind of discounts that Amazon is offering, and it's all about Amazon devices, Echoes, it's Amazon basic products, Ring, surveillance, doorbells. I think that's the future for Amazon, diving deeper into devices. We know that they've been working on a robotics project for a long time there, that they have yet to unveil a home robot. Bezos has been sponsoring a project inside Amazon called Project Kuiper, which is designed to release a constellation of satellites and offer internet access in competition with SpaceX, which of course has Starlink. And then you look at some of Amazon's initiatives in healthcare, online pharmacy, some of the telehealth and walk-in clinics that they're developing, and some of the devices that are meant to kind of link back to Amazon's healthcare offerings. And so I think that's a major avenue of expansion. Look, as a $1.7 trillion company, you need large markets to be able to continue to grow and expand. And I think that's where Bezos is really going to continue to focus his efforts at Amazon, finding those big next opportunities for growth.
All right, Brad Stone. The book is called Amazon Unbound. Thanks for being with us. Coming up, more drama swirling around executives at the beleaguered electric truck startup Lordstown Motors.
Welcome back. Well, it's been revealed that executives at the electric truck company Lordstown Motors sold stock ahead of their quarterly earnings when the company revealed that losses were double analyst expectations. We have Yahoo Finance's Emily McCormick here with the details on what seems, Emily, like potential fraud. That's what it seems like. What are the details of the story?
Well, Kristen, as you mentioned, some really troubling optics coming out of Lordstown Motors. Of course, the company revealing in a filing that a number of its top executives sold stock before reporting financial results last month in a move that really just adds concerns for this electric vehicle maker that we've been seeing over the past year to date, really. Now, we should note that these share sales were disclosed in filings first reported by the Wall Street Journal. But to go through what we know so far in terms of some of the personnel involved, John Vo, who leads the company's propulsion unit, sold more than 99% of his vested equity in early February to bring in proceeds of more than $2.5 million. We also saw Lordstown President Rich Schmidt sell more than 2/3 of his own vested stock over a 2-day period, also early on in February, to bring in proceeds of $4.6 million. And then we also saw other significant executives within Lordstown, including its former chief financial officer, who just resigned last week, also sell some of his holdings early on in February as well. Now, the issue of these sales is mostly around their timing. Usually insiders and company executives would be subject to a blackout period where they can't sell their shares right before or in the months and weeks preceding a quarterly report. And we know that these all took place in early February, and we just received quarterly earnings results, or quarterly loss results, I should say, from Lordstown Motors that came in much worse than Wall Street analysts had been expecting. So this really is a question of optics here, Kristen. But of course, when it comes to just what this company has been going through over the past several months, still dealing with that fallout from the short report from Hindenburg Research, which of course said that the company was promoting fake pre-orders for its upcoming electric truck. Lordstown did admit last week that it actually does not have any binding purchase orders for these trucks. And of course, it's also dealing with a couple of subpoenas from the U.S. Securities and Exchange Commission. So taking all this into account, perhaps no surprise to again see Lordstown Motors shares sliding in today's session and adding to losses of about 50% so far for the year to date, guys.
All right. Thanks so much, Emily McCormick, for bringing us all of the details on that story. And coming up next, Bitcoin has taken a bit of a tumble. Does this mean that now is the time to get into Bitcoin? We'll be chatting about that next.
Crypto prices continue to crater on Wall Street despite the broader rally we're seeing in the equity markets today. Bitcoin is down another 7% right now and is down about half from its peak that we saw back in April. Remember when Bitcoin was above $65,000? We also have other smaller digital currencies following suit. This is as China expands its crackdown on Bitcoin mining. Joining us now is John Wu. He is president of Ava Labs. Good to see you, John. Thanks for being with us. I want to start with the latest out of China because authorities in the Southwest province ordered Bitcoin mining projects to shut down. What are the larger implications there for cryptocurrencies? And do you think that investors in the space are overreacting a little bit?
Hi, nice to be here. So first of all, China cracking down on Bitcoin cryptocurrencies is actually nothing new. Basically, a decentralized computing source as well as distributed governance is almost antithetical. It is antithetical to what the Chinese Communist Party believes. What they want is more control. And simply put, when you have a decentralized currency like Bitcoin, it reduces their effectiveness in terms of capital controls. And China is one, as we all know, has hugely strict capital controls. So them coming down and attacking the Bitcoin miners is really not a surprise. They did it in 2013 against the banks. They did it in 2017 against exchanges. And they started the mining narrative, actually cracking down on miners in 2019. This is just the latest in their effort.
So, John, is this dip that we're seeing right now, is this a buying opportunity for Bitcoin as you're seeing it, or do you think that it could actually go even lower than it is right now, perhaps in the 20,000 range?
So, obviously, the short-term impacts due to the noise related to the government announcements will not help. But this sell-off recently this is just another example of the recent worries in the macro environment. First, it was we're printing too much money in the US. The rest of the world is printing too much money. Then you had US potential regulation against not just Bitcoin, but against various things out there. And the fear of that, capital gains taxing, fear of more taxing in general, led people to take profits. So that started with the 30 times sales SaaS companies. Then we saw, you guys just had a moment about Lordstown Motors. That was a SPAC. So a lot of the high risk related industries all sold off. Crypto and Bitcoin is part of that last 2.5, 3 month movement of higher risk, more speculative asset classes selling off. As it relates to today's news, again, with China, they are far more focused on their own central bank digital currency, the digital yuan. That they love the best aspects, which is transparency, but they want to take the control of the network. So that's why decentralized and a distributed governance scenario with Bitcoin is their enemy. However, they are deploying the digital yuan and using the best parts of blockchain technology in order to get more control. We should be very worried about this in the US in general. And the fact that they're going to crack down on the miners, in my opinion, is a good thing, because there are great new companies in Texas who are going to take up the slack here. There is great solar as well as wind power that is very cheap and renewable. And if we can have more hash rate in the US, these are professional managers who've done data centers for a long time and can contribute to the grid in Texas or in upstate New York for hydro.
John, I want to get your thoughts on something happening with crypto that's pretty technical, and it's called the death cross. And I know that sounds really ominous, but it means the average price over the last 50 days for Bitcoin fell below that of its 200-day moving average. And that indicator is typically seen, as a closely watched technical measure for where that cryptocurrency is going to be going in the future. Most see that as a bearish signal. Do you think that that's the case this time?
Right. So the technical analysis people have used the same death cross, regardless of what asset class. They've used that as a chart as an indicator. Well, in this case, this time, if you look at the sell-off now versus a couple of weeks ago, there was high volume a lot of weeks ago. There was a lot of leverage in the system. Right now, it just seems like there's a lack of buyers because the volume is not as big. The curve for the futures is not really in huge contango. Another indication the forward outlook is not as great as it was in the past. So I do feel that there is some worry in the short term. However, I don't think anyone should worry about the future of the blockchain technology and where prices will be in the medium to long term. Reality is there's more and more utility, and the utility is coming and looking at things like Ethereum, like other first layer protocols like Avalanche. So there are plenty of DeFi, NFTs, as well as other use cases now sprouting up. So some of the Bitcoin lack of enthusiasm, if you will, is partially the regulation in China, but also because there may be other things that they need to look at because utility is just down the corner.
So I want to ask you about some of the other cryptocurrencies. I know we've been focusing a lot on Bitcoin in this conversation, but we were looking at the cryptocurrency chart not too long ago. We're seeing some of the other cryptocurrencies taking a leg lower. There it is, Litecoin, Ethereum, Dogecoin, all in the red right now. How should really investors be considering some of these other digital currencies? As we go forward, it does seem as if what happens with Bitcoin does have these knock-on effects with some of these other cryptocurrencies, even if they're not being targeted specifically.
That's right, Kristen, you're right. There is high correlation in the space still, just like other asset classes. When one big growth SaaS stock sells off, the others usually will follow along with it in some level. But if you look at the underlying metrics like unique visitors or addresses being created on the DeFi protocols like Ethereum, Avalanche, and some of the others, you'll see that users and interest is actually picking up even though prices are down. So prices coming down is actually in a weird way beneficial to people who want to operate and grow the functionality in the space. That's what we're doing here at Ava Labs for helping the Avalanche protocol, and I know others are doing the same. And I'm telling you, the traditional finance world is taking note of this, and they will be looking at more applications that they can have for use cases as well in the near term. So yes, short term, a little worrisome. Medium term, long term, there's $70 trillion of millennial capital that will be coming towards this space in the next, call it 5 to 10 years.
Yeah, great insights. John Wu, president at Ava Labs, thanks so much for being with us today. Coming up, the race to offer groceries to your doorstep in a matter of minutes. We're going to speak with the CEO and founder of Joker next up.
Welcome back. Well, New Yorkers can now get their groceries in 15 minutes or less. You heard that right, 15 minutes or less, thanks to the instant grocery company Joker. We're joined now by Rolf Wenzel, Joker CEO and founder. So let's just start here, because it seems honestly impossible to me to think that I could get my groceries in 15 minutes or less. How are you guys able to operate like this? How does it work that you're able to get groceries to people's door in less than 20 minutes?
Yeah, thank you so much for having me, first of all, and happy to introduce our Joker business to you. So what we are doing is we are a group of founders, entrepreneurs, and operators that have come together to really reinvent retail, to build a next generation online retail model whereby we directly procure predominantly local products from local suppliers, local distributors, local producers, aggregate them into our own distribution and fulfillment centers, build out a very narrow network of delivery hubs throughout the city, and then being able to deliver to end customers in less than 15 minutes at very comparable and often significantly cheaper prices as compared to offline retail stores.
So that's interesting, because I think you hit it there, the price point, right, Ralph, that you're saying that you can actually undercut some of the bigger retailers. Tell us how you're able to afford to do that, because I think when people think you're procuring things from local folks, while that might be really great trying to help the local community, I think people feel that they're going to be paying a premium for that.
Well, I think one of the dilemmas of the current online retail models is that fulfillment takes too long. People are not as patient as to wait hours or days to get things delivered. The second dilemma of online retail is that price points are often significantly higher than an offline retail, often attached to a delivery fee. And the third dilemma of current online retail models is that they're hardly economically nor ecologically sustainable. So we are trying to clean up and to really come up with a proposition that is instantly delivered, that is locally appreciated, that offers cheaper price points as compared to other online platforms or offline platforms, and to build a proposition that for the first time is measurably economically, but also economically more sustainable. And we're doing that by cutting out current middlemen, by using technology, by using data, and by actually leveraging our expertise of having built various online models over the last 20 years and bringing all of that expertise now together for what is meant to become a better and a bigger proposition than most current online retail models.
Now, I know that your company is not terribly old, but curious to know what some of your growth and some of your expansion plans are. I can see Joker working in a place like New York City or Miami or LA, San Francisco, but is there an interest to tap into some of these more rural and suburban areas, particularly as so many people have fled the cities and are now living in some of these more suburban areas?
So first and foremost, we think about Joker as a global platform that is geographically agnostic and also agnostic to the type of city and to the type of cosmopolitan and metropolitan area. We've started to build out the business in Europe and in Latin America, and recently launched New York City as our first US city, as our market entry to the United States. But from here, we are expanding throughout a number of additional cities in the US East Coast, but then also further expanding towards the West Coast and other cities in the heart of the United States. And it's a model that will work in essence in both the large metropolitan areas as well as like the smaller ones. And again, the proposition of instant delivery, local products, and something that is economically and ecologically more sustainable at equal or cheaper pricing points is something that attracts customers not only in the larger metropolitan areas.
Ralph, I know that you founded Food Panda, and other folks on your board and part of the company worked at places like Walmart and Blue Apron and Fresh Direct. How are you using that expertise to leverage technology, like you say, and data to provide a better experience for people?
I think we all have worked, as you rightly said, in a variety of different online consumer companies. whereby we could only always influence a specific part of the customer experience, be it the ordering process, be it the last mile delivery component. Joker now allows us to really influence the end-to-end experience from the procurement of the products up to managing the inventory in our own warehouses, employing our own rider personnel, and with that also guaranteeing a consistent and high quality on-time delivery of the products to the customer. So what basically combines the passion that all of us have coming from different consumer companies is really the ability to influence and revolutionize the whole end-to-end experience from procurement to delivery to the customer's doorstep.
Are there any interest in going public or perhaps in being acquired? I can think of several companies right now that are trying to break into this grocery space that might find what Joker is doing very interesting. Is there an interest to be acquired by one of those companies?
Well, we're not even 6 months old, and we're focused on building out our own business. We have an excellent team. Those very strong investors that have started to back us have confessed that we are the fastest growing business that they have ever seen in their investment lifetime. So I think we have a great future ahead of us. We're not thinking about exits or selling the business to someone. We're passionate operators ourselves. We are software developers. We are supply chain experts. We are marketing specialists, and we've all come together to really build a new standard of online retail. Amazon has set the standard for same-day delivery some years ago. Joker will be the company setting the standard for instant local product delivery.
All right, Rolf Wenzel, Joker CEO and founder. Congratulations and good luck to you guys as you continue to grow. And coming up, athletes have now claimed a huge victory thanks to a Supreme Court ruling against the NCAA that allows athletes to get paid. We have the details on that next.
Oh, hey there. I am back. Welcome back to Yahoo Finance Live. The Supreme Court today ruled that strict NCAA limits on compensating college athletes violate U.S. antitrust laws. It's a decision that could have far-reaching implications for the future of college sports. And Yahoo Finance's Alexis Keenan is here now to break this decision down for us. Alexis?
Hi, Alexis. So this is all over what's called amateurism rules and those harsh rules that the NCAA and other conferences like it put on student athletes to say you can't take certain types of compensation in exchange for your participation in college sports. Now, the question here is really whether they can prohibit that compensation. And this unanimous decision from the Supreme Court, where all the justices said, no, the NCAA, you and other conferences, you cannot ban what is education-related compensation. This affirms a Ninth Circuit Court decision that held the same way, essentially. And in this case, the NCAA was saying it should be exempt from the traditional antitrust analysis. The organization said that the non-compensation rules are really foundational to the organization. It preserves its real essence and that it's an amateur organization. Now, the former student athletes in this case, they argued that that rule violates a law against contracts that restrain trade or commerce. So the impact here from this case and this settled now decision is that the athletes student athletes at colleges, at universities, they now can accept limited benefits. Those are things like they could be for scholarships. Also, graduate scholarships, the court said they can accept. Also, tutoring, also paid internships, post-eligibility period. So that's really different. They can have things like school supplies, computers, costs of incidental things incidental to participation in the sports. That includes travel and also travel expenses for family as well. Alexis?
So, Alexis, I want to ask you about some of the things that the Supreme Court pointed out in their ruling. One of them pointing out some of the top jobs within the NCAA. Explain a little bit more about that.
Right. So while this is not really central to the court's analysis and the decision they came up with here, the justices did point out that the people who run the NCAA are profiting in a far different way than the athletes that they're overseeing. So if we take a look at the salaries for, you can see there on the screen, the top conference commissioners, the court said they earn from $2 million to $5 million in salary annually. Also, they pointed out athletic directors tend to make around $1 million. Then they pointed to Division I football coaches, who we all know are compensated quite well, earning nearly as much as $11 million a year. Also, they pointed out that the NCAA's March Madness contract alone for their television rights is worth $1.1 billion annually. So certainly that came into play. There was a lot of discussion about the compensation that is not going to the athletes, but is going to the folks that are running this organization and the other conferences as well.
All right, Alexis Keenan, thanks for breaking that down for us. And coming up next, labor shortages aren't just impacting the restaurant and hotel industries. In the next hour, how the airline industry is having a tough time finding workers and what that could mean for your travel plans this summer. Plus, a little later on, we're going to hear from the CEO of MassMutual about how the pandemic has lots of folks rushing out to buy life insurance policies. We've got the Dow Industrials now up better than 600 points. Nice snap back after last week's big sell-off, the Dow's worst week since October. Broader market playing along as well, with the S&P up better than 50 and the Nasdaq now up by triple digits, gaining 113 points. Stay with us. Kristen and I are back right after this short break.
Welcome into the 2 p.m. hour here on Yahoo Finance Live. I'm Kristen Myers, here as always with my co-host Alexis Christoforous, and here is what is happening today. Well, markets waited last week for some guidance from the Federal Reserve, which they did ultimately receive after that FOMC meeting. And today, markets are again going to be hearing more from the Fed's James Bullard and New York Fed President John Williams. We'll be discussing market reactions to comments from Fed officials in just a moment. And the Delta variant of the coronavirus is keeping borders closed as the United States is bracing for a potential surge of that variant among unvaccinated Americans. We'll be talking about how concerned you should be with a doctor in just a couple of minutes. And Mass Mutual CEO Roger Crandall stopped by Yahoo Finance to chat about the life insurance business during and after the pandemic. We have that conversation coming up this hour. But first, a quick look at the markets right now as we are seeing the Dow rallying up over 600 points right now on a sector basis. Energy up over 4%, industrials and financials also giving a nice boost to market. Industrials up over 2%, while financials is up about 2.25 percentage point. Well, let's turn to Yahoo Finance's Jared Blickery for a look at some of the trending tickers. Jared, let's start with Bitcoin, not a ticker per se, but let's start with the digital currency. Of course, we've seen Bitcoin taking a leg lower after some headlines out about crackdowns in China.
Yeah, and it was not the greatest weekend for Bitcoin, not a stock admittedly, but I think it's telling that we're beginning with the show, kicking that off. A nice day for stocks, by the way. We can get to some of those in a little bit, but I want to go to the Wi-Fi Interactive because I'm looking at some price action over the weekend that was not too constructive. This is a year-to-date chart. Well, let's get actually down to Bitcoin here, and there we go. This is that breakout top that we saw fail, and here we are resting at about 30 to 32,000, that potential support. But I'll tell you what, we just got a death cross. And what that is, you take the 200-day moving average, and we're going to plot that. You can see it's been acting as resistance here, and then we're going to plot the 50-day moving average. You can see that one's a lot more tighter, but you can see it's been in play as well. And when it crosses below the 200-day moving average, as it is here, it's called a death cross, and it tends to lead to more downside price action. I will say in the short term, over the next few days, it could be a contrary signal, so we might get in a little bounce up. But if we take this down to a 2-month chart here, probably going to be pretty difficult to get out of the $40,000 to $45,000 price level here for Bitcoin. Before we go on to the next, I just want to show Dogecoin as well. And here's our crypto heat map that I'm going to pull up. Doge has been selling off, and the Dogecoin off 24% over the last 24 hours, hovering around the 20-cent line. So some of these altcoins seeing some weakness as well.
All right, I want to switch gears and talk a little autos because I know there's a bullish analyst note out about GM and Volkswagen and how they're aggressively making a push into EVs. What can you tell us?
That's right. It's on the entire EV industry and Ford as well. I'll put them in there. But GM and Volkswagen is the center of this analyst report. And those stocks have been outperforming other stocks like Tesla in the industry. So here's what Bank of America is saying. For the overall industry in terms of nameplate offerings by powertrain type, internal combustion engine is still dominant. We know that, but the lead is shrinking. So they're saying that EVs now occupy the second position as a result of focused product efforts. And while hybrids still account for a little over a quarter of the powertrain offerings, they appear to be shrinking in relevancy. And that's because the ICE vehicles, internal combustion engines, they're becoming close to parity when it comes to cost with respect to EVs. Also, they say that startup electric vehicle makers may make some headway as well. And they're talking about the pipeline of standalone EV names expected over the 4-year period to also reflect some of the results of the newer industry entrants. This would be Rivian, Lucid, Fisker, Lordstown, Canoo, Arrival. And so while a lot of these companies are trying to beat Tesla or replicate their success, the analysts writing, while a few may be successful, we note the competitive environment is fierce among incumbents and entrants. And we know some of those names have been hit harder than others recently, like Lordstown Motors. But let's pull up a chart of GM here before we get the next ticker. And you can see year to date still down about 10%, but bouncing off those May lows.
All right, Jared, talk to us about a really interesting deal that is happening between Steven Spielberg and his production company and Netflix.
That's right. He's coming to Netflix. In fact, he's already been there. They had a partnership last year for the trial of the Chicago 7 and also a biopic on Leonard Bernstein that hasn't been released. It's still in post-production. But this is a new deal, and it's going to be a multi-year agreement. And they're seeking more hits, and they want to attract subscribers. As we know, Netflix stock not reacting today, at least to the upside. It's down about 1%. You can see year to date, still been hugging those lows that it's hit several times over the last year. And if you take a look at a one-year chart, still looking pretty choppy. It got a really nice boost, you'll remember, early in the pandemic, and then it's just been flagging sideways. So maybe you need a little bit more of a catalyst here for Netflix, but one of my all-time favorite directors, I got to say, coming to Netflix is going to be really interesting. I love his movies.
They are definitely tying up all the big names, Netflix, in an effort to stay competitive. Want to get to the Yahoo Finance Plus investment idea of the day. It is Lennar, that is the home builder. They are, of course, benefiting from the boom we're seeing in the housing market. So perhaps not a great surprise that there's a bullish call there, Jared.
Exactly. The home builders have really been on fire. Now, you can see it's off a bit from its highs. This is over the last 2 months and down a little bit today. Nevertheless, Argus Research likes the name and they like the space. And here's a little bit of the reasoning. They're saying they have a long-term price target of $115, and they're raising their estimate. So I'm going to skip a little of this and just go on to some of the reasoning. Sales, gross margins, earnings, and new orders better than our estimates and consensus. Guidance was solid. Management updated on its previously announced plans to spin off some of their other business in order to become a pure play home building and financial services business with smoother earnings. So kind of simplifying the business line there. So here's something that Executive Chairman Stuart Mills said. Housing markets remaining very strong across the country, even as interest rates are heading higher. And this is helped by strong savings, government stimulus, and a return to normalcy. So they're seeing higher margins and higher selling prices for its customers. And here you see, let's take a longer term look at this one. Here's a 1 year, up 61% over that time period, guys.
All right. Thanks so much, Jared. We'll see you a little bit later on in the show. I want to keep this market conversation going. We're joined now by Alfred Eskandar, Salt Financial President and Chief Operating Officer. Alfred, always great to have you here with us. I want to start with what we're seeing in this huge rally right now. The Dow has pulled back a little bit from its gains, but it's up just about 575 points right now. Of course, we had seen a huge sell-off in the markets on Friday. Curious to know how much you see the Fed itself really as being, in a way, a risk to equities, or was the market reaction last week perhaps a little bit overblown to some of those more hawkish tones that the Fed struck?
Well, Kristen, good to be with you again. It was fun. I think last week was just the market's way of showing that it got a little bit, flat-footed. No one expected the mark and the conversations coming out of the FOMC meeting, and it was more hawkish than the market was hoping for. So when you move interest rate hike potentials, up by almost a full year, there's going to be a bit of overreaction. What should also be mentioned was Friday was also triple witching. So you had a lot of futures options and indice expirations all happening at the same time, which also didn't make the market any easier to trade, and we had a big spike in volatility on Friday. So it all made for a pretty tough day. And today, what we're seeing is just the market, collecting itself over the weekend and coming back and recognizing that some of the comments were incredibly positive for the economy. Certainly, the GDP estimates, where initially thought would be 4.5%, and now looking more like 6% GDP growth for the year.
So, Alfred, we're looking at the sectors today, and all 11 of them in the S&P 500 are in the green. We spoke to a market strategist last hour who said, you know what? I think we've reached peak earnings, at least for now, because the economy is really going on all cylinders. When the Fed starts to take its foot off the gas, we're going to have to see the effects play out in the bottom lines of companies. Do you believe that earnings have indeed peaked, and what do you expect in the next couple of quarters?
I certainly can't challenge that, but when you look at the overall economy in general, and you've got unemployment trending down the way it is, you have demand and certainly a ton of cash on the sidelines. There is still a lot of tailwind here for this economy to continue to recover faster than people think. Obviously, the big question is overheating. The comments last week showed that inflation was a little bit ahead of what they had expected, hence the comments. So at 3%, it could cause some jitteriness in the market, certainly some additional volatility. But I think overall, the number of positive signs for growth versus any kind of headwind is in favor of investors being having equity exposure right now.
Alfred, I would love to ask you about cryptocurrency. Jared led with it when we were talking about what's trending. We're seeing Bitcoin falling after some of the headlines around China. It's actually been many of the reasons that Bitcoin has fallen quite a bit over the last couple of weeks. It's not that, it's always a tweet from Elon Musk. How do you think investors right now should be approaching cryptocurrencies, Bitcoin and some of the others like Ethereum, Litecoin, perhaps even Dogecoin, considering how volatile these assets get, sometimes not so much around the technicals, but just around some of these headlines?
Yeah, I agree. I mean, put the technicals aside for a second, and let's understand who's really involved in crypto, whether it's retail or institutional. Certainly, corporate treasuries and long-term institutional investors will have a problem with the volatility. You've got an asset class that's down 20% in the last 5 or 6 trading days, down 50% from its high, which was about 3+ months ago. It's just simply too volatile to hold on your balance sheet. So that's another challenge for it. Christian, you and I have spoken about crypto a number of times on and off the air. I don't have a crypto as part of my portfolio. We at Salt, we don't look at that even personally, but it is attracting a ton of attention. Obviously, there's even more retail investment boards. Even some of the institutional portals like Tapforum has a dedicated section just to crypto. So it is capturing the imagination, but I do believe the volatility is too much to handle for long-term institutional guys at the moment.
All right, Alfred Eskandar, Salt Financial President, Chief Operating Officer. Always great to have you with us. Thanks so much. And coming up next, we'll be bringing you the latest in the coronavirus pandemic as the Delta variant of the virus continues to surge around the world.
About 45% of the U.S. population is fully vaccinated against the coronavirus, and cases are declining in a number of states. But public health officials are warning today that the spread of the highly contagious Delta variant among the unvaccinated could pose a new threat. The Delta variant, which was first identified in India, now accounts for up to 10% of new cases in the U.S. Joining us now to talk about it is Dr. Susanna Hills, pediatric airway surgeon and assistant professor of ENT at Columbia University Medical Center. Doctor, thanks for being with us. Let's start with this Delta variant. How much of a threat is it, do you think, and could we be in for yet another wave of this virus in the coming months?
Yeah, I think one of the easiest ways to figure out where we're headed is to look actually at what's happening in Europe, because throughout this whole pandemic, the pattern that's evolved is what happens in Europe tends to happen here in the United States a couple of weeks to months later. And what we've been seeing in the United Kingdom is a surge of cases with association with the Delta variant. The Delta variant is now the dominant strain in the United Kingdom. So here in the United States, only about 10% of cases in the US are attributable to the Delta variant at this point, but case numbers are doubling about every 2 weeks. And we can expect to see, given that this variant is more transmissible than the other variants that we've seen, and that it tends to make people more sick, there are more hospitalizations associated with this variant relative to the other strains of the coronavirus, that we'll have more cases here in the US, and it's probably going to become our dominant strain. That being said, it's really important to remember that the vaccinations that we have, the vaccines that we have work really well against this variant. So, but you do need 2 doses, but those who have 2 doses are likely to be well protected.
That is if you are vaccinated, of course. While the vaccination levels have been rising in some states more than others, we still have a vaccination level that's only just over half in the United States as a whole. So curious to know if perhaps lifting some of those restrictions that we've seen. I literally was just looking at pictures the other day of a completely packed and full Madison Square Garden. Did those restrictions come off just a little bit too soon, considering that we're hearing that the Delta variant is more contagious and can be more severe?
I do think that our case numbers nationally have been incredibly low. So, I think lifting restrictions, particularly in the summer, giving people a break, letting people have some social interaction, I think it's a reasonable choice right now. Our case numbers are really at a reasonable level. But I think my main concern isn't so much where we're at now, but it's the message that's going along with these reopenings. There seems to be a message that we're done with this pandemic, and that is for sure not the case. So I think while case numbers are really low, it's fine to decrease some of the restrictions that are in place, but we've got to be ready to re-implement restrictions and respond as case numbers trend in the wrong direction. And I think we're going to see for sure, with less than half of the United States fully vaccinated, that we will have more cases. Many of these cases will likely be the Delta variant. And I'm concerned also that our pediatric population, which hasn't had the opportunity for vaccination for kids who are 12 and under, will also be at risk for increased numbers of cases with the coronavirus. And there was a study that just came out today in the UK. There's a second study from the UK corroborating what came out today, showing that pediatric cases were probably the driver of this recent surge they had from May into June of COVID cases associated with the Delta variant. So I think it's okay, and I'm glad people are out having a summer and enjoying themselves. But I think we've got to not mislead the U.S. population with the message that we're done with this pandemic. We're not, and we've got to be ready to take a step back when we need to.
That's really troubling, that study out of the UK about younger folks who are not able to be protected yet with the vaccine, the ones who are now spreading that Delta variant. But talk to us about Moderna's plans here to expand production to make COVID-19 vaccine boosters. For those who have been fully vaccinated, any more clarity on if and when we're going to be getting those booster shots?
We don't yet have enough data to really know how long the vaccines that we're giving right now last. But the CDC and federal health departments are working really, really diligently to figure that out. And I think the key here, what I love about this is that they're planning for the need for boosters, which I think are almost a certainty in our future. We know these vaccines are not going to last forever. We'll probably need a booster at a year or a year and a half or something like that. As we get more ongoing data, that will be shared. We'll have a plan, but I love that there's a plan for the future with this. I also love Moderna's plan to send vaccinations that are in excess globally to other countries. And I think that also has to be part of our protective plan for the world and for our country, because we're not going to be safe from this virus until all of us are in a safe environment, until we have this virus under control globally. And cases went from 120 million to 150 million in the last 6 to 7 weeks globally. And when you look at what's happened in India and in Brazil, it's really been devastating. And I love that Moderna is planning to send vaccine doses globally. I think we should be really focused on trying to do that as well.
An important reminder, we are not out of the woods and we are still in the middle of a deadly pandemic. Dr. Susanna Hills, thanks so much for joining us today. Coming up next, the CEO of MassMutual joins us to talk about how the pandemic has sparked a surge in demand for life insurance policies. We're back right after this. The pandemic continues to be a wake-up call for Americans to buy life insurance policies. In just the first quarter of this year, sales of life insurance policies jumped 11%. That's the biggest gain in nearly 40 years. And people of all ages and income levels are buying these policies. I recently spoke with MassMutual CEO Roger Crandall about that trend and what it's meant for his business.
The interest in life insurance is up. I mean, COVID certainly got people thinking about the need for life insurance and protecting their families. So MassMutual, I'm really happy to say we're seeing sales even stronger than that. We were up well over 20% in the first quarter. Again, life insurance is not something that most people think about, but we know that there's about 100 million Americans who either don't have life insurance or who have it and tell us in surveys they know they need more. Everyone wants to protect their families. For MassMutual, as the name implies, we're a mutual company. We're effectively owned by our policy owners. So way back in 1851 here in Springfield, 31 people put some money together, started selling policies to friends and neighbors, and now we have 5 million friends and neighbors and $29 billion of capital above and beyond the reserves for those policies. So MassMutual's been growing, and it's been one of the it's horrible to look for positive things in a pandemic, but people recognizing how life insurance can help their families has certainly been a good one.
And you look at the numbers, nearly a third of consumers say that COVID-19 has made it more likely that they'll purchase life insurance in the next 12 months. Talk to me about the kinds of people who are doing this, because you think life insurance, you think sometimes, well, older folks, wealthier folks are buying into these policies, but you're seeing that even millennials, I think something like 45% of millennials say they either have it or want to buy life insurance in the not too distant future.
Yeah, we're actually seeing one of the strongest growth segments is millennials. And again, we think that's really positive. One of the things we've been doing is investing heavily in technology to make it easier to buy life insurance, particularly going through the underwriting process. With fully underwritten insurance, you're able to give people the lowest possible cost of insurance. But the days of having a paramed show up at your house, in some cases with a scale to start the process, and it goes downhill from there from a consumer perspective. Although you might have to do that for some large policies and people who've had historical health issues, increasingly we're able to use machine underwriting to get people through an underwriting process very quickly, issue policies very quickly, and that just makes the whole buying process better, both for consumers and for agents who frequently are working with customers to help them understand what their insurance needs are.
You bring up a good point, because I was curious how you would assess someone's health risks, especially during a once-in-a-lifetime pandemic. Are you asking to see COVID-19 tests? Are you asking folks if they've had COVID? And what are you doing with regards to that?
Yeah. So remember, our business has always been one around trust, where our policy owners and the owners of the company share sensitive health information with us, and we use it just for the purpose it was given to us, which is to put them in the best risk class, to give them the lowest kind of price of insurance. So we do ask a series of health questions, and what's great now is, again, particularly for younger, healthier folks, we don't have to do that we don't do that on paper. We can do it just on an app. We can have the underwriting be happening literally as that app is getting taken, and we can then issue a policy immediately. So we built a fully digital platform. We haven't just digitized an analog process. We've built a brand new, effectively digital insurance company, and that's been an important thing. And the uptake on that accelerated dramatically during the pandemic in 2020. Change management's always one of the big challenges for any industry, especially one that has established ways of doing business. The pandemic actually got people to accept change.
Well, that's a good thing, certainly. I want to ask you about another trend we're seeing, because as the number of policies sold climbed, we saw the average death benefit actually shrink by about 4% to $270,000. What's your takeaway from that? What does that tell you?
I think it's great. I think it's the realization that everybody has, that they need some life insurance. Life insurance is not just for the wealthy. In fact, the history of life insurance in the United States is really one of all of America buying life insurance. Our oldest policyholder today is 103 years old. She's had her policy 93 years. So it's a very long-term product, permanent life insurance. So I think it's absolutely fabulous that we're seeing millennials buy policies, that we're seeing policy sizes trend down. That just means more Americans are making sure their loved ones will be protected if something happens to them, and that's just awesome.
We also had a chance to talk about the return to the office. Roger Crandall starting now to ask employees to come back to work on a voluntary basis there at MassMutual. And he also told me they're pushing ahead with a $300 million investment to expand their footprint in both Boston and New York City. You can check out the entire interview on our website. Coming up next, a look at the day in oil, and a little later, why the airline industry is having trouble finding workers. Welcome back. Well, it looks like U.S. equities aren't the only thing rallying today. It was a really good day for oil as well. And Jared Blickery here now for a recap. Jared, I see crude at a 2.5-year high. What's behind the push?
That's right. It's all about the reopening story. And we saw the lines this weekend. Anybody who drove anywhere, I think they were hard to miss. Let's check out the Wi-Fi interactive heat map. We're going to take a look at the energy sector first. And we can see the majors here. By the way, lots of green on the screen. Majors up nicely. Exxon up over 3%. Chevron up 3% as well. Some of the smaller names, and take Schlumberger, the oil services company, they are up over 5%, and we're also seeing Pioneer up over 4%. So broad-based gains here, and we did take a little bit of a hit last week in the energy stocks as growth tended to outperform a bit. But here is WTI as it stands right now, still trading the electronic market. We hit about $71 per barrel and shot up to 74. So the dips are being bought here. Here's a look at the last month, and that is from the lower left all the way up to the lower right. That is an intact trend line, and definitely a long-term one too. Let's take a look at the 1 year real quickly, and we can see up 82%. So the next big meeting for OPEC Plus in a couple of weeks, we'll be bringing that to you. In the meantime, looks to be all about the demand picture here, Alexis.
All right, thanks a lot, Jared. I want to stick with oil now and bring in Rob Thummel. He is portfolio manager and managing director at Tortoise. Rob, it's been a while. Always good to see you. I know you just heard Jared's report there on oil. Is the rise we're seeing really all about the reopening trade, or does this have something to do with the Iran nuclear deal? The fact that, talks to restore that plan between the U.S. and Iran might actually be stalled because we saw that Iranian presidential election late last week in the country.
Yeah, Alexis, I think it's both. You know, if you think about it, there is a lot of demand, as Jared just highlighted, for oil and oil related products, and there's right now just not enough supply coming to the market quite yet. So we've seen inventories come down globally, and that's really helped boost oil prices. The Iranian negotiation would be additional supply, but now that seems to be pushed out and might not be coming to the market. So the reopening trade in general has really led the oil prices higher as just global oil inventories have continued to decline.
And Rob, curious to know how you see the heat wave that we have going on in California. I know that another one is supposed to be slamming the West Coast again. How do you see that impacting energy markets going forward, at least through to the end of the summer into the fall?
Yeah, so the heat wave, you know, obviously that means we need more electricity demand. And so where does the electricity come from? Comes from natural gas, it comes from coal, obviously it comes from renewables as well. So from our perspective, you know, we probably see increased electricity demand in the West and in the Midwest where we live. And that will be good for all energy commodities, but more so for natural gas and for renewables. And actually, we've even seen a little bit of an increase in demand for coal, not only just domestically, but also globally in Europe in particular as well.
What about the price of WTI crude right now at a 2.5-year high, settling above $73 a barrel? I mean, do you actually foresee that we could have $100 oil perhaps in the next 6 to 12 months? And what might get us there?
Yeah, that's a very good question, like Alexis. You know, short term, anything can happen, right? The Strait of Hormuz could get shut down temporarily, and oil prices could spike. There's a lot of geopolitical issues that could drive oil prices higher. But for an extended period of time, I think it will be pretty difficult for oil to get above $100 for an extended period of time, just because we do have so much supply, both domestically in the U.S., but also globally as well. So I wouldn't expect oil prices to rise above 100 and stay there for a while. Often $100 oil is actually not good for the energy sector. It's a little counterintuitive, but that just drives consumer demand down. And that's not good for anybody, whether it's the consumer or the energy sector as well.
All right, we're going to have to leave it there, but the conversation will be continued for sure, because lots to move oil in the coming weeks, including that OPEC Plus meeting. Rob Thummel of Tortoise, thanks so much. I want to switch industries now and talk about the airlines, because the restaurant industry is not the only one experiencing a labor shortage. It is also impacting the airline industry. And over the weekend, American Airlines said it would cancel around 1% of its flights in July to serve what it says is a surprise uptick in travel demand. Now, all of this is coming as the airline industry struggles with some unprecedented weather in parts of the country and also a labor shortage at some of its hubs. I want to bring in Mike Boyd now to talk about this. He is president at Boyd Group International. Mike, good to see you, and thanks for joining us. Before we get into the labor shortage, I'm just wondering if we can expect other airlines to make some similar announcements the way American did this weekend.
Well, let's remember, 1% is not a huge cut in any case. The real reality is here, for airlines, you just don't go out and hire somebody. If you're going to have them work at a ticket counter, they have to have training in hazardous materials and security. You just don't bring people on real quick. The real issue is they had to let so many go. Bringing them back is becoming a problem. But it's not a huge problem. I think it's going to be very temporary.
So to that point, then, do you think we're going to start seeing a lot of these airlines in the attempt to kind of lure some of these workers back, start offering big bonuses, higher salaries? Because this labor shortage isn't just existing within the airline industry. We've heard so many companies say that they frankly can't find workers. So how long is it going to take for some of these airlines to really get some of these workers back to working?
Probably a couple of weeks. You can't just go out there and say we're going to raise. A lot of these are union jobs. That's number one. You just don't raise a union rate per se. But it's not that severe. It is something to get airplanes out on time, but it's not something where people are lined up like at the drive-through at McDonald's. It's going to be an issue, but they're going to deal with it. But they have to deal with it in the confines of their current compensation program.
You know, it sounds to me like some of the airlines were sort of caught flat-footed, and I'm trying to understand why. Because I mean, we keep talking about the reopening and that people are going to have all this pent up demand and travel is coming back. Were you surprised that they didn't have the workers on hand they needed to keep their flight schedule the same?
No, not really, because they've been, like, for example, American Airlines just adjusted its September schedule down by about 25%. But guess what? That puts them right about where they were in 2019. They've been trying to adjust it as best they can to maintain revenues, but it's very hard to do when you're not really sure how many people are going to book. Remember, load factors overall are not up to where they were prior to this pandemic. So it's a very hard thing to project. Remember, in the airline industry, a couple percentage points, one way or the other, can be profit or loss. They're taking the cautious path, which they should.
So it seems, Mike, you're saying this is a fairly small speed bump, at least for American Airlines. Just curious to know how long that bump is going to really last, especially as the demand right now, as so many states and cities and even countries now, the EU opening up their borders to vaccinated Americans, we're only going to see this demand continue to increase throughout the summer. Do you think these shortages are going to continue that long, or do you think that perhaps they will be able to build up their staffing in time for all of the summer holidays and vacations?
Well, right now they're having problems. They're not having a major meltdown. And let's remember, international travel, the EU can open up all they want to open up, but not many people are going to take their family to visit the lake country of Italy this summer because of all the nonsense that's gone on over there. Same with business travel. Everybody's meeting electronically. So it's going to be down. It's not going to be up to 2019 levels. It'll be close. But this is not a crisis at airlines. It's a problem.
What can travelers expect, though, Mike, as some of the fully vaccinated folks head back into the air to travel? I mean, are they going to be hit with long lines and lots of delays this summer as they start to travel again, do you think?
Well, remember this. Long lines at airlines don't delay flights. The flight leaves without you. It's real simple. But one really thing that concerns me is to hear that the Transportation Security Administration might be understaffed. Understaffed and TSA has never been put in the same sentence. So I don't know what's going on there. But I would suspect you're going to have to get to the airport early, depending upon where you are. But overall, I think it's going to flatten out by September, and it's going to get back to a fairly normal.
All right, I think we may have, okay, Mike, thank you so much. Mike Boyd, president of Boyd Group, thanks so much for being with us today. We appreciate it. And coming up next, a look at cryptos cratering today, even as stocks rally. We're back right after this.
welcome back. Steven Spielberg's production company is partnering with Netflix again. So what can we expect from this partnership? We have Yahoo Finance's Alexandra Canal here with all of the details. Hi, Ali. And Ali, you're muted right now, so we can't hear you.
Can you hear me now? 1, 2, 3.
We can.
All right. Good. The trials of working from home. But yes, Steven Spielberg, obviously a huge name in the film world, making his way over to Netflix. So Amblin Partners, which is his production company, officially signed a multi-year partnership with Netflix, which will supply multiple movies per year to the streaming platform. Now, the financial terms of this deal have not yet been disclosed, but insiders at both Deadline and The Hollywood Reporter said that the deal has no restrictions regarding budget or genre. Now, Netflix shares, they're trading a bit in the red today, down around 1 percentage point. So it doesn't seem like investors are reacting too heavily on this news, but it's still a pretty surprising deal because remember, Spielberg and Amblin Partners also have a separate theatrical deal with Universal Pictures. Now that deal was just renewed in December. Spielberg will continue to direct films for that studio as well. So it seems like things are getting a little muddled in the media world, but you know, I am not totally surprised that both Netflix and Universal want to continue working with Spielberg and Amblin. Obviously, he's a huge name in this space, but Amblin has some pretty recognizable films. We have big blockbusters like Green Book, which did go on to win Best Picture, also 1917, The Trial of the Chicago 7, which did land on Netflix amid COVID-19. So these studios do have some experience working together, but still pretty interesting and surprising nonetheless. I don't think a lot of media experts anticipated this today.
So how do you think this represents a shift in the media world, the fact that Spielberg has come to this deal with Netflix?
Well, Spielberg is one of many directors that have been very hesitant to embrace the streaming world. Back in 2019, he did make some comments about streamers like Netflix being able to be eligible for Oscars. If you remember, Netflix sort of made a big splash in the beginning with Roma, but he seems to have changed his tune here, even though he said later that he didn't totally mean that. He was just defending the theatrical experience. Right now, you can't deny how much things have changed over the past 2 years. Now, I think this comes down also to just the power of Ted Sarandos. He is the co-CEO of Netflix, also the chief content officer. He's done a really great job trying to bring those big names to the platform, not just on the director side, but on the actor side as well. Netflix spent $450 million to secure the next 2 Knives Out sequels starring Daniel Craig. They also have a movie coming out later this year with Leonardo DiCaprio. So, you know, I don't think that they're in a bad spot. They're always willing to spend the money and put the money where their mouth is when it comes to securing those high profile names and those high profile actors and actresses to hopefully draw people to the platform and subscribe to the channel. But I think this is more so extends beyond Netflix, and it's really an industry-wide situation. I think a lot of these studios, and I've spoken to some creatives in this space, they've said that studios are really risk averse these days. They only want to invest money in those big budget franchise superhero films. And because of that, creatives have been a little frustrated. These streaming platforms allow a bit more flexibility. So I think this is something that studios are going to have to debate moving forward and try and change their strategy here. But this is certainly just another example of how things are not changing anytime soon, and how streaming, if anything, is becoming more a part of the landscape of Hollywood.
All right. Thanks so much, Alexandra Canal, for bringing us all of those details. I'm looking forward to seeing some of those movies that come out of that partnership. Coming up next, after the break, WeWork has posted the best sales since it scrapped its IPO plans 2 years ago. We'll be bringing you all the details on that next.
Welcome back, everybody. As vaccination rates rise and workers start to trickle back into the office, WeWork is actually having its best month in almost 2 years. We've got Yahoo Finance's Sabeel Marcellus here now to break it down for us. Sabeel?
That's right, Alexis. So what we're seeing is that WeWork in 2019, they tried to go public. That failed. The CEO had to step down. Then we also saw thousands of layers of workers get laid off. And now we're seeing WeWork try to resurge. And it's actually going to try to go public one more time, but this time via a SPAC. And there we're talking about a $9 billion merger. But let's get to how WeWork is doing right now. So obviously the pandemic has really impacted the company. So what they saw is occupancy rate was over 70% back in 2019, but then that dropped to 47% towards the end of last year. And now it's back up to 53% in May. Also membership. So back when they're doing the IPO, membership was around 662,000 members. Now that dropped to 490,000 last year, and it's now inching its way back up to 505,000 members. So we're really seeing WeWork benefit from the fact that people are getting vaccinated, feeling more comfortable about returning to the office, and they're seeing more people willing to rent office space for business.
So, Sabeel, tell us how they've been, really managing through the pandemic. I know they're doing better now than they did before. How did they make that happen?
Yeah, so Kristen, what we're seeing is that WeWork is trying again to go public, but this time via SPAC, and they're also streamlining their business. So they closed a bunch of locations. During the pandemic, they renegotiated leases, and we're also seeing more customers now booking office space because they foresee that, they might not necessarily have to go back to their former office, but there might be some kind of hybrid arrangement. So WeWork is looking more and more attractive. So that's why we're seeing with WeWork, and they're really, pushing to this time have a successful IPO. We'll see what happens, but they're trying to do it again.
All right, Sabeel Marcellus, thanks so much for that. I want to get another check of the markets because it looks like investors have really been able to sustain this powerful rally, this comeback rally that we saw right out of the gate this morning with the opening bell. Remember, last week was not a good one for equity investors. It was the Dow's worst weekly decline since October. And here you see the Dow up now 557 points. It was up more than 600 earlier. So it looks like investors taking advantage of some of the bargains they saw last week. The S&P 500 now up 55. We've got the Nasdaq Composite up 113 points as tech stocks seem to fall back in favor as well. All 11 sectors in the S&P 500 in the green. And by the way, have to mention that today is Amazon Prime Day, which really has morphed into a two-day event, a huge sale there at Amazon that usually brings big profits for the e-commerce giant. And there you see the energy sector is helping to lead the advance today for the market and what is a broad-based rally. All right, coming up in the next hour here of Yahoo Finance Live, Robert Cohen of DoubleLine is going to join. He'll be talking about how to protect your portfolio with inflation on the horizon. That's going to do it for Kristen Myers and myself, Alexis Christophers. Thanks for spending the past 2 hours with us. We've got much more Yahoo Finance Live in store for you right after this break.
Markets move higher, wiping out some of last week's losses as the biggest names in financial regulation, among them Fed Chair Jay Powell, Treasury Secretary Janet Yellen, and SEC Chairman Gary Gensler, meet with President Biden to discuss climate change and increasing access to credit, as members of the Fed speak publicly about their outlook on things like inflation. Then Bitcoin fell below $32,000 after China intensified its crackdown on cryptocurrency mining. But investors like MicroStrategy's founder and chief executive Michael Saylor are going in big, disclosing his firm spent almost $500 million to purchase more than 13,000 Bitcoins, bringing their total holdings to about $3.3 billion. We'll check out crypto with you. And with that kind of wealth, who needs a sale, right? Amazon's Prime Day is underway with $100 AirPods, $30 Roku units, and thousands of deals that promise to help drive Amazon's e-commerce dominance. But is it the savings or the psychology of saving a few bucks that really drives the art of the deal? We've got the chair of marketing science from the Smith School of Business here to analyze all of this for us. There's an hour left in the trading session. I'm Adam Shapiro.
And I'm Julia LaRoche in for Shauna Smith. And since there is just an hour left in the trading session, let's bring in Yahoo Finance's Jared Glickry for the latest moves in the market. Jared?
Well, we're seeing a lot of green today, and it's centered in the Dow. So let's take a look at the Wi-Fi Interactive, and we can see not only is the Dow outperforming, but also small caps. The Russell 2000 up even more. That's up 2%. The Dow up 1.7% or over 500 points. Now, I want to take a look inside the Dow. We're actually at a longer term chart here. This is a 2-month chart. We're going to put the 50-day moving average on, and this is a really critical level, 34,200, maybe a little bit higher. We're going to want to watch if we do rally into that area today or tomorrow. That would be a logical area where we could see some short sellers. Now, the Nasdaq much closer to its record highs, barely had a small loss last week, and that's because we saw a rotation back into those growth names when we saw the 10-year yield, all that bond market volatility centered around the Fed. Well, I also want to take a look at the VIX because it topped 21 today. Haven't seen that kind of a print in about a month. And when we do see these rounded bottoms, a lot of times we see equities top, and topping is a process. The reason I say that there is that potential is because this is a seasonally weak, actually 2 weeks of the year here, don't have a lot of news going on. And here we see the energy sector, lots of green, and we'll take a look at the Dow next because that's where the action has been. Not one red square on your screen. Boeing is a standout, that's up 3%, Chevron up 3%, American Express up over 4%. And here's that 1 month look. You can see it's still up about 5% on that time frame, guys.
Jared, thank you very much. There's a lot going on with the Federal Reserve. I mean, last week we got the summary of economic projections and the infamous dot plot, but this week we're going to hear from a whole bunch of Federal Reserve members. Let's bring in Brian Chung. He's going to run down the calendar for us and much more. Brian?
Well, Adam, the Fed speak has already begun. We heard from 3 Fed presidents earlier this morning, a lot of them chiming in on that Wednesday decision last week to hold interest rates steady. But of course, it was the dot plot projections, which show where policymakers could see interest rates going in the next few years, that got markets all riled up. And you'll recall that the dot plots for 2023 showed the median member of that 18-member committee projecting 2 interest rate hikes by the end of 2023. We heard from Neil Kashkari from the Minneapolis Fed, in addition to Jim Bullard last Friday, and their commentary helped us understand which of their dots were theirs. So Kashkari is saying he didn't see the case for an interest rate hike through the end of 2023. That explains the orange dots at the very bottom, but that Jim Bullard saying he's penciling in 1 interest rate hike by the end of 2022, which shows the red dot that he doesn't see necessarily the case for keeping interest rates at near zero through the next 3 years. Now, of course, they are only 2 of 18 policy makers on the committee, and there are at least 10 Fed officials scheduled to speak this week. The full calendar will show you that we are expected to hear from Jerome Powell tomorrow. He'll be testifying before Congress. We'll also hear from the likes of Mary Daly. She's the head of the San Francisco Fed, who's also a voting member of the committee, and other people on doc, Mickey Bowman, who's a Fed governor, Raphael Bostic from the Atlanta Fed, Eric Rosengren from Boston, in addition to some other repeat speeches. But we're also keeping our eye, of course, on what bond markets are doing. I was taking a look at the 30-year over the weekend. It seemed like it was flirting pretty closely to the 200 basis point level, but it does seem like bond markets have bounced back a bit since the steep losses that we saw on the bond yields in Friday's session after Bullard said that he was penciling in that 2022 hike. So a lot worth watching. But again, 10 Fed speakers on dock this week. The question, of course, are they going to offer more clarity or more confusion? We'll have to see.
And Brian, when it comes to Fed speak, we should be getting some comments crossing from New York Fed Chair John Williams. What can you tell us?
Yeah, it looks like those headlines are just crossing, Julia. John Williams, again, the head of the New York Fed, speaking at a virtual event just now. And some of the headlines from his prepared remarks note that he, at least the way he's seeing the economy, they still have a long way to go on the recovery. He pointed to that May jobs data showing that the economy is still 7.6 million jobs short of pre-pandemic levels. He continued to describe inflation as mostly transitory. This is pretty notable because a lot of the commentary from those who have argued for maybe interest rate hikes earlier are saying, well, they're a little bit more fearful of inflation being a bit more persistent. So Williams saying that inflation is mostly transitory could be one way of saying that he does believe that ultimately inflationary pressures are not as big of a deal as some that are penciling in those earlier rate hikes might see. But an interesting quote here, I guess it's worth reading, quote, "But the data and conditions have not progressed enough for the Federal Open Market Committee to shift its monetary policy stance of strong support for the economic recovery." So nothing in his remarks that really details specifically which one of his dots were his on that chart from last Wednesday. But based off of reading the tea leaves, it seems like he's a bit more in the camp of trying to keep things accommodative for a bit longer. Now, of course, these prepared remarks are coming alongside a media appearance where he might offer a little bit more clarity through a Q&A. So we'll have more updates of that right here on Yahoo Finance. But again, New York Fed president saying that he does expect inflation to be transitory, guys.
And when the Fed speaks, we listen. We also listen when Brian Chung covers the Fed. We will see you a little bit later on, Brian. Thank you. Let's bring in Mitch Rochelle. He's founding partner at Macro Trends Advisors, LLC, because he's very good at helping those of us who try to make heads and tails of how to invest, take some of the data and the comments we get from the Fed and interpret how to use them. And I wanted to ask you, you say that investors, when you look at the yield on the 10-year, are sending a message to the Fed, don't raise rates. I wanted to challenge you on that, because if that was the message, wouldn't we see them selling the 10-year and that the yield going up dramatically?
I think we're going to not disagree. I think we're going to realize that the problem with bond purchasers is they're competing with the Fed, who's also buying Treasury securities. Actually, I think last month you saw that the number of purchases by the Fed of Treasury securities exceeded the new issuances of Treasury securities, meaning they're buying them in the secondary market. So I think they are trying to send a message, but they're also facing some competition. And as the Fed buys, they can sort of control the yield a little bit. But I think you look beyond the 10-year and also look at the equity markets. Wednesday through Friday, I think investors try to send a message to the Fed that we don't like this talk of rate raising. Famously, at the end of 2018, I believe it was October 2nd, 2018, when Chairman Powell said something about their stance on accommodation, the market sold off all the way through the end of the year. So the market's pretty good at sending a message, and I think they're trying to do it a little bit in the bond market, but they're facing some competition from the Fed themselves.
Mitch, Julie LaRoche here. What is your outlook as it relates to rates in the year ahead?
I think they're going up. I've sort of been wrong on saying that because I predicted interest rates staying low for a while in the midst of the pandemic because of accommodation. I think one of the things the Fed's going to do to prevent the economy from overheating, I don't think they're going to make a move on rates. I think they are going to taper. And the area in which they're going to taper is potentially their $40 billion monthly purchase of mortgage-backed securities. And I think they're going to begin to taper in that area because the housing market is already overheating a bit. And I think that that's going to upset the market if it's not well telegraphed. So as you said in the previous segment, you have a slew of Fed members out there in the market. I think they're going to begin to start talking more and more about tapering. So that's influencing my outlook. Having said that, I see a scenario in which rates are 100 basis points higher by the end of the year if the economy continues to run hot and if the likelihood of the Fed raising rates in the short end of the curve as early as 2022, I think that's certainly going to drive rates up.
Hey, Mitch, before we even get to what you just said is a possibility, we're going to have earnings. I mean, in less than 10 days, we're going to be kicking off earnings season for Q2. What's your expectation? Because a lot of people are positioned right now with a lot of cash on the side and looking for that dip to jump back in. The dip we saw Friday, they're jumping in today.
I think you nailed it, Adam. Anytime there's a dip that's more than just one day, and people have a little bit of time to digest data. So we had the perfect situation. People had the weekend to read Barron's and digest data. I think they jump back in on a Monday. So there's a ton of cash. Just listen, if you look at a chart which compares the growth in the S&P 500 to the growth in the money supply, those two charts or those two lines or graphs, however you want to say it, are highly correlated. So if we continue to pump money into the system, we're going to have money on the sidelines, and any time there's a dip, people are going to buy in. But as it relates to earnings season, which is the core of your question, I continue to believe that earnings are going to outperform. Expectations are getting better and better managed. But if you look at the blowout first quarter we had, I think there's enough momentum to continue that, which are going to make stocks an interesting investment throughout the year. There'll likely be a correction somewhere during the year of some sort, because there always is. But right now, going into earnings season, I see tailwinds and not headwinds.
Mitch, when we're back in studio, our coffee, our green room coffee, is a lot better than the stuff you get at Fox Business. So we look forward to having you come into 770 when we're back in studio. All the best to you, Mitch Rochelle, founding partner of Macro Trends Advisors. When we come back, we're going to be taking a look at a whole lot of things, including what happened to Bitcoin. Call it a China crackdown, and not necessarily a crypto crash, but wow, talk about a fall.
Welcome back to Yahoo Finance Live. I'm Julia LaRoche in for Shauna Smith. We'll take a look at Bitcoin's price. It's hovering around $32,690, down about $2,200 on a continued crackdown in China. We're joined now by Nick Bhatia. He is the author of the book Layered Money, and he's also an adjunct professor at USC Marshall. Nick, great to have you on the program.
Thanks for having me, Julia.
And we know that this crackdown in China has been going on for several years. And for someone who's been in this space for a while, and also someone who has experience in the financial markets, who takes a macro view, frame this up for our viewers at home.
As we all know, Bitcoin's price is incredibly volatile. And so the news happens to, move the price, especially when a country like China announces further regulation. But it's important to recognize two things. Firstly, China has been cracking down on Bitcoin for several years now. And if you look back at the headlines, we've had mining bans, trading bans, further regulation that continue to be announced out of China. The second thing is that Bitcoin's price, while it might be down $2,000 or 6% today, this is well within, a standard deviation of moves for Bitcoin. We see increases of hundreds of percent for Bitcoin every few years, and then we see spectacular 75% drawdowns as well. So the volatility is important to separate from some of the underlying news that comes out for Bitcoin.
For those of us who might want to one day dabble in Bitcoin, whether we do it through an ETF or whether we do it through some kind of slice because we can't afford even 31,000K, how much does like the news we got about Saylor purchasing almost $500 million worth of Bitcoin, how much does that drive the price? And am I susceptible to the big fellows and women who might be driving and manipulating me out of actually getting the best deal?
Well, it's funny, actually. If you look back a few months, we saw the Tesla purchase of 1.5 billion of Bitcoin and several MicroStrategy purchases all line up with basically a doubling of Bitcoin from 30 to 60,000 in pretty quick fashion. But then the $500 million purchase by MicroStrategy last week was followed by, quite a large price decline. So it is really hard to correlate particular purchases or sales of Bitcoin with the overall price action. And as far as, competing with these large parties like Tesla or MicroStrategy, we still are in a position where there's only one company out of 500 S&P 500 companies that owns Bitcoin or has admitted to own Bitcoin on their balance sheet. So I think we are still very early in this adoption cycle.
So very much early in this adoption cycle. I want to revisit a tweet that you put out earlier, at least part of a tweet here. You said that China banning Bitcoin would be beyond moronic for their geopolitical ambitions. They aren't idiots. So what is kind of your thought process as it relates to China and Bitcoin going forward? And what do you think could be the biggest risk to your thesis?
So when I think about what China has as far as their attitude toward Bitcoin, it's hard for me to imagine that the country and the Chinese Communist Party are looking at Bitcoin and saying, we don't want to be involved with that. We don't want to own any of that. And we don't want our people to own any of that going forward for the next 10 years. It's hard for me to imagine that because the Chinese people, the Chinese Communist Party has made it known for the last several years, couple decades, that rising up to be the geopolitical superpower in the world, replacing the United States, or at least being on par with the United States, it's their stated goal. And so when you look at the wave of adoption of Bitcoin and its position as a macro asset, I do believe that China wants to be a part of that. Now, seeing the news come out about China that they're banning mining and they're cracking down on the trading and ownership of Bitcoin, it doesn't necessarily vibe with this idea that China is embracing Bitcoin. So we have to watch what they do and not necessarily what they say. And so I want to watch what China does in terms of their investment outlook towards Bitcoin. How are they portraying Bitcoin as a technology? And what I've seen from articles that have come out in Chinese newspapers, for example, is that they identify Bitcoin as a potential digital gold and a solid investment opportunity looking forward into the future. And so we have on one side China might be embracing Bitcoin as an investment, and then the other side, they want to crack down on mining. They want to make sure that illegal trading is taken out of the marketplace and that the government has control over it. So it's really a tale of two worlds, and I want to watch more that unfolds instead of just reacting quickly to China bans Bitcoin or China bans Bitcoin mining and correlating that with China hates Bitcoin and it won't be part of their country.
Well, for our viewers watching, Nick, if you don't mind, I'd like to get your price target on Bitcoin. You can give us the time frame, but what is your price target in, I don't know, the next year or even years ahead?
Sure. Well, I think Bitcoin it's already reached the $1 trillion market cap earlier this year. And I think that we'll see that evolve into the multi-trillions over the next few years. So for example, a $2 trillion market cap of Bitcoin will be about $100,000. So I think that's the direction that we're heading in this particular asset over the next couple of years for sure.
Well, Nick Bhatia, author of Layered Money and an adjunct professor at USC Marshall, I have to say, fight on because of my husband, but it's great having you on here, and stay with us. We'll have more on COVID-19 after this break.
About 35 minutes to the closing bell. We want to get the latest on COVID-19, and Anjali Kamlani covers COVID-19 and the coronavirus pandemic for us here at Yahoo Finance. What have you got, Anjali?
Well, let's start off with what's going on over in Japan with the Tokyo Games set to start with fans included. That's something that is a shift away from what health experts say is safe and should be monitored, continuing, as the pandemic continues to span the globe. But the country has said that they're willing to have the games with about 10,000 people in the audience, which is about half the capacity that they have there. They have had sporting events open to the public. They say that this is largely for, not largely for, only for domestic attendees, and masks will be required there to help curb any concerns about spreading the virus or this becoming some sort of super spreader event. But health experts are still concerned about just having that many people in one place. And of course, this is all because while vaccinations do continue globally, there are concerns of growing the Delta variant, which is over here right now as well. And that's something that we are worried about here in the US, with experts like Dr. Peter Hotez, a key vaccine expert in the country, saying that we might face 2 USs as a result of the Delta variant continuing to infect unvaccinated individuals. So that is really a concern globally, but also here in the US. And while many have said that there might not be any sort of real surge until possibly the fall, if things continue on the path that they are, that is something that we are keeping an eye on right now. Back to you.
Anjali, thank you. Let's bring in Dr. Brian Garibaldi. He is Johns Hopkins Biocontainment Unit Medical Director. It's good to have you here, Doctor. And when we have this discussion about vaccinations and the variants, especially the Delta variant, I think a lot of us, the concern we have is for kids 12 and younger. Do we know how the Delta variant affects them? Because they can't get vaccinated yet.
Well, that's a great question. I mean, we know that this variant definitely spreads more easily and likely causes more severe disease than the other variants that are available or that are currently circulating. And what we have seen is, we've seen an increase in cases among unvaccinated people, which includes children. So over the last several months, we've seen an uptick in the number of children who have been infected and a number of children who have required hospitalization and in some cases developed severe disease. So I think that's something that we're worried about, and it's another reason that we really need to step up our game in terms of getting people vaccinated. We're probably not going to make President Biden's goal of getting 70% of the country vaccinated by July 4th, but that doesn't mean we still can't continue to make progress until the school year to try to make sure that we decrease community transmission as much as possible.
And Doctor, from your perspective, what do you think will kind of help move, I don't mean to make a pun here, but help move the needle as it relates to getting more folks vaccinated? What do you think are the biggest challenges out there?
Well, I think one of the biggest challenges is the misinformation that's circulating about the potential side effects of the vaccine and the lack of a clear message about its benefit, both for individuals but also for communities. And I think we're starting to see some progress on that front in terms of meeting people where they are, trying to understand what their concerns are, and really trying to battle that misinformation with valued members of local communities. But I still think we have a ways to go, and we've seen some progress with incentives like vaccine lotteries, for example, where people have been getting financial incentives to get the vaccine. Those have led to some uptick in vaccination rates in the areas that have implemented them, but we've seen that initial benefit from those incentives start to tick back down. So we're going to have to come up with continued creative ways of getting people to recognize that this is for their own health, but also for the health of their friends and family and their communities.
Doctor, we've all encountered that person who just won't listen to reason. So what can those of us who are vaccinated adults, who return to the office, who might encounter people who are not vaccinated, who might be able to transmit a variant of COVID-19, what can we do? What should we do to protect kids? Do we need to worry if we're vaccinated and encountering people who are not, who might be contagious?
So we know that the vaccines are very effective at preventing symptomatic illness, and that probably means that the vaccines, that those of us who are vaccinated are probably less likely to be able to transmit COVID-19. And luckily, so far, the data we've seen in terms of the mRNA vaccines and the Delta variant are holding that high level of protection in the real world. And so, I expect that even if you're exposed to someone who has symptomatic COVID-19 and they're not vaccinated, if you've been vaccinated, your chance of becoming symptomatic is quite low, and then your chance of transmitting it onto someone else is also low.
And I imagine you're probably having a lot of these conversations, in your own area of work. And what do you say to someone who might be hesitant about getting a vaccine? How do you kind of help them get over that and get the shot in the arm?
Well, I think the first thing is trying to understand what their hesitancy is, right? People have very real concerns, legitimate concerns about safety based on their own medical conditions, based on the people that they're around. And there, we also have to recognize that there are many people who are hesitant to get vaccinated because of historical reasons, and the inequities in our healthcare system, particularly amongst underrepresented minorities. So I think the first step is to just try to engage people in an honest conversation about, hey, I'm curious, why have you not yet gotten vaccinated? And I think the conversation starts there, and where it branches off really depends on what their response is and what their concerns are.
We appreciate your comments. Dr. Brian Garibaldi is Johns Hopkins Biocontainment Unit Medical Director. All the best to you and your team. When we come back, it's an Amazon Prime Day fire sale, and we're going to break it down for you after this.
Welcome back to Yahoo Finance Live. I'm Julia LaRoche, and it's time for 2 and 2, two stocks that we're looking at right now. Take a look at shares of Pershing Square Tontine Holdings, up just about 0.25% at $22.75 per share. This is the SPAC that is led by hedge fund billionaire Bill Ackman. Pershing Square Tontine Holdings signed a deal on Sunday that it will buy 10% of Universal Music Group's shares from Vivendi for $4 billion. Universal Music Group is expected to go public in the third quarter of this year. Now, Pershing Square Tontine Holdings also said that it will continue to exist as a RemainCo after the transaction, and that RemainCo intends to pursue another business combination. Tontine will also debut a new company called a SPARC, a special purpose acquisition rights company, to allow those Tontine shareholders to subscribe to those shares when the SPARC finds a business combination partner. We're also looking at shares of Royal Caribbean, trading up about 1.48, just about 1.5 per, or let's see, about $1.48 higher, or 1.73% higher. Royal Caribbean's Freedom of the Seas cruise departed the Miami port on Sunday. This is the first cruise ship to sail from a U.S. port in 15 months. Now, keep in mind, this cruise is a 2-day test cruise. Now, Celebrity Cruise, which is owned by Royal Caribbean, is scheduled to see its Celebrity Edge ship depart Fort Lauderdale on Saturday. This will be the first revenue cruise to leave the U.S. since that no-sail order was implemented in March 2020. Adam, what are you looking at?
Well, Julia, we're all hoping that those cruise lines have a lot better luck than the poor folks on the SS Minnow. Keeping an eye on American Airlines right now. There was the news this morning that they had to cancel. It's something as many as, it depends, 80 flights a day through June through July because of a staffing shortage. They've got the demand, and the stock right now is trading higher, not dramatically, but the stock right now is higher. And part of that has to do with the fact that they have been able to, 2.1 million people moving through TSA, through airports yesterday. And we're now averaging about 2 million on weekend travel days, still below the 2.7 million you would see in 2019. But American, like the other airlines, is benefiting from the increase in demand. The problem is American, like the other airlines, offered early retirement to lots of people who took it and left when the airlines were cutting expenses going into the pandemic. They now need to staff up, and you can't just hire someone overnight. That goes from mechanics to baggage people to ticketing people. So all the airlines are in that place, but American is having the biggest problem with that right now. Then there's Home Depot. Shares of Home Depot have been a bit mixed, but right now they are trading higher, up almost 2%. Keep in mind that with Home Depot, the CEO said when they reported their earnings back in May that fiscal 2021 is off to a strong start as we continue to build on the momentum from our strategic investments and effectively manage the unprecedented demand for home improvement projects. Now, we've seen the price of lumber. Lumber futures have fallen back down from the highs that we saw. They're off about 45%. Home Depot did very well during the pandemic. They saw their first quarter sales increase 33% to $37.5 billion. They're going to report second quarter in August. We're going to keep an eye on that, but lots of stock analysts are keeping an eye on it because they are off 10% from their 52-week high, which was around $345 a share. Julia?
Thanks, Adam. Another stock we're watching, of course, is Amazon, since it's Amazon Prime Day, but really Prime Days these days, right? And our next guest is Christian Magoon, Amplify ETF's CEO, to break this down for us. Christian, great to have you on the program. And of course, we know Amazon Prime Day, it just gets bigger and bigger every year. What's kind of your outlook for this year?
Yeah, well, we see, continued growth. Last year was held during a pandemic, which should have benefited Amazon, and it did. They eclipsed $10 billion in sales. But believe it or not, a year later, or at least about 9 months later, since Prime Day was held in the fall, we see 25% more Amazon Prime members today, around 150 million of them. So Amazon should set a new record, possibly at $11 to $12 billion in sales this Prime Day, which is really helpful for them. They need a shot in the arm. Certainly, the stock has been, underperforming the S&P over the last year, and I think this could be some positive news for Amazon to continue its rally towards that $4,000 mark.
I love hearing that $4,000 mark, but I think a lot of us and a lot of investors are questioning with the transitions that are coming up with Amazon, the fact that, yes, they've got 40% of the U.S. e-commerce market, but e-commerce only represents 15% of total retail. After the pandemic, shouldn't it be much higher than that?
Well, it did spike during the pandemic, and it spiked from about 11% to 16%. Now it's settled just under 15%. But yeah, I think the point is with online retail, we're still in the early stages. Global market share for online retail is above 20%. The U.S. is still under 15%. Why is that? Well, we like to drive and take our automobiles out. Our mobile payment technology isn't as robust as countries in Asia and Europe. And there's this tradition of simply, going to the store. Well, that really changed and boosted kind of the penetration rate during COVID. And we think that's going to only accelerate growth going forward. Going back to 1999, pre-COVID, we saw 20% a year compounding average growth rate of online retail market share. And we think that will continue to happen. The World Bank thinks that we're going to get to 50% online retail market share worldwide in the next 20 years. If that's the case, U.S. companies have a huge amount of upside because they're only selling about 15 cents of every dollar here in the U.S. today.
Christian, I want to go back. You mentioned a $4,000 kind of price target that you have in mind. Would love to kind of hear your thesis on that. I'm looking at the stock. It's at $3,454.20 right now. What are the drivers and the catalysts for you going forward?
Well, I think, first of all, Prime Day could be a great catalyst if they're able to show that they're going to beat their record sales last year during the lockdown. I think that's huge. This year, 20 different countries are going to be participating. 2 caveats: India and Canada are out, so not ideal, but still a good amount of markets that are open for them. They can execute there, then successfully transition the CEO role. I think that's going to be big. AWS and that unit really seems to be the big growth side of this business. So they have to defend against Google and Amazon and Microsoft here in that battle. And then finally, I think they have to come through this whole regulatory environment clean, either maintain their business, or if they're going to break up in maybe 2 to 3 entities, which could unlock a lot more value than maybe $4,000 could in aggregate for the Amazon shareholder. This is a massive company involved in so many businesses. And perhaps the market is discounting right now, believe it or not, at $3,500 based off what it would be valued at independently. So we're going to be watching all of those unique kind of variables going into the next year. And, again, we are bullish on Amazon here.
Christian, when you bring up the regulatory future for them, there is the new head of the FTC who certainly seems to have her sights on breaking them apart. As an investor, though, how long should I be willing to wait for that to play out? That could take years, couldn't it?
Yeah, it really could. And, it could be a lot of negotiations in store for Amazon. And maybe, potentially Amazon could outlast the Biden administration. And maybe we could see somebody new at the FTC. Certainly, Amazon has a lot of resources. We think when investing in online, the challenge in online retail stocks, the challenge is not to get overly concentrated in a company like Amazon, because we've actually seen better performance over time owning some of the smaller names. In our online retail ETF, iBuy has more than doubled Amazon in terms of performance over the last year. And it's been these names like Shopify or Stitch Fix or Wayfair or Etsy that have really driven a lot of the gains in the online retail space. And Amazon may, be a victim of its own success here and maybe get less focused on this massive opportunity of online retail market share. And if that's the case, investors need to pay close attention to how long they want to hold that, because again, we could see some staleness in Amazon if it gets in a long-term debate with the U.S. government on being a technology platform that has too much monopoly type powers.
Christian Magoon, Amplify ETF's CEO, I thank you so much for your time. And coming up, we'll have DoubleLine Capital's Robert Cohen to discuss how to play inflation in your portfolio. Stay with us.
And welcome back to Yahoo Finance Live. 15 minutes to the closing bell. Quick market check for you. We're watching the Dow up more than 560 points. S&P 500 is up over 50 points, and the Nasdaq is up over 95 points. The yield on the 10-year, by the way, 1.48. The reason I bring that up is we've been talking a lot about inflation, and we're inviting into the stream someone who can help us strategize our portfolios when you're worried about inflation or if you want to use it to your advantage. Let's bring in Robert Cohen, Director of DoubleLine's Global Developed Credit Group. It's good to have you here. And help all of us understand something. And if what I say is inaccurate, correct me. But there was a discussion earlier in the day that I heard in which they pointed out that the 10-year and the 2-year, the spread is actually flattening, which wouldn't that mean we're headed toward a recession, or at least that's what bond investors are telling us, because we're hearing counter to that. So as an investor, how do I make heads or tails of the 10-year actually being below 1.5 and the 2-year possibly rising?
Yes, hi, thanks for having me. Doesn't necessarily mean that we're on the precipice of a recession. What it means is that inflationary concerns on the long end of the Treasury yield curve are abated or mitigated because the expectation for what people refer to as persistent inflation is coming down a bit. I think mainly because people are looking at what were the big drivers of inflation in the latest print, and they're related to things like airlines and used cars, things that presumably should be transitory with respect to inflation. So I think it's just suggesting that it's all else equal a little less risky to be in long duration bonds because the Fed's going to hopefully take care of inflation. I think that's what we saw, particularly after there was signaling that the Fed is going to maybe taper a little sooner than planned. So I think that was sort of the Fed recognizing that inflation got a little bit higher than they expected it would, and they are at least watching this and are willing to act if necessary. And I think that's what makes investors in the long bond a little bit more comfortable.
Robert, Julia LaRoche here. It's hard to believe it's been over a month since we last spoke at DoubleLine. Would love to kind of hear an update from you on your own views as it relates to inflation and how much of a risk you think this might play.
Yeah, so I think we've always said inflation is a risk. It's not a certainty. It could be transitory, but I think there are many reasons to consider why maybe it won't be. You were just talking on an earlier segment about airlines. American Airlines announced that it's having to cut some of their traffic because they're unable to ramp up flight operations. So transitory comes down to what's your time horizon. Seems like in the case of American Airlines, it's taking a little longer than they thought. That's maybe one little point, but if you look more broadly, some of the key components of inflation, the owner's equivalent rent, which is the way that CPI computes housing expense, is 25% of CPI, and it hasn't moved up. Owner's equivalent rent hasn't moved up as fast as the housing market has. So I think that could provide upward pressure. Certainly, we have wage inflation coming, and the persistence of that is hard to tell. Time will tell. I think it's hard when you're paying premiums now to get employees back in to deal with that and mitigate that as time goes on. So that's something we have to watch. And we have corporations now onshoring manufacturing in a way that we haven't talked about in decades. So, for example, semiconductor capacity is being brought back onshore. Some analysts expect that could be as much as 30% more expensive than manufacturing in Asia. We've talked about in the past about critical healthcare infrastructure coming back to the U.S. We manufacture a lot of pharmaceutical and healthcare supplies in Asia. That was something that was a concern that people are bringing back onshore. All these could potentially be more drivers of more persistent inflation, but I think it's too early to tell. We view it as a risk that you have to manage when you're managing investment portfolios.
Yeah, something DoubleLine's certainly known for is managing for that risk. So I want to bring this up with you because my conversation with Jeffrey Gunlock at your offices, he mentioned floating rate corporate debt being very interesting to him. That is your area of expertise. How can the viewers at home think about playing the inflation trade in the context of their portfolios? What would be a smart move for them?
Yeah, I think in order to understand the floating rate trade, you have to understand where we were and how we got where we are now. So at the onset of the pandemic, a little over a year ago, credit spreads blew out, and the opportunity in corporate credit was in the most beaten up areas. So you could play transportation, gaming, retail sectors that were the most displaced by the pandemic and had the most opportunity for recovery. So as an example, CCC high yield had a yield of 19, 20%. Now it's compressed down to sub 6%. So we've gone from this immense opportunity with the market being beaten up last year to a point now where spreads are very tight and inflation concerns and interest rates are part of the discussion. So with all of that spread compression, we've now moved to a period where corporate credit is less of a reflationary and beta trade and more of a carry trade and more of a credit selection consideration. So in that environment, you have to think about what does well to allow you this carry trade with mitigated downside risk. That's what gets us to bank loans. If you take investment grade credit, it has a very long duration of 9 years. It has a yield of 2. That yield to duration relationship we find very dangerous in an environment where rates could be rising. Our outlook, basically since the beginning of 2021, is that we favored bank loans. So we had an overweight on bank loans.
Right.
We were neutral on high yield, and we were underweight investment grade. And so the idea simply is all about duration in an environment where spreads are tight and we have this carry trade now. You want to be in an asset class that has lower duration and a little bit more credit protection if volatility hits.
Robert Cohen is director of DoubleLine's Global Developed Credit Group. We appreciate your being here. We'll be right back with the closing bell.
Let's head down to the New York Stock Exchange where we have Yahoo Finance's Jared Blifrey. Jared?
look at the Wi-Fi Interactive, we are sitting on some nice gains to begin the week. Dow is up over 1.75%. You can see that's over 600 points now at session highs. Just a few minutes to the bell. Also looking at the S&P 500 up over 1.25%. And the Nasdaq is a little bit of a laggard. Small caps up 2%. So let's take a look at a heat map here. We can see a lot of gains in the broader market. Amazon coming down a little bit. That's down 1%, close to breaking up. It hasn't been able to do it, but you see gains for Apple, Google, Microsoft, all up more than 1%. And just a quick look at the sector action, energy and financials, the biggest gainers.
Thanks so much, Garrett. Welcome back to Yahoo Finance Live. I want to bring in our panelists as we head into the close here. We are joined by Melissa Brown, Managing Director of Applied Research at Contigo, and Ann Berry, Wheelhouse Chief Investment Officer. Welcome to you both. Melissa, I want to start with you as we head into the close here. What do you make of the kind of action we've seen in the market today versus what we saw this last week?
Because I don't see the changed between last Thursday and today. So I am finding it a bit surprising, although we were going in with reasonably good market sentiment, even after the close on Friday. So maybe any little bit of good news was rewarded today.
And hey, Ann, how about you?
One of the things that we've been watching very closely is which way inflationary pressure would tip some of the growth stocks. And so what we've seen today, which is the upward movement again on the Nasdaq, the upward movement again in some of the key technology stocks, some of the key social media stocks, very much in keeping with what we would have expected, which is as folks look about where to put their capital in a rising inflation environment, this return to growth feels natural. And we're really looking now, as people come out with announcements on what the second half of the year looks like, we're looking at what new business models are likely to persist going into this post-COVID environment.
Well, we're just about 30 seconds to the close here. So let's take a look at where we are heading. The Dow up 596, 592 points, the S&P 500 at 58, the Nasdaq 113. Just 5 seconds away, waiting for those final closing numbers here. And there we have it, the closing bell here on this Monday.
All right, we have a closing bell, and recovery looks good after what we saw last week. The Dow had been off at the end of last week, about 3.5%. We've recovered a bit today. The Dow's going to settle up about almost 2%, 1.75%, up over 580 points. The S&P 500 is going to be up about 1.5%. It was off last week, roughly 1.6%. Again, it's going to settle around, 58 points higher today. Nasdaq was essentially flat for the week. Nasdaq's going to be up 111 points. Just some of the sectors, all the sectors today in the green, big gainer. Materials up 2%, energy up 4%. We had the call that we might see $100 a barrel oil again. Not exactly what those of us who like to drive V8 engines want to hear, but let's get back to the panel and talk about where these markets may be going. And it's really good to see you again. And I wanted to get your take for those of us who are just average investors. Are we concerned much with the inflation picture? You just heard me talk about oil, with gas prices probably going up. But is it really a problem as we go forward for future income?
I do think I'm with the Fed on this one, that a lot of the inflationary pressure I think we're seeing at the moment is temporary, it's transitory. It's a response to blockages that we've seen in the supply chain because of international movement of goods. It's been owing to labor shortages, firstly owing to COVID fears, now the debate around the stimulus. So I do think in terms of the longer term outlook for inflation, I don't worry about it so much, Adam, because I do think the Fed has said they will move quickly to tamper inflationary pressure. And so when I think about, the retail investor's income, this isn't something I'm as focused on perhaps as last week's market reaction would have projected.
And Melissa, I want to go back and talk about volatility and what you're going to be focused on as it relates to volatility, especially when we start to get the second quarter results in the coming week here.
Yeah, we have seen volatility just fall like a rock. And, as of even after Friday's move, it was about a third of what it had been at the peak during the COVID crisis. So I think that's one of the reasons we're continuing to see positive market sentiment because it seems like the risk of getting in is low, relatively low. And so, we might see a little pop up in volatility after today's move also. But that's been really the biggest bright spot that we've seen in the market.
And you're the second person who's joined us today who said, look, pay attention to Amazon, although it's been kind of sideways for the past couple of weeks. Why are you, I'm going to say it this way, why are you high on Amazon with all of the hurdles they face if the government really does try to break them up?
I think Amazon's an absolutely unstoppable juggernaut. So Adam, I'll take your statement, why am I high on it, and say I'm very bullish on this. When you look at the history of Amazon, it has been completely unapologetic about trying to expand into white space at breakneck speed. If it looks like it's going to fail, it pulls the plug. If it looks like it's going to succeed, it doubles down. I think the fact that pharmacy is now an area Amazon's been pushing in aggressively is a massive white space for them. Opening of grocery retail, massive white space for them. Now this acquisition of MGM, I think there's convergence of content and commerce. We're just at the early innings. I think Amazon is doubling down on getting real talent and content library in-house. I think they have got a long way still to go, even with the regulatory pressure.
And Melissa, one of the things that was interesting in your note when you're thinking about sentiment is the roof score that you all have, risk on, risk on, internal scores that you all tell us a bit more about what you're seeing and what is kind of showing you right now, and what can you infer from that data?
Well, I mean, we have been seeing, for example, investors seeking risk. They're buying higher volatility stocks. They're buying other stocks, higher beta stocks that that indicate that investors are willing to take on the risk that those stocks entail. And as I mentioned, we're seeing volatility also come down, which is something that we view as being a driver of market sentiment going forward. So all of those things kind of converge to say, okay, sentiment's looking pretty good now, but we're also looking at some other parts of the market that typically do better when sentiment is poor, or don't do as well when sentiment is strong. Looking at some kind of measures of value or dividend yield, and so there's a little bit of divergence. There's also divergence between the U.S. and much of the rest of the world, where the investors in the U.S. market seem to be much more positive than we're seeing in, say, Europe.
And as we wrap this up, again, I approach this from the average kind of retail investor. What are we not saying? I mean, we talked about Amazon, we talk about the juggernauts in tech, but what are the areas, the sectors that perhaps we're overlooking that we should pay attention to, especially on the eve of Q2 earnings reports?
Well, I do think there are actually some areas of traditional retail that people may look at and say, they're sort of clunky and that there may not be much room to go, but they're doing some really interesting things. Albertsons, for example, big traditional grocery store, today just announced a very interesting partnership with DoorDash to get very rapid grocery deliveries out there. So I think going back, looking at some of these traditional retailers like the Albertsons, like the Walmarts, and seeing in these earnings results discussion around new ways in which they're trying to do business and to get to consumers directly, that's what I'd be looking out for right now.
Ann Barry, a Wheelhouse Chief Investment Officer, and Melissa Brown, Managing Director of Applied Research at Contigo. I thank you both for this excellent panel this afternoon. Thanks again. And I want to bring in Yahoo Finance's Jared Blickery for his final thoughts on the market today. Jared?
Well, let's go back to the Wi-Fi Interactive. I was looking at the day's price action. By the way, nice price action today for a Monday. I'm still watching like a hawk the 14,200 level. Haven't gotten there. If we sell off from there, probably going to see lower prices, but maybe the worst is over. You take a look at the Nasdaq, that's close to record highs. S&P 500, a little bit close. And taking a grain of salt with the weak price action that we saw last week, we are heading into the seasonally worst period of the year, one of the worst periods of the year over the next 2 weeks, deteriorating breadth statistics that we're looking at. So there could be some more weakness, not quite out of the woods just yet, but nice to see the green on the screen here today.
All right, well, Jared, thanks so much. I want to turn our attention with need financial regulators, and for that, I want to bring in Yahoo Finance's Jessica Smith. Jess?
Yeah, Julia, President Biden is having a closed-door meeting with people like Treasury Secretary Janet Yellen and Fed Chair Jay Powell, along with the heads of the SEC and the CFTC. This is Powell's first meeting with President Biden since inauguration, and the White House is saying that this is a routine check-in, that they aren't expecting any policy decisions to be made in this meeting, but they are checking in. The White House is getting an update from these regulators. We are expecting some sort of a readout at some point today to hear more about what they covered, but the White House said they had planned on talking about climate and increasing access to credit. Julia and Adam.
Julia, do we still have you there? I think we were having a tech issue. Tell you what, I'm going to take it from here. And I'm just going to say, when we come back, we are going to deal with that issue of inflation when our editor-in-chief, Andy Serwer, joins us. And we're going to explore the two issues when it comes to inflation that a lot of us may be missing. Welcome back to Yahoo Finance Live. We talk a lot about inflation and the impact it might have on the strategies you employ for your investments. But our editor-in-chief, Andy Serwer, published an article where you pointed out, Andy, that when we talk about inflation, there's something that several economists, or even those of us who in media talk about, that we forget, which is the incredible productivity that technology plays in the future of inflation. So help us understand what we might be missing.
Right, Adam. Well, I mean, the big question about inflation is it transitory, which is economists speak for temporary, of course. And my take there is if inflation is mostly because of what happened with COVID, in other words, disrupting supply chain, creating labor shortages, and if that is going to end at some point fairly soon, probably some point later this year, then one would imagine, or one could surmise, that the impact of inflation would be temporary as well. So that's sort of where I come out with that. And then addressing your point square on, though, Adam, and that is that I think technology, and particularly consumer technology, is such a powerful force in our society, in our economy, from here to the rest of our lifetimes, through the rest of our lifetimes, that I just feel that that force, that deflationary force of technology, which reduces the cost of making clothing and drilling for oil and shipping things, is so powerful that it will weigh down inflationary pressures for a very long time. It's a very powerful force.
Andy, I want to bring up another story for you, since you are in Maine right now, and that's that Maine became the first U.S. state to enact a law that requires divestment from fossil fuels. From my understanding, the state treasury and the public employees pension fund must dump fossil fuel holdings by 2026. So what's your kind of reaction to that? And is this a Maine only thing, or do you think other states might do similar actions here?
Well, Julia, there's an old line, as goes Maine, so goes New Hampshire, or something like that, right? I mean, or as goes New Hampshire, so goes Vermont. Right now, Maine stands alone, but Maine has always kind of been an iconoclastic state when it comes to politics. However, divesting of fossil fuels is something we're seeing across society with big pension funds. Brown University is divesting from fossil fuels as well. And so it is not that strange a point to make. It's hard to actually implement, though, Julia. That's the thing is, first of all, yeah, you want to sell Exxon and Chevron, but then what about railroads? What about trucking companies, et cetera? And what about companies, then going back to Exxon, that are doing the right thing? They're getting into carbon sequestration and alternative fuels like solar and wind. And would you punish those companies that are trying to pursue non-carbon energy sources? They're tremendous employers. So that's a question, and that's an argument against this. And the SEC is going to be making companies disclose about the risks when it comes to climate change and exposure to these kinds of risks as well.
Andy, you bring up the issue of the state pension funds, and do they perhaps actually undercut themselves going forward because they have such tremendous obligations? And the fossil fuel companies, I mean, you just said it, our Royal Dutch Shell has made a commitment to become much greener, and yet it would appear they're being penalized.
Yeah, and I know a lot of people in this business, and you probably do too, Adam, in the money management business, who would consider themselves liberal Democrats, who are very concerned about climate change, but at the same time think it's a bad idea to ban investment into these kinds of companies, because what it does is it sort of limits their amount of capital that they can access, and therefore makes it even more difficult, perhaps, for them to change and implement change. And the other thing, from an investing standpoint, conversely, wouldn't you want to support these companies? Never mind, perhaps the returns they might garner from making these types of transitions. So I don't think it's a clear-cut issue, and I know people who argue on both sides.
As long as we can get lobster under $8 a pound. I don't know what it's going for these days up there, but anyway, Andy, have a wonderful time in Maine.
Right now.
Yeah, send us some steamers. All right, Andy Serwer, our editor-in-chief, all the best to you. When we come back, we're going to be taking a look at more of how these markets are moving, not only when it comes to inflation, but we're going to be talking more about the psychology behind things like Amazon Prime Day.
Welcome back to Yahoo Finance Live. It's time for news on the move. Alabama Governor Kay Ivey declares a state of emergency on Monday in 8 counties following the loss of lives, injuries, and power outages by Tropical Storm Claudette. At this time, the storm has been blamed for 14 deaths, including 8 children who died in a highway crash. Well, ready, set, sail. Royal Caribbean's Freedom of the Seas departed Miami on Sunday. This is the first cruise ship to set sail from a U.S. port in 15 months. The cruise is a 2-day test cruise. Now, Celebrity Cruise, which is owned by Royal Caribbean, is scheduled to see its Celebrity Edge ship depart Fort Lauderdale on Saturday, marking the first revenue cruise to leave the U.S. since the no-sail order was implemented in March 2020. And blast off Bezos, more than 55,000 people have signed a petition on change.org to not allow Jeff Bezos to return to Earth. The petition states billionaires should not exist on Earth or in space, but should they decide the latter, they should stay there, end quote. Bezos' spaceflight on Blue Origin is slated for July 20th. And now, all eyes today, of course. Well, let's take a quick check of the markets of where we ended the day here. Of course, the market did much better than it did on Friday. We have the S&P 500 closing up 58.34 points, or 1.4%. We also have the Dow closing up 586.89 points, or 1.76% here, and then the Nasdaq closing up 111.1 points today. And as I was mentioning earlier, we want to discuss Amazon Prime Day, that huge shopping bonanza, but maybe more interestingly, the psychology behind it. I want to bring into the stream our next guest. We have PK Kannan, Dean's Chair in Marketing Science at the Smith School of Business at the University of Maryland. PK, welcome. And I think we're excited to have this conversation because it is quite intriguing when you talk about the psychology behind Amazon Prime Day. Walk our viewers through what that means.
If you think about what they are trying to do is put the consumers in a situation of scarcity, right? It's a 2-day event, and consumers know that they're going to get 40 to 50% discounts on several items. And they are looking at giving them some limited deals, like lightning deals, which last only for maybe a couple of hours or 2 hours or so. And they also have limited inventory for these lightning deals. And as consumers look at the counters, which are ticking down in terms of how much time they have and how much inventory they have of these items, they feel a psychological pressure, right? So these are acting as scarcity cues in order for them to take some action which is unplanned and which is on impulse. And so consumers then don't have much time to react, and they look at the deals and they just want to buy something, and they end up spending a lot of money on these items.
And then we get buyer's remorse. PK, I am curious, there's this concept of risk aversion. Is that what's at play here? Because there was an analysis of these deals, and you just mentioned the 40, 50% off. That's few and far between. Most of the deals that people get today and tomorrow at Amazon are less than 10% off as bupkis.
That's right. So what they try to do is to have a few items which are like traffic builders. People come there and they get exposed to these other deals and they end up buying it. And the reason for buying these items is because Amazon has a great return policy. So if I'm looking at a deal where I can actually get an item, buy it immediately without having to think about whether that's going to be a good fit or not, what I'm thinking is, let me buy it now. And if it's not a good fit, I'll return it tomorrow when I look at it. So that's the kind of psychology that drives this buying behavior. And not only that, they look at other people buying these items because you see this inventory going down very fast and they can see other people buying these items and they see that there is a social persuasion here. So there's a herd mentality and then I go jump into it and then I start buying these items without having to think much about it and then say, well, if it's not going to be a good fit for me, I'll return it tomorrow.
You know, it's interesting. You mentioned the social persuasion aspect of the shopping. I'd love to explore that even further. And, as someone, in your role at the university, maybe even interacting with the younger generations, how do you see the social persuasion and the shopping how do you see that across generations?
If you think about the younger generation now, they are extremely adept at online buying. They actually talk to people in social media. And someone goes and mentions on the social media that they purchased something, and immediately there is a lot of interest in it. And so the social persuasion is also enabled by the connectivity these younger consumers have. And so what really appeals to them is if their friends are buying it, they need to have that, and then they go and just buy it. And so this is basically what we talked about, having acceptability by their peer groups, and if they are buying it, I want to buy it. And so this social persuasion is a very interesting concept, which makes people really succumb to peer pressure and then mimic what other people are doing.
There's another thing that comes to play with retail, and that's the paradox of choice. I mean, with Amazon, you have thousands upon thousands of potential choices, but I looked at my own history on Amazon. I buy the same thing over and over again. I just got an order of Dickies socks, the same socks. How much are we slaves to our past when it comes to retail at Amazon?
It becomes a habit for most of us, because if I were to look at my own purchase history at Amazon, I also buy the same things over and over again. And it becomes a habitual kind of a thing. And also they make the shopping process so easy so that you really don't have to think too much about it. Now, repeat buying is a process which we all know that if you have had good experience with the product that we have bought before, we don't have to think much about it. And so Amazon really plays on it, right? They send you all these recommendations, and when you go to their website, you have things aimed at you because they personalize it for you. And it becomes very easy for you to go ahead and complete a transaction. If there is a one-touch, purchase button, and your credit card is already there, and they make it very smooth. And that's why they have been extremely successful in making these huge amount of sales during Prime Day and otherwise.
It's so interesting because, you're right. It kind of keeps you there within that ecosystem, and it may make it easy. So I guess it kind of brings up the question of the competition out there and how other retailers kind of need to adapt, or how do you kind of think about the evolution amongst the other retailers to kind of step up their game?
Yeah, other retailers have to take advantage of this Prime Day also, because Prime Day is becoming something like a Black Friday and a Cyber Monday. It's not at that same scale, but still, last year, about $12.3 billion of sales was done at Amazon. And if other retailers sit at the sidelines and don't compete for this time, they're going to just let Amazon run away with these sales. So other retailers like Target and Walmart are actually having their own sales. And the idea here is I want to dampen the enthusiasm at Amazon by giving my own sales so that I get a share of consumers' time during this time so that people will come and buy products on my platform. And so I think it's a good idea for other consumers to follow suit so that they don't just leave the market whole for Amazon. And, in the past, we have seen that retailers who have sat on the sidelines, they are not actually getting any additional sales or sometimes even losing sales. And so it's a good idea to just jump in and make sure that you compete for all these eyeballs.
I won't say the brand, but was shopping TVs before the Amazon sale, and Best Buy had a better deal than the Amazon deal. I got to ask you, though, as we go forward, and I asked a previous guest the same question, given the behemoth that is Amazon, and which is actually all of e-commerce, why is it only 15% of total retail in this country?
That's a good question. It's going to increase, but people have their habits. You actually buy something online. Some of those things you really don't want to buy online because you feel much safer to go and check it out yourself and, touch and feel. And so, we talked about risk costs. Risk costs are very high for lots of product categories, which you don't want to buy online. right? It's easy to buy electronics because I know what it is. It's easy to buy items that are branded because I know what it is. But many items where there is a fit concern or where there is a performance concern, I really would like to go and touch and feel and ensure that I'm getting the best deal possible and it's something that I really want. And so that's the reason that online hasn't really taken off as much. But although, as today's consumers get older, the younger consumers get older, you're going to see more and more shopping go online.
Well, PK Kannan, Dean's Chair in Marketing Science at the Smith School of Business at the University of Maryland. Thank you so much for that really interesting discussion on the psychology behind Amazon Prime Day. Now, stay with us because we're going to have more coming up on Yahoo Finance, including a discussion about how businesses can capitalize on women's sports.
Welcome back to Yahoo Finance Live. We talk a lot about the differences between what male athletes earn in professional sports and what female athletes earn. But now there is a way, and you can download the report today, to help figure out the way businesses can capitalize on women's sports. And helping us talk about the FAN Project is Angela Ruggiero, CEO and co-founder of Sports Innovation Labs. Also, by the way, the hockey player and four-time Olympian and I believe gold medalist, aren't you?
I do have a gold medal. It was fun. Fun times being a hockey player.
Yeah, you don't flaunt it. You should wear it like a necklace, right? Tell me about the FAN Project, because since we've been doing the live 8 hour at Yahoo, this has been a recurring theme about how do we capitalize on women sport, and businesses could make a lot of money here. Tell us.
Yeah, so the FAN Project is an initiative of Sports Innovation Lab, my company. We're a market research company that focuses on the fan, really understanding how technology is influencing fan behavior. So with that backdrop, we set out and worked with a variety of partners, including the WWE, WNBA, UFC, LPGA, to write a research report developed using consent-based data. So fans actually gave us their social media data. And by looking literally at what they've done in a longitudinal way, going as far back as 2007, we believe with this report, with this research, we've been able to unlock the business potential of women's sports. So looking at fans, looking at their behaviors, we believe there's a massive market for women's sports, but you have to understand those fans and those consumers and actually build sports in a different way. So as I say, don't lift and shift the men's model, really focus on the future fan, the fluid fan, which we've found exist in the women's sports market in a higher propensity, and build the business around women's sports with more storytelling, as an example. New ways to distribute content isn't just linear. It's OTT. It's social. Create this community-based monetization model. So high level, there's a massive opportunity in women's sports. The data through the Fan Project has unlocked that. And what this report's going to do is lay out the blueprint to go to market, essentially saying, how do you monetize women's sports? Here it is in this report.
Let's explore that blueprint. You're talking about this kind of fluid future fan, this fluid fan base that you have, not lifting and shifting the men's model. You've obviously untapped something that's super interesting here. Let's explore that blueprint in a tangible way.
Sure. So again, anytime you're going to build a business, you have to understand the consumer first. So that's what this report is all about. Let's actually measure these fans. The fluid fan is something we've been studying for about 5 years here at Sports Innovation Lab. It's this future consumer, the future growth engine to the sports industry. You have these traditional diehard fans. They're going to buy, tickets and merch no matter what. We're in the age of the fluid fan. And so if you can understand, again, this digitally savvy consumer, one that is fickle, you have to do more to keep their attention. But they're more likely to invest in the athlete as opposed to the team or the league. They like to follow their values, as an example. And women's sports have actually understood this. And those that lean in, that produce content in a different way, as I mentioned before, storytelling, right? The Olympics do this better than anyone else. WWE does this flawlessly. You're creating a narrative 24/7, 365. It's not just about the game day stats. So what you're producing and how you're doing that is more around the athlete as the entertainer. And again, you're going to follow these athletes throughout not just their game day, but outside of game day. You're going to then distribute that content in multiple platforms, not just linear broadcasting fees, which typically men's sports make the lion's share of their revenue on. You're going to go do deals with Twitch. You're going to go figure out how to create short form content for social media. You're going to create a portfolio to distribute this really interesting content that, again, isn't just about game day. And then you're going to take a step back, say you're a brand, and you're going to measure your return on investment in a different way, not just subs and viewership and numbers, but more about quality of engagement. And that's what we're seeing. We actually measured quality of engagement, and for brands that sponsored women's sports, they had an immediate increase in brand engagement and higher levels of brand affinity.
Help us understand simply, and this is just a hypothetical. Let's say I'm Coca-Cola, and they're fan of women's sports. The storytelling is queen, as you point out. So how do they then use the athlete or the team that they then want to monetize to reach the fans on the various platforms you just described?
Well, if you take about it, this idea of athlete-driven media that we've been talking about for years, athletes can now go direct to consumer. A brand like Coca-Cola, which, by the way, I used to be a Coca-Cola athlete, they might create more content for me. And so when I'm playing in the Olympics and I'm talking to my fans, there's more branded content that tells more about me, the person, the influencer, the entertainer. And so you understand athlete is a massive channel in addition to your team or your league. You're going to create more long form content, short form content, and understand that when you make these investments, when you change how you activate, so to speak, you're going to have a massive increase. We saw actually, our data said there was a 2,700% increase in fans exhibiting one or more of the core behaviors that we measured, correlated to Visa following their announcement of equal sponsorship of the men's and women's national soccer teams in 2019. Over 1,000% increase in the same kind of affinity with Budweiser following their announcement of the NWSL in last year. So we can measure now, not only just announcing it and supporting women's sports is good for the brand, because again, you have these extreme loyalists now in the women's sports market. Yep.
With only about 40 seconds left, what do you think about the Supreme Court ruling today? Is that going to open up the ability of female college athletes to then be perhaps championed by the kinds of companies you and I have been talking about and take them to the next level?
Yeah, name, image, likeness. The athlete is the channel now. It's the direct to consumer. It's what's in the Fan Project report. And this ruling, I think, opens up, again, additional revenue streams and opportunities. And those companies that understand that are going to lean into the athlete at the NCAA level and start investing in them, supporting them. So I'm extremely excited for athletes to have more opportunities to make money and leverage their brand. But it's a shift in society. It's a shift in technology. And again, the athlete is the distributor.
Real quick, let's just let everyone know that the Fan Project report is downloadable at the fanproject.co. We really appreciate your being here. Angela Ruggiero, Sports Innovation Labs co-founder, CEO, 4-time Olympic medalist, and we should point out a gold medalist. All the best to you. We'll be right back.
Welcome back to Yahoo Finance Live. I'm Julia LaRoche in for Shauna Smith today. Well, we want to talk about the Supreme Court's ruling on the NCAA and what that means for college athletes. So I would like to bring into the stream Yahoo sports reporter Pete Thamel to break this ruling down for us and what it means for the college athletes. Pete?
Julia, well, I feel like this ruling by the Supreme Court will not be remembered as a transformative ruling like the one in 1984 that changed the way college football was viewed on television, for example. This feels like, remember the movie Swingers, like the guy behind the guy? This feels like the ruling behind the ruling, meaning this ruling in its pure form is opening up educational benefits to college athletes. But if you really read what the justices wrote, especially Justice Kavanaugh, it feels like the Supreme Court is daring someone to challenge the NCAA in terms of antitrust, to challenge the NCAA in courts in terms of essentially paying athletes and professionalizing athletes. It feels like we are a step away from that happening, and this is an important step in that ladder to get there.
So this isn't a catfish hunter kind of moment in sports history, but what does it mean for those of us who might love watching college athletics? What does it mean for the people we're cheering? They going to make a buck or not?
Well, they're well on their way, and this ruling, I think, history it'll end up getting lost a little bit because July 1st, in about a dozen states, name, image, and likeness, which we've talked about many times on Yahoo Finance, is about to become real in some states. And essentially, the big thing left with name, image, and likeness is, will the NCAA make a ruling? Will Congress pass a law? Or will there be 50 individualized laws in different states? And what this Supreme Court ruling today, to me, says is the NCAA is going to have a hard time limiting what athletes can get from their name, image, and likeness. I think it handcuffs them slightly and really signifies that the NCAA has just done a dismal job in its leadership standpoint. A dismal job from a leadership standpoint in becoming over litigious and spending hundreds of millions, tens of millions on protecting amateurism when they should have simply worked with athletes to say, oh, you want extra educational benefits? Sure, you can have post-grad opportunities, you can have free laptops, you can get credits. Instead, they just kept going to court, paying the legal fees, clinging to their piece of the cookie instead of working with the athletes while they were making billions and schools were making billions. And this is kind of the start of their grand comeuppance, losing money and losing control. If you want to think of what the NCAA is like right now, it's basically a stuffed animal roped to the back of a Mack truck that's going down the highway at about 65 miles an hour, and it's just going to get bounced around with no control of its fate.
Well, there you go. Well, so the NCAA has its views, but I'm curious, what about the teams? Where do the teams stand on issues like name, image, and likeness?
So the schools stand where their state stands right now. And obviously there's, if you just take Division I football, for example, in FBS football, there's 130 different. So you can't say the schools stand anywhere specific. But essentially, the schools are going to work with athletes to help them profit off their name, image, and likeness to the amount the rules allow them to, because that's going to make their school more attractive. Louisiana Monroe is all of a sudden not going to be able to come up with better ways for its student athletes to make money than LSU. I mean, that's just going to be the realities of it. The powers are going to remain the powers. But one of the crucial things will be how these rules read, because as of right now, it's perceived, and again, these are supposed to take place July 1st, and we really have no idea if there's going to be any sort of uniform rules. So everyone's sort of operating in this weird world of ambiguity and hypotheticals, but essentially an athletic director or an associate athletic director can't say, hey, Johnny Recruit, this is how you can make $500 from the local car dealership, local restaurant, et cetera. There's going to have to be third parties that do all that, which is it's going to be messy and it's going to be uncomfortable because amateurism was essentially the best deal going for the schools and for the NCAA, and that's all going to change in a quick period of time.
Well, we'll definitely want to have you back to discuss this further. So Pete Thamel, Yahoo Sports reporter, thank you so much for that breakdown. Now, earlier today, Chris Beals, WM Technology CEO, joined Yahoo Finance Live to discuss the company's SPAC deal. Take a listen.
It's been a great path, ton of hard work from the team. I think we
We're really aided by the fact that we have a very mature management team, and so getting through a process like this is never easy, and so it's really exciting to have officially had our debut on Nasdaq last week. But yeah, sort of the Google meets Shopify of the cannabis sector. We're in a really interesting place because I think we're still in the really early stages of growth of a number of the states that have already licensed. Only about 25% of cities and counties in California, for instance, have cannabis licensing. That's a huge opportunity. And then separately, if you look towards our business in a box, that suite of SaaS offerings, that continues to expand. Our adoption continues to grow rapidly. And then as we look towards the sort of going forward, Virginia, New York, New Mexico, now Connecticut most likely are all legislatively legalizing. And so on the go forward, we see what I find to be this incredible acceleration of states of their own volition opening up. And so that really underscores a lot of opportunity on the go forward.
Yeah, maybe we can stick with the Shopify comparison there too, because I guess it is more fair when you think about SaaS and what you guys are trying to build. But last year it was $160 million in revenue. You guys told investors you expect to be $205 million this year. Is that still kind of the guidance when it comes to growth? And I mean, I guess, if you focus in on that SaaS piece, important to flex that you guys don't necessarily touch at any point kind of the leaf, which is why, you guys are able to trade publicly here. But what does that maybe look like if laws do change, what the growth could be, if not just 205 million?
Yeah. So yeah, we are and are always going to position ourselves as the operating system for the cannabis sector. And so yeah, the 205 is our guidance for this year. Really excited about the growth that I see ahead both this year and then in sort of the out periods as well. But I think the thing that's interesting for us is we are not a touch the plant company. We never will be a touch the plant company. But there's so much opportunity for streams of revenue that sits on the other side of something like federal legalization. We cannot offer any form of payment rails. There are a number of what I find to be incredibly exciting and frankly I think lucrative product offerings we could provide or things we could do to help enable these businesses. That we simply can't do until federal legalization comes because we take a very tight compliance view of sort of what is permissible and what is not permissible with this current state of affairs. We have state legalization and an ongoing federal prohibition. And so, that is a really exciting catalyst for us on the go forward is when that time comes when we do see federal legalization.
So, Chris, let me just follow up on that growth question because you did say you're still in the early stages. To what extent can the value that you see here be unlocked without the federal legislation in place?
Yeah, there's so much growth that can happen without federal legalization. I think to that point, there's so much growth that can happen just in states that have legalized already. The simple reality is most jurisdictions that have legalized still have a retail density that is far too low to enable the legal market to supplant the illicit market. So most states that have legalized still see less than 50% of cannabis demand being met in the legal market. It's a huge area of growth for us or opportunity because we see the number of licenses continuing to increase as a factor of time. And so especially in the wake of COVID-19, as state and local governments look for ways to stimulate local economies, augment tax bases, that sort of thing, the cannabis sector is a great way to do that. And so we're seeing local jurisdictions move forward with accelerating licensing. So while federal legalization is in and of itself, I think, a really singular catalyst event for us, our forward growth is really predicated on looking at the states that are already legalized. And I think taking a fairly conservative view of what states may legalize on the go forward, given that we see generally a material lag between when a state, say New York, legalizes and when the first licenses come online with something like adult use.
Yeah, you're also not the only company maybe that's trying to tackle the issue of kind of helping cannabis businesses in these endeavors. You could look at Leafly as maybe another one out there, but when you look at what Weedmaps is doing specifically maybe at the scale, I mean, what are the numbers you point to say, no, look, we're in the best position to eventually capitalize on that growth if we do see federal legalization change?
Yeah, I mean, the interesting thing is we're really in a universe of one when you look at the breadth of our offerings. It's that we have what I believe to be the largest marketplace out there available in every jurisdiction that's legalized. And then we're pairing it with a deep expertise in data because the simple reality is we estimate we see over a 20% conversion rate from consumers that touch our surfaces. It's only enabled by us taking a really complex, essentially pharmaceutical product and breaking down the product information in a way that gets people comfortable with effectively taking a pharmaceutical good that they're going to put in their body, understanding the different compounds, the different product types. And we attack that both through the data piece, but then the fact that we have our suite of software we provide, but then we also invest heavily in integration. So we integrate with almost, for instance, every third-party POS. We integrate with cannabis-specific CRMs, that sort of thing. And so that's really where we position ourselves is unlocking value, is really serving as that operating system where we can help these businesses, especially as they see margins compress, unlock revenue and profitability.
And that was Chris Beals, WM Technology CEO on the company's SPAC. Well, coming up after this, we'll have more on those American Airlines flight cancellations and what that might mean for your summer travel plans. Stay with us.
All right, time for the back page, although this was a headline. American Airlines cutting flights not because of demand. They got the demand. They can't hire enough people to keep up with it. Julia, what do you think of this?
Well, I guess, Adam, it begs the question is if you think we'll see more airlines make similar announcements on the heels of this one from American Airlines scrapping hundreds of flights. And of course, you're right, the demand has bounced back significantly, but we haven't been able to see the workers return to keep up with that demand. So curious from your perspective as someone who covers these airlines, do you think we'll see more of these? And is this a crisis or is this just a problem?
It's a problem. I'm no expert. I would not call it a crisis, but each airline approached it differently. And American had been very aggressive in its ramping up of the recovery. Look, we had 2.1 million people flying on Sunday. We're almost back to 2019 levels. In 2019, on that day, it would have been 2.7 million. The difference between American and, say, Delta, United, the other airlines, is they all let people go through early buyouts as they were going into the pandemic to cut costs. Now they're all scrambling to rehire. We're just seeing it manifest more so with American because they were laying on capacity at a greater pace than, say, the other airlines. So, will we see the other airlines canceling on this scale? Probably not. Too much of a good thing, right? 2.1 million people returning. That's a good thing. We just need to get the people working. I think the producer was just talking to me. I had trouble hearing what you were saying, Irina. So here's what I'm going to do. I'm going to do a quick recap of where we finished the day, and you can see that we were in the green. We'll see you tomorrow. Have a wonderful day.
you.